So, as you said, the word is a great word, tenuous. We're one tweet away from greatness or terribleness. So, you have to take all this in context. It's good, but it depends. So, what we could do right now is focus on things that are good. Earnings season is out. Banks just put out their numbers. Bank of America came out with really strong earnings. JP Morgan as well. So if we have earnings like we're predicting, and we know that actual earnings typically beat earnings estimates, out of the last 40 quarters, 37 times actual has beat estimates, and we're estimating a 12 to 13%. We need that straight open, and if we do, I think we're going to have good times ahead.
Okay, so corporate earnings growing at a double-digit rate, and the expectations are high for this current earnings season. So far, as you mentioned, we're seeing, especially in the banks, living up to the expectations. What's your overall expectations as we run through the balance of this earnings season?
Yeah, I'm feeling good about the earnings season. There's a lot of strong forward guidance. The war has subsided to a bit. It's still there. An active war is a blockade, but it has subsided. We do have a ceasefire to some degree. We need a deal struck. That blocking is hopefully putting pressure on China and Russia to put pressure on Iran to come to the table and strike a deal. If that happens, well, we're feeling pretty good. You look at like the American Association of Individual Investors, the AAII, just a couple of weeks ago was at plus 51. That's a lot. That's a very high bearish number. Now it's down to 43. So the market is feeling more bullish, less bearish. We are as well. And if earnings season plays out the way the forward guidance has been speaking, we're setting up for a decent remaining part of the year.
I'm curious to know where you see areas of opportunity. When you think about sector performance, yesterday tech was a leader. You had consumer discretionary at the top of the leaderboard, as well as communication services. Where do you see the sector opportunities?
Yeah, it's hard not to bet on big tech that is putting in billions and hundreds of billions of dollars into its infrastructure. It's just hard not to make that bet. They've outperformed the last 10 years out of any sector. So there's a couple of sectors that it's hard not to also look at that have been surprises. EM continues to outperform at year to date, 10.5%. Developed international outperforming at 7.5%. And in infrastructure trade, we leaned into an infrastructure trade a year ago. IGF up 10.5% year to date. So there are pockets of the markets that are doing well. When you look at large cap value, rounding out large cap value, the Russell up around 6% year to date, and growth down around 2%. So you're getting a rounding out, you're getting pockets doing well. I just think that tech sector is so diverse between hardware and software companies. It's incredible what AI has done from a destructive standpoint of the software companies.
So, Robert, are you bullish on the balance of the year? Do you expecting like an uptick in IPO activity? I mean, this is supposed to be the year of the mega IPO.
Yeah. We are bullish in this year, and I think this turnaround story of the market in relation to this war has further solidified it. That, coupled with the earnings growth, coupled with strong economic data, maybe not as good as people wanted from an inflation front. We're not at the Fed's target of 2. It is ticking up a bit. You're going to see headline CPI and PPI go up as those energy prices are still elevated. But when you listen to a Powell saying he's going to look through, keep interest rates where they're at, it just seems like there's a lot lining up for a decent market for the rest of the year. So we're feeling pretty good about it.
It reminds me of that conversation that we used to have about a soft landing from the Fed. All right, thank you, Robert. That's Robert Conzo, CEO, you got it, and Managing Director of the Wealth Alliance. Have a great rest of your day. Coming up, we'll dive into the latest look at the housing sector with mortgage application data. Plus, Alice Coffey joins us to take us through another earnings report from the financial sector. We've got Morgan Stanley's numbers to dive into. That's next on Morning Movers.
I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Welcome back to Morning Movers. I'm Diane King Hall coming to you live from the New York Stock Exchange. Time now for the economy check. For that, let's go right over to Kevin Hincks. He's live over at the CBOE in Chicago. As you know, we've got you covered from exchange to exchange. So we've got a look at the housing market this morning with some mortgage application activity data out. What does that look like now? And good morning to you, Kevin.
Good morning, Diane. Yeah, so here's the good news. 30-year mortgage dipped from 6.51% down to 6.42% during the past week. So therefore, mortgage apps firming up ever so slightly. The composite up 1.8%. That's made up of purchases that were down 1%, but refinances up 5.1%. So you see the sensitivity in mortgage applications to lower rates. They dropped slightly down to 6.42, still significantly above the right around 6% where they bottomed out before. The housing market that we know needs these rates to go lower. That's a goal of the Trump administration. They jumped up during the, with crude oil and the overall uncertainty, but now starting to ease back down, Diane, see a little positive effect from mortgage applications.
All right, let's talk through some of the other economic data that's on your radar today. We've got the Empire State Index out, import-export prices. Take us through some of the numbers here, Kevin.
Some regional numbers coming out, Diane. The Empire State Manufacturing now plus 11. That's much better than negative 0.2 it was. They were looking for down 0.2. This is always a number that's a bit volatile. So up 11, good solid number out of the New York area for manufacturing. Also, we did get some import-export prices. Imports month over month up 0.8. That's much less than expected. Import prices year over year up 2.1%. That's a little more than expected. Exports up 1.6% month over month and 5.6% year over year. So prices moving all over the board in terms of imports and exports, Diane. So all things considered, taking all this information, E-minis up ever so slightly, up 3. NASDAQ down 1.25 in terms of the futures. A very unchanged, very hesitant market in futures starting the day, Diane.
Yeah, it does seem like that. It seems like it's kind of a wait-and-see mode after the momentum that we've had to start the week, and what momentum it's been with the market clearly pricing in and into this war. Do you think today the tale of the day is headlines or earnings or some combination of the two, Kevin?
Well, the bank earnings, we're not getting to the real volatile earnings yet. We'll get some Netflix earnings tomorrow after the bell. I still think it's a headline market, Diane. Remember, Bank of America is up slightly after their earnings report. I think that looking at the entirety of banks, they're holding the levels, slight moves either up or down. Citi had a nice day, but JP Morgan, Wells Fargo was the weakest of the banks so far. So looking at the entirety as we start off earnings season, the banks are holding these levels that they've rallied up to. So far, so good for earnings season, but large cap tech looms on the horizon, Diane.
All right, thank you, Kevin. Appreciate that. And sticking with the earnings picture, we want to dive back into the banking sector with results from Morgan Stanley. Those shares higher in the pre-market off the back of the release of its quarterly results. Alex Coffey, co-host of NextGen, joins us for a deep dive. Alex, you've had some time to walk through these numbers. Talk to us about your takeaways here.
Yeah, first off, takeaways is the market likes it. Right now, Morgan Stanley shares trading up about 3% in the pre-market trade. Net revenue quite a bit ahead of the estimates that I saw, close to 20.6 billion. They come in at 20.58 billion. I saw estimates in the 19.7 range, so a really nice beat. If you were to break it down by segment, wealth management, a little bit more in line. We know this is a really important part of the business for Morgan Stanley, so something to watch there. But at 8.52 billion, it did inch ahead of the 8.45 billion expected. Where the real bright spot was within sort of riding this wave of volatility over the last several months. Their equity sales and trading revenue was 5.15 billion. That was way ahead of estimates. Their FICC trading revenue was 3.36 billion, and that was also quite a bit ahead of estimates. And this was despite the kind of disappointing numbers that you saw at a Goldman, smaller FICC trading unit at Morgan Stanley, but really seemingly did a lot better in that area. Investment banking largely in line at 2.12 billion. Underwriting a little bit disappointing, but not a huge quarter on that front. EPS was $3.43, Diane, and net interest income at 2.7 billion was largely in line with estimates. So strong quarter for Morgan Stanley.
Yeah, it is, and I'm glad you brought up FICC because I know that was one of the reasons that Goldman got dinged on the release of its results, and the view was that it was more idiosyncratic to Goldman, and you can see that with these numbers out of Morgan Stanley, even though, as you mentioned, it is a smaller part of their business. We know wealth management has been, I don't want to call it their bread and butter, but a mainstay for Morgan Stanley. Nice to see the IB numbers. Any final thoughts you want to leave us with, Alex?
Yeah, the one thing that I would point out is that investment management unit was a little bit down and their non-compensation expenses were higher, but that was largely driven probably by increased spend on technology. So we know all these companies are investing heavily in AI and other things to improve efficiencies. And while it hasn't necessarily paid off fully yet, many of these companies expect it to down the line.
All right, thank you, Alex. That is Alex Coffey, co-host of NextGen. Coming up, we'll dive into the factors affecting the housing market, low inventory, high prices, and still elevated rates as many home buyers enter the spring selling season. We'll have some insight on the other side of this break.
Trading at Schwab is powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Morning Movers. I'm Diane King Hall, coming to you live from the floor of the New York Stock Exchange. Mortgage application activity on the rise. But what's going on under the hood? For insight, we want to welcome in our next guest. That's Scott Alter, co-founder and principal of Standard Communities. Scott, thank you so much for joining us today. So we got new mortgage application activity from the Mortgage Bankers Association this morning, showing an increase in mortgage application. But it was about purchases, or excuse me, about refinancing. Purchases were actually down a little bit. How would you characterize overall the state of the housing market now?
Well, I mean, overall, there's a major housing crisis going on of affordability. We continue to see struggles for the average American to be able to afford housing. And so we at Standard Communities are focused on affordable housing, specifically growing and working with the LIHTC program in the federal government. So, you know, the housing market needs more federal housing policy. It needs more of a lot of things. But overall, I think the housing market is you know, has a crisis, and it's really a supply issue.
Okay. Okay, supply issue, because that's been one of the challenges that I've heard from different experts, whether we're talking about economists or real estate experts as well. They talk about how there's low inventory, but at the same time, there's high prices. Is that also just about the inventory?
It really is a supply. I mean, just at its core, it's a supply issue. I mean, we are short 7 million homes, and we're only in the affordable housing space, we're building about 150,000 homes a year. You know, I focus specifically on, and Standard Communities focuses on multifamily housing. And what we are seeing is capital flows in a positive way. Now, this is something that is helpful, is that we're seeing capital flows move towards affordable housing and towards multifamily housing. The market rate sector has actually struggled a little bit with transaction volumes. But in the affordable housing sector, we continue to see strong transaction volumes. And that's a result of federal policy. The LIHTC program is 40 years old, and we're actually celebrating 1986 with the Housing Tax Reform Act, Reagan's Tax Reform Act. And so the LIHTC program has been a super successful program, and things like the Road to Housing Act that we're seeing in the Senate and Congress, and it's in conference right now, are positive developments, but we just need to see the federal government push harder.
So do you think this is a policy problem? Because some say it's a rate issue too, but at the same time, given where we stand with inflation, it doesn't look like rates will come down anytime soon.
Yeah, and I think that's true. I mean, overall, construction of housing has slowed with rates having risen in the last few years, and volatility is real, right? I mean, obviously with the Iran war, with oil prices moving, with interest rates fluctuating substantially, it continues to be a problem, and so that's why it is a policy issue. I mean, I think we need to continue to see the federal government push for more housing policy. And we have seen some positive developments in the last 5 years within the federal government. And specifically using the LIHTC program as the base and then bolting on with additional policy that is pushing forward and being helpful.
What policies would you like to see?
Well, zoning reform is something that needs to happen, and it has to come from the federal government. I mean, zoning is a local issue, but it can't be addressed without seeing the federal government use either carrots or sticks, both, anything we can to be able to push for zoning reform. And then also just additional resources. I mean, we need the federal government historically has been the biggest driver of housing, and we need to continue to see those resources be driven into local markets.
So how, and excuse my ignorance here, how would zoning reform create more housing?
It just takes too long to build housing because we have NIMBYism, because we have bureaucracy, and it can take 3 years to come out of the ground ground of a multifamily property or even single-family communities. And so we need to see that go much faster.
Okay.
And faster means cheaper.
Okay. So like the speed that commercial space is developing needs to happen when it comes to here on the ground for housing. Let me ask you this question, because there are so many millennials in particular who feel like the American dream is just out of reach for them. You know, that was always the view that, you know, you want to own a home. So is the American dream dead, or is it just deferred?
I just think it continues to change. I mean, listen, we have a housing crisis, so it has to happen at all levels, meaning we need to see single-family homes built quicker, cheaper. We need to see multifamily built cheaper, quicker, and so I don't think that dream's dead. I think it's deferred. I tend to agree with you, but I don't. Again, to be able to drive, it's not a demand issue. We obviously have the demand is there. It's just a supply issue. Yeah.
When do you see things changing? Let's say things stay the same. You don't get the policies you want. I'm not saying that, you know.
Yeah, I know.
we'll take that, you know, that side of it. And when do you see things changing? Because the view I heard for 2026 was it would be a slow increase in housing activity this year for 2026, and then things would pick up in 2027. What's your view?
Well, I think that, I mean, we are seeing capital flow into the business. Given that the LIHTC program is 40 years old, there has been a substantial risk-adjusted returns for investors. I mean, Standard Communities continues to outperform its estimates on its returns for its investors. And so given that there's been outsized risk-adjusted returns in affordable housing, we want to be able to push more capital flow that direction. So I think 2026 is actually going to continue to be a good year. I mean, the Road to Housing Act is a great act. Like, it should happen. The problem with it is there's this one particular clause that people have been talking about is the institutional investors not investing in single-family homes. That's just a clause that needs to go away, and then the rest is really very positive. Even the Big Beautiful Bill had several clauses and part of it that were really significant for affordable housing and just housing as a whole. So if the government can not only just push their public resources, but also push the private sector to have banks and insurance companies be investing into housing more and more, then I think it can be it can help.
I like the optimistic point you're leaving us with, Scott. Thank you. Appreciate that. That's Scott Alter. You got it. That's Scott Alter. He's the co-founder and principal of Standard Communities. Our thanks to Scott. Coming up, time for Options Corner. We'll chart and trade Uber after its latest commitment to autonomous vehicles. Morning Movers will be back after this break.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need, all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
We're back on Morning Movers. Uber is shifting away from its asset-light model. The Financial Times reporting that the ride-sharing giant will commit more than $10 billion towards autonomous vehicles. That includes equity stakes in companies and fleet investments. Time now for Options Corner. Joining us to take a deeper look at the chart is Rick Ducat, lead market technician. All right, Rick. So far this year, it's been a down year for Uber, but walk us through the trends that you notice on the chart.
Yes, down about 1.5%. Meanwhile, the S&P 500 up about 29%. So some significant underperformance here. Not too terribly many delivery and ride-sharing types of companies here, but Lyft is the standout here, up 25.9%. So we can see as well when we look at our Uber chart more specifically that after a pretty pronounced downtrend, we're down about 28.5% from those highs near 102. We do seem to have stabilized somewhat here. We have made a consistent low point near around the 69 level or so. Meanwhile, 79 to the upside, an old low, a breakdown point, and then a subsequent high. That stands out as a resistance area potentially if things do start to improve. Downward sloping channel type shape is our prevailing theme here. We are closer to the upper edge of that channel, but we haven't seen any kind of breakout materialize so far. When we do look at our moving averages that we follow here, we are starting to see a bit of improvement. We have crossed above our short-term 5-day and 21-day, our dark blue and teal moving averages. Those come together right around the 72 level. So if we were to keep advancing, here is where our 63-day comes in, our gold EMA, 75, 65, our quarterly EMA. RSI improving as well. We are a hair above that 50 level now, so that could be a further bullish signal if we do get a crossover. Volume profile shows we have nodes here. We're kind of in the middle of this one here, around 74 or so. Things start to pick up again here between about 82 to 87 roughly. So those are the notable areas to watch from this perspective.
Okay, so those are the notable areas to watch. Thank you, Rick. Appreciate that. That's Rick Ducat, the Duke of Data himself. Now, take us through an example trade. We've got Tom White, senior options contributor and co-host of Fast Market. Tom, what's the approach for an example trade here? Is this something that you're leaning into, a decelerating or accelerating?
Well, you take a look at the technicals that Rick kind of just went through, that downward channel that we've seen. Now, the one caveat there, that 70 level has become an area of support over the last couple of months. So maybe that balances things out, even though we've still pulled back about 28% from those all-time highs that we saw about 6-7 months ago. So you have to take that into consideration. They report earnings on the 6th of May, so that might be an event that could move the stock also. But it does look like it's based out about $70. So I looked at a strategy that takes advantage of that. If we continue to kind of gyrate just above the 70 level, looks like the stock's going to open up here about 73. So I looked at a neutral to bullish strategy where, hey, if the stock does fall and breaks through 70, I'd be willing to buy the shares on this cash secured put here, where I'm going to go out to the May monthly cycle. So 30 days to expiration on this position, some short-term positioning, but you're going to capture that earnings event also. So there's some additional volatility in these options. We're going to sell the 70 strike put, that base case that we looked at on the technicals there. You're going to collect a credit for this cash secured put of about $2.25. That's what you can make on this trade, $225. Or if the stock falls below 70, you get to buy the shares at that break even of 67.75 to the downside. That's about 8% below the current share price where the stock's going to open up here, about $73.50. So you've got that cushion to the downside. Now, one of the caveats of this type of position is that, yeah, it's capital intensive, right? You've got to be willing to buy the shares if you're still short that put and the stock's below 70 at expiration. So take that into consideration. But you could also put a bid in for 67.75 on the shares and maybe never get filled. Maybe the stock doesn't go down to those levels. So this gives you that opportunity to maybe get into the stock on a longer basis to buy the shares, or just take advantage of that higher implied volatility and keep the credit that you collected with the expectation that it's going to remain above $70 a share over the next month.
All right, thank you so much there for that example trade, Tom. We got shares of Uber indicating higher in the pre-market. Futures, so little change this morning as investors take a break from the buying that we've seen this week as investors bet on and off to the war with Iran. Thank you so much for joining us today on Morning Movers. I'm Diane King Hall. Download the Schwab Network app. It's available in the App Store and tune in 24/7 on schwabnetwork.com. Stay with us. You've got Opening Bell with Nicole Petalides up next.
So what is unique about Schwab Coaching is the community.
There's a lot of energy, like-minded people are learning with you.
You can just see and feel all the excitement around getting to learn a new topic.
Some of you want to get everything face-to-face with you and 400 or 500 of your closest friends.
Some clients like to be in the privacy of their own home on an online workshop, but still having that live interaction with the coach.
As I'm talking, questions are coming in from that live audience, and they help me fill in those gaps as an educator.
People learn differently, but all those ways we actually teach it all come back to the point of making a difference and helping you make progress.
And so that means not just giving you theory, it means giving you the practical implementation using our platforms.
So we want it to be fun, we want it to be informative, and most of all, we want you to walk away with a skill set and independently be successful in achieving your goals.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. schwabnetwork.com. For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Wednesday morning. Welcome to Opening Bell right here on Schwab Network. I'm Nicole Petalides, and I'm so glad you are with us this morning. We're not that far off from record highs on the S&P 500, so we have a lot to talk about. Of course, we'll discuss all about potential rise in inflation and how that could impact the Fed's calculus as what investment opportunities, the current environment. We'll analyze the V-shaped recovery in the market that we've seen, and one guest calls a sentiment recession. We'll explain that. Also, everything Iran, as we know, there are still the calls to return to the talks in Islamabad. Right now, you are seeing oil at $93 here. So that really has shown that this market has gained after a week. We had 2 winning weeks, and then this week has been pretty great. Yesterday also, we're not that far off from record highs. We're talking about 0.5% on the S&P 500. A move today could mean a new record. 10 days in a row of gains for the NASDAQ. So here's a look right now at the futures. You are seeing just slight gains here this morning. The S&P futures are up above the 7,000 mark. Look at that, gaining 3 points. And the NASDAQ futures are slightly lower, losing 6 points. The Dow futures up 45 points, and the Russell. Also, we're going to take a look at all those bank stocks that reported, right? You have Bank of America and Morgan Stanley. We're looking at all of those here this morning in PNC. And here's a look at the futures products. Gold is down $13 at $48.36 a troy ounce. Oil's at $42.07 the barrel. The VIX is at 17.85. The 10-year bond yield has come down to 4.27. The U.S. dollar right now, 97.98, so holding that 97 mark. Bitcoin right now, still in that 74, not far off from the 75,000 what we saw. We haven't seen that in some time. 74,410, that's up about $10. And so that is the big picture. Kevin Hanks is joining me live at the CBOE for our pre-bell playbook. We know that the Strait of Hormuz is, for all intents and purposes, closed. Iran doesn't really have much leverage for negotiations or, playing the cards, so they want to come back to the table, it's reported. And that has brought some optimism in the big picture, right? So far, we've seen some gains, not far from highs, right?
Good morning, Nicole. Yeah, the market getting way ahead of some of the other commodities and other trades involving the U.S. involvement with Iran. Now, it appears to be talks of more negotiations coming up this weekend. President Trump talking on Truth Social about China is very happy with the way things are going. They're about to start getting some oil and receiving. So positive statements there. Futures not moving very much as crude oil futures have drifted back slightly higher today. We'll see how they finish the day. Obviously, they are very sensitive to headlines. I think if there's another announcement of negotiations, which I think will probably happen, that's what they're leading towards, we'll look if there's any reaction in crude oil. But right now, crude oil sits up about 0.9%, so just over the $92 level. So they're up across the board. So it looks like to start the day, the markets are relatively calm, very little movement in the futures, and there was very little movement overnight in the futures. So it looks like the markets, after a big rally yesterday, are holding those levels, but waiting for the next headline, Nicole.
So I did see one thing on Truth Social. China's very happy that I'm permanently opening the Strait of Hormuz. So I guess what they're doing is blocking the ships that are coming out of the Iranian ports and sending them back. And we've gotten reports of those ships going back, but leaving a trail, I guess, for other ships to go through. Does that seem right to you?
Yeah, that's right. If you're trying to put pressure on Iran, you have to do that without putting pressure on China as well. So you need to get them crude oil different ways. Now, here's the thing. The crude oil that they were buying from Iran was at a steeply discounted, sanctioned price. If they're buying it from somewhere else, like the United States, if China's buying oil from the United States, it's going to be at a market level, which is much more expensive. So the pressure coming from China is going to be pretty intense coming up in the next days. And then, remember, you're cutting off income to Iran. So there's only so many days that they can hold out without that massive amount of income that come from selling crude oil. So the pressure of cutting off Iran's access to the Strait of Hormuz, that's what's eventually putting pressure and going to bring Iran probably back to the negotiating table. Nicole?
Yeah, and look, the president said on Fox Business that they're going to be making a deal that they, there's also been reports that the U.S. has not agreed to extending the ceasefire. There were also reports that China would be willing to help to send weapons to Iran to help them. So it probably behooves the U.S. to try to help China with the oil situation. So all of that happening. Let's talk about some of the bank earnings. You had Bank of America that you were looking at.
Bank of America, how about this? Represents the highest earnings per share in nearly two decades for Bank of America. $1.11 per share, exceeding the estimates of basically $1.01 or $1.02. Revenue, net income, $8.6 billion, a 17% increase. Revenue, $30.43 billion, marking a 7.2% growth compared to 25. The big boost, exceeding expectations. It was driven by higher net interest income and robust trading and banking fees. That's where CEO Brian Moynihan put the reason for their outperformance in terms of earnings per share. So real good earnings from Bank of America. And again, these stocks, the banking stocks starting off earnings season, all slightly down or holding these levels. That's pretty solid because they had all rallied into their earnings report. So anything flat to slightly higher or even around this level is a pretty good win for the banking stocks. So their earnings all doing extremely better. Earnings season off to a great start so far.
Yeah, understood. And look, we also got in mortgage apps, 1.8%. The estimate was for minus 0.8%. We got in the Empire Manufacturing number, the New York one, my favorite. So we'll have a lot to follow here this morning. Kevin Hanks, thank you. We continue to take a look at some of the stock movers this morning, and we bring in Alex Coffey, host of Next Gen Investing, to take a look at Broadcom and Meta. Now, this is an expansion of a partnership. I saw this earlier this morning. And it's just exciting that every single day there is tech and AI expansion.
Yeah, no doubt about it. Meta and Broadcom announcing an expansion of a multi-billion-dollar partnership. This is the design and build AI custom chips. Deal includes commitments exceeding 1 gigawatt of computing capacity with multi-gigawatt expansion planned over time. The goal is to improve performance, lower costs, and reduce reliance on NVIDIA and AMD as Meta scales its infrastructure, Nicole. Now, a part of this, there was also an announcement that Broadcom's CEO will step down from Meta's board when his term expires, though he'll continue advising management. So as those companies become more and more ingrained with business, perhaps stepping away from an official role at both companies in order to avoid kind of those questions that may surround it. The agreement supports Broadcom's growing custom AI chip business, positioning it as a credible alternative to NVIDIA. Meta continues to, of course, spend aggressively on AI infrastructure, which is reinforcing its sort of long-term AI strategy, attempting to be one of these big-time winners in this race. Reaction so far is a move higher in Broadcom and kind of a little change move in Meta. Now, initially, Broadcom spiked more. It has eased a little bit. It's up about 2% now from where it closed yesterday. Bottom line, though, Nicole, deal strengthens AI roadmap for Meta and continues to solidify Broadcom's role as a key custom silicon partner within this hyperscale AI spending.
Understood. All right. And then we have Morgan Stanley earnings. I saw Morgan Stanley's up about 3% right now in the pre-market.
Yeah, and as Kevin said, banks so far, really nice beats on the aggregate, but the aggregate one-day price move on average has been down 1.3%. Not the case for Morgan Stanley, as it's up, as you said, about 3% or so, as indicated by the pre-market quotes here. Earnings were a nice beat driven by trading strength, especially equities. Net revenue was ahead of estimates, 20.6, beats to 19.7. EPS at $3.43 was a solid beat as well. Those equity trading revenues at $5.15 billion, way ahead of estimates, benefiting from active client engagement and volatility. The FICC trading revenue, this was a big thing that I had circled post-Goldman, and some of those questions around Goldman specifically end up being specifically Goldman questions because FICC trading was really strong for Morgan Stanley, $3.36 billion, Nicole, beats the 2.9 estimated. Wealth management continues to be a stabilizer. All in all, though, really nice broad-based beat for Morgan Stanley. Again, led by that trading revenue, but it was supported by, again, steady wealth management momentum.
Okay, it's great to see you, Alex Coffey. So right now, Morgan Stanley's looking up about 3%, Bank of America 2% higher. PNC also came out with numbers minus 0.3%. ASML, another name that reported down 2.5%. Alex Coffey, thank you. We'll continue to get you ready for the trading day, folks. Kevin Mon standing by from Hennian and Walsh Asset Management. Will be just a moment. Opening bell. We'll be right back.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Welcome back to Opening Bell. We're getting you ready for the trading day. About 2 weeks ago, we were in correction territory in the major averages. And today, we are a stone's throw from record highs. Kevin Mon, President and Chief Investment Officer at Hennian and Walsh Asset Management, is with me. We were just talking about this in the commercial break. We really almost can't believe it, right? It's minus 10% off the highs, and here we are. We're less than 0.5% from the S&P record high of 7,002. Some of your thoughts about this action?
I mean, you think about it. Over the last 10 trading days, the S&P 500 has moved up nearly by 10%. We've erased all of the losses that took place since Operation Epic Fury was announced back on February 28th. And I think it serves as another reminder to retail investors about the dangers of trying to time the market. But it should also serve as a reminder to them, if this type of volatility has unnerved them, perhaps they should take some risk off the table and invest according to what their true risk tolerance is. But investors are clearly now looking past the war and are now starting to focus on earnings, bank earnings, interest rates, valuations, which are certainly much more improved right now. And I wouldn't be surprised if we don't hit another record high by the end of this week.
Yeah, I mean, a lot of folks are feeling really optimistic. The president said, a deal is coming now. He said that on Fox Business pretty much. I'm paraphrasing. But they're going back to the table in Islamabad. And the Trump administration has been really tough on Iran. And prior occurrences. They said Iran always lost the war but won in the negotiations.
Correct.
But they can't win in these
Not this time.
negotiations because the Trump administration is shutting off the economic benefits of maybe moving oil or charging in the Strait of Hormuz. So now, let's talk about what you think the Fed will or should do in the next few meetings.
In all likelihood, the Fed does nothing. And in all honesty, they don't really need to do anything at this point in time. According to their updated summary of economic projections, which they released in March, they actually increased their forecast for real GDP growth this year to 2.4%. I know it's not a big increase from 2.3%, but they obviously think the economy is on relatively solid footing. They maintain their forecast for unemployment at 4.4%. They did increase their forecast for inflation, core PCE, their preferred inflation gauge, to 2.7, but they think that starts to come back to 2% by the end of next year. So if all of that is accurate, well, then they don't need to cut rates right now. So I take them at their word. One more potential rate cut this year, another rate cut next year. We get back to their neutral rate of 3%.
What do you think about earnings so far? I mean, we're hearing about quarterly profits and revenues, in some cases records. Investment banking was looking good. Trading revenue was looking good. A lot of beats that are happening. These banks are setting the tone. What do you think?
Yeah, I mean, overall, we're on track for our 6th consecutive quarter of double-digit year-over-year earnings growth. That's pretty impressive. Banks are telling us right now that the consumer is relatively healthy and still spending. We're seeing record equity trading volumes, record investment banking revenues. But fixed income operations are mixed at the banks thus far, and we learned from Goldman Sachs that they actually increased their provisions for potential credit losses by 10%, their largest relative increase since 2020. So perhaps Goldman is telling us something that they're concerned about that we should be paying attention to.
I did think it was interesting in the last 48 hours. I mean, we had two U.S. Big Wall Street titans. You had Citigroup and BlackRock, moving overweight equities. The prior day, you had J.P. Morgan saying buy the dip, a V-shaped rebound and recovery. Morgan Stanley turned cautiously bullish this week as well. So what are you doing? How do you make money now? Are you picking particular stocks? Is this a stock picker's market?
I think it is. I think the dip has happened. I think the bottom has been set. But if we return to all the places where significant investment opportunities were taking place prior to the conflict in Iran, I think you'll find investment opportunities going forward. And you just need to follow the money to find those opportunities. Look at AI infrastructure build out. That hasn't slowed down. Power, memory, data center construction. How about aerospace and defense? Following the mission around the moon recently, certainly aerospace is on the forefront of a lot of people's minds. Defense stocks, as a result of all the increased spending in that area to replace our munitions and upgrade our own capabilities, not only in the U.S., but across the world. And finally, biotech. You can't forget about biotech.
So you prefer to pick sectors? You don't have specific names that you could bring to
I got some names. I'll tell you.
Let's hear
sure,
some
let's
names.
go.
Let's hear. Bring
on the AI infrastructure side, let's start with Eaton Corporation. Eaton Corporation has been in business for
ETN,
decades.
right?
They actually, ETN, build out the data centers. How about the Power Solutions, Duke Energy, a large utility provider that owns and operates 6 different nuclear sites in North Carolina, South Carolina. Memory, Micron Technology, of course. The AI revolution starts and stops without memory. Then I think about aerospace and defense. How about L3Harris in terms of missiles and missile interceptors? We need to replace all those right now in the U.S. And then lastly, as it relates to biotech, Apellis Pharmaceutical, recently acquired by Biogen, the same Biogen that acquired Reata Pharmaceuticals back in 2023. I anticipate a pickup in small cap biotech M&A activity over the balance of this year.
Yeah, Apellis Pharma's APLS. You also had Micron on there.
I do.
What do you think about that group that's been beaten down? Is Micron now the time to buy?
Talk about a buy the dip opportunity right there. In my opinion, the AI revolution once again ceases without memory. And who's the leading provider of memory to all these large hyperscalers right now? It's Micron Technology. So if you can buy at these levels in 2 years' time, I think you'll look back and be very happy you did.
And at the end of the year, where do you think the S&P 500 may be?
Boy, that's a good question.
I mean, roughly.
I don't set target. I think we'll be up in the high single digits by the end of the year. Perhaps we sweep into double digits, but we got the midterm elections coming up. There's going to be a lot of volatility there. We still don't know the ultimate resolution with Iran and the Strait of Hormuz. We're going to need some time for gas prices to come down. So I think it's going to be a very strong back-end loaded year.
Right, and when you think about other opportunities abroad, Do you look abroad much?
I think you really need to consider adding international stocks to build a globally diversified portfolio. Other than March, international has been leading the way for the better part of the last 15 months. Add names selectively overseas, but still overweight U.S.
Yeah, understood. I mean, what do you think about the leadership and just how, now the other thing, like one big, beautiful bill, is that the kind of thing that would provide some economic strength going forward? People are getting tax refunds,
Absolutely.
Or a better corporate tax rate, or more infrastructure and manufacturing here at home?
All of the above. Perfect, Nicole. So if you think about the tax rebates, that puts more money in consumers' pockets, and 70% of our economic growth comes from consumer spending. You think about the incentives to build manufacturing plants here in the U.S. That creates job as well, and also somewhat immunes us from some of the supply scale shocks that could exist if further conflicts happen down the road internationally. So all of those things provide economic tailwinds, and we also know that wages are growing right now faster than the rate of inflation. So all those things line up well for the economy. It's just a question of how much do stocks rise as a result of that.
A lot of folks said the order was Venezuela, Iran, Cuba. I don't know. Are you think something happens with Cuba? I mean, we're getting closer and closer to the midterms.
Nothing would surprise me at this point in time, but I think as we're getting closer and closer to midterm elections, we need to see the stock market continue to grow. We need the economy to get back on solid footing. We need gas prices to come down. So I wouldn't anticipate too much happening before the midterm elections.
I mean, at this point, the midterm elections, any thoughts there? I mean, this is also midterm election year. Stocks don't necessarily go up 20%.
No.
I mean, you've had 3 years of 20% gains or more. Are you saying now, by the end of the year, the S&P may likely have single-digit gains, high single digits, maybe
which would be a good year.
Digit. Yeah. Your thoughts on the midterm elections?
As we know, in all likelihood, the incumbent party will lose seats in the House. If, in fact, they lose less seats, I guess that would be a win for the Republicans at this rate. But it's going to be a difficult year for the market overall. We anticipated that going in, but next year should be a very strong year.
Just quickly on all the deals every single day. I mean, today it's Meta and Broadcom. Every single day there's another AI gigawatt spending circular funding deal. What do you think about that? Do you buy these AI names? Do you buy into AI?
I think you have to buy into the entire ecosystem, not just buy into the hyperscalers. Look to the cooling and solution provider, the data center construction companies, the data centers themselves, the power providers, nuclear power provider, SMR providers, and of course the semiconductors and some software names as well. Don't just try and pick a couple winners, build a more holistic portfolio.
Kevin Mon, Hennigan and Walsh Asset Management. Thank you so much.
My
it's great
pleasure,
to see you, Kevin. Thank you. Coming up, we'll do a quick break, and then we'll count you down to the start of trading. And we're now, between now and the end of the week, certainly on all-time high watch. Opening bell, we'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Marley Caden, live from Chicago. We're tracking market movers, earnings reactions, and what traders are watching next. Stream Schwab Network live at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time.
Welcome back to Opening Bell. I want to count you down to the start of trading. Could we hit some records today even? Joining me here on set as we wait to see more action. Oil has now turned into the red, 91.25 the barrel. You have a 10-year bond yield of 4.27. And President Trump saying today it looks like they're going to be making a deal. They're back to Islamabad. Sam Vadas is with me. That's the plan, right?
Yeah.
Seems that's the plan. We'll see.
That's right. And what war? That seems to be the headline this morning coming through from the notes. Nicole, Denny saying so far as the stock market is concerned, the war is over until further notice, because obviously we are just an arm's length away now from an all-time high. Obviously we're within 1% now of the S&P 500, and we only need 11 points to get there this morning. So obviously we're looking at just some fractionally higher up arrows right now. The NASDAQ, remembering we've seen this longest winning streak since 2021. We've seen the Tran at a record. The dollar, not everyone's talking about that, but obviously we have seen that also giving up nearly all the gains since the war, near 6 weeks low as we get up and running this morning right now at 97.93 on the Dixie. It's back to where it was before the war started, after rising 3% on that relative safe haven bid that we've seen. And what does that mean? Well, international catching a bid as well. China became the latest overnight to actually recoup all of its war losses as well, getting back now to the pre-war levels today. Singapore and Taiwan had already managed to recoup the losses. Australia and Japan not far away. Europe is not far off from recovering losses either. In fact, the Stock 600 is just 2% away from recouping those losses, and that would also be an all-time high. So we are seeing very much internationally markets regaining some of the strength right now. There is a view, though, out there, I would point out, Nicole, that we may pause and sort of drift sideways in the short term. And that is because some of the traders have been pointing out to me that maybe things are looking a little bit stretched at this point. I know that a lot of the conversation in recent days has been around obviously a lack of positioning in this market. If you take a look at the semi-SOX index, up 30% from March 30th low in just 10 trading days, Nicole. But if you take a look at the RSI on the 7-day, for instance, 85, so very overbought. And so these are some of the things that traders have been pointing out as to why we might drift sideways for now. But yes, I mean, you continue to see these headlines about the fact that, according to reports, we're talking about perhaps more negotiations, the US and Iran potentially coming to the table once again. And so it feels like the US markets are very much holding on to that optimism that things are getting better and not worse.
And that has been the rhetoric from the Washington, administration, from Trump himself. He said, look, we were trying to do this quickly. We want to get out. And so we'll see whether or not he can actually have that execution at this moment. How about we take a look at Uber, which is spending on autonomous vehicles?
Yeah, $10 billion, according to the Financial Times this morning. This is the report coming through, Nicole. So it's going to be spending quite a hefty amount on thousands of autonomous vehicles and stakes in also their developers. So I believe it's 2.5 set aside for that, and then the rest on these autonomous vehicles. So the point of this article really points out that it's basically a shift away from the asset-light model now and the gig economy. And the aim is really to avoid disruption coming from the robo-taxis. We know that this is something that obviously Uber has been sort of trying to position itself in, the robo-taxi space. I mean, it's been investing heavily as well. Plans to launch services in 28 global cities by 2028. I mean, obviously it's been partnering up with other companies like Baidu, Rivian, and Lucid as well. So the FT very much points to more money that's going to be spent on this sort of more heavy asset type of business model. But speaking of investments, Nicole, the other story that's floating around Uber today is out of the information, because it seems like software development is becoming a very costly reality for these tech companies. Uber's CTO, so the executive at the helm of the technology, has reportedly said now that the company's AI spending is effectively blowing out the budget right now. So according to the information, the CTO is saying that the company's surging use of AI coding tools has maxed out its full-year AI budget. We're in April, Nicole, of 2026. And I think this is going to be really at the core of the debate moving forward when we're talking about these tech companies being CapExed up to the eyeballs, just how much they really have to spend on this stuff.
And we had today yet another story with Broadcom and Meta.
Right.
Every single day, there's more spending on AI, more gigawatts, more everything. To your point, thank you. Sam Badas, and we'll check out those banks after the earnings. The opening bell rings right now. Here we go. The S&P 500 is at 69.79. The all-time high is 7,002. So you can watch for that level. Right now, the S&P is up about 12 points. That's up about 0.2%. The Dow Jones Industrial Average up 168 points at 48,689. The tech-heavy Nasdaq up 21 points at 25,863. The small caps, the Russell, which has had a great run, is at 2707, gaining fractionally this morning. Oil and gold are both lower. I say oil is lower. I mean, I almost feel like in a moment we're going to get to an 8 handle. It's at $90.78 for the barrel. It's pretty unbelievable to see that when you think about it. It wasn't long ago we were closer to 120. Right, you remember that. In the meantime, a Bitcoin 74,455. We continue to take a look at some of the movers here. Earnings season. Diane King Hall is with me, and we take a look here at ASML in the pre-market. I did see that name to the downside. Diane, good morning.
Good morning. And it was bouncing around as investors tried to read the tea leaves on where to go next with this one. This may be a little bit of a case of buy the rumor, sell the news, because the annual forecast looked good. Now the second quarter forecast was a little soft, but if you look out further than that, it did look solid. And on a year-over-year basis, despite the downdraft that we're seeing today, the stock is up more than 100% on a year-over-year basis. In terms of the trailing quarter, when you convert it to dollars, ASML reporting earnings of $8.37 per share. That was better than expected. Revenue also topping expectations at a touch above $10.25 billion there. Again, converted to dollars. Revenue growth was up 13%, so you had some strength there. Gross margins 53%. So again, ASML really turning up the voltage when it comes to this AI boom in terms of their full year sales outlook. They're raising that as chip makers just move to add capacity. They now see 2026 net sales of between 36 to 40 billion euros. That's up from a prior range of 34 to 39 billion. Now, keep in mind, ASML is the only company making that advanced ultraviolet lithography machines. Those are needed to produce these cutting-edge chips that all these companies need as the AI arms race continues. The CEO saying, quote, "We expect, in fact, that the supply will not meet the demand for the foreseeable future." And that's been the question in this area. It's been more of a supply challenge than a demand challenge. So again, this is an upbeat annual forecast. Now, the second quarter forecast is a little soft at expectations of between 8.4 to 9 billion euros. So we're seeing shares shave off right now, real time, Nicole.
Yeah, and so look, the demand for chips outpacing supply, and that has been the story about AI. It's just demand, surging demand, and so that's why you continue to see all the spending that we've been seeing. How about Progressive earnings?
Progressive earnings. So Progressive has been something that's been in focus today. Let's take a look at where those shares are. I want to give a quick check on that ticker there. Pulling that one up right now. Sorry, a little slow on that one here. Shares are a little off right now off the back of those quarterly results for Progressive now in terms of their results today. Just catching up on that one. They did beat expectations. Earnings coming in at $4.96 per share. That beat estimates. Sales coming in at $20.9 billion. That was actually a miss there. So this is a mixed result here, and you can see in terms of investor reaction, they are trying to process that real time right now as shares fluctuate.
Nicole.
Yeah, understood. And you have another one?
Looking at Nike, so Nike shares right now a little bit higher at the moment. This as we see some insider buying, both Elliott Hill, Apple CEO Tim Cook moving on that one. High-profile insiders buying stock here. Shares rising right now as you see the bets increase here. Now this is it's been a rough year for Nike, but this is a vote of confidence from these key names here. Tim Cook buying about 25,000 shares. Elliott Hill buying a touch less than that, approaching 24,000 shares. Combined, the purchases total almost 2 million here. So this is the signal that leadership believes the stock is undervalued right now. It suggests that management sees better days ahead, especially after recent weakness. Nike, in this case, investors are looking for proof in the pudding that the turnaround is here, that Elliott Hill's plan to turn this around is coming to fruition quicker than expected. There has been concern around that, and that's why you've seen shares under pressure year to date, off just shy of 30% on a year-to-date basis, because some investors have said this turnaround is taking too long and haven't seen the momentum yet. So it's one to watch here, but you see some confidence at the moment, Nicole.
All right, and last but not least, we take a look at Cloudflare. I see they're trading higher.
Yep, it's got an upgrade here. So you got some conviction around this. Piper Sandler upgrading this to overweight from neutral. They've set a $222 price target from here. The analysts basically believing that the stock can outperform from here. They're turning bullish. They see Cloudflare being constructive in a few areas: cybersecurity, of course, cloud infrastructure, networking services, AI infrastructure, and edge computing. So AI matters here because they believe that Cloudflare will benefit from AI workloads, strong relationship with LLMs, fast networks, secure connection, distributed computing power. They think that it's a strong case for Cloudflare from here. The pullback recently, they believe, helps the stock. They see this as a good entry point. So you are seeing shares rise right now, 3.5%. So regaining some of the lost ground so far this year. On a year-over-year basis, obviously Cloudflare looks much better. Nicole.
All right, price target 222. It's at 186. That's a nice upside. Diane King Hall, great to see you.
Great to be with you.
Thank you so much.
You got it.
And folks, we'll continue to take a look at the big moves here in the market, the V-shaped recovery. 5 weeks of selling, then we were in correction territory, and now we're looking at the third week of gains. We are so close to record highs. Coming up next, our next guest calls a sentiment recession. What does that mean? Opening bell, we'll be right back.
While others recap the news, I help you read between the lines, from what's moving markets to what's next, with sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall, and connect with me on LinkedIn for more.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Welcome back to Opening Bell. I'm Nicole Petalides. We have the hustle and bustle here on Wall Street. Stocks are higher. The Dow's up 117 points. And we are seeing the NASDAQ, I'm looking at the S&P 500, whether or not it gets to that 7,000 mark, right? You're watching that for new highs. Joining me right now, Blake Millard is with us, Director of Investments at Sandbox Financial Partners. And we're looking at really a V-shaped recovery. It came pretty quickly after 5 weeks of selling, didn't it? Is that what you expected?
Yeah, good morning, Nicole. It's great to be here with you. Look, the bears had their chance to take control of this market, but they failed. Stocks have now fully recovered from the Iran conflict, with the S&P 500 erasing a near 10% correction. And now we're returning back to those old highs in late January, probing right there. So since the March 30 low, we are now higher by 600, almost 700 points. That's 10%. The market has once again shrugged off geopolitical risk and proven its resiliency in the process. So equities right now are acting as if the worst is over, helped by ongoing diplomacy talks seeking permanent peace in the region, as well as momentum heading into earnings season. This 2-week rally, 3-week rally for me is confirming that there's probably a durable low in place. We can see that with credit spreads tightening, the dollar collapsing a little bit, yields coming down, and those are important signals for risk assets. So we think the environment favors further upside in the back half of the year. But I think there's an important lesson here for investors at home, and that's while risks continually pop up under this administration and the current Iran conflict remains ongoing, and there's going to be more risks to overcome in the coming weeks and months, the reality is that staying invested, staying the course, remains the best option for most investors. So 2026 is just a reminder that periods of uncertainty, while they feel unpleasant, and they absolutely do, it's also when opportunities are the most attractive for long-term investors. So when markets experience volatility like this, driven by these geopolitical events, it's often the case that earnings expectations don't change as much as the stock prices. So really the bottom line lesson for me, for investors at home, is investors that are maintaining a long-term perspective, holding a balanced portfolio to navigate these difficult periods, can often be rewarded for their patience.
So let's talk about, I want to get to the opportunities and what your investment advice is for folks, because that's really important. But what's this sentiment recession? What does that mean?
Great question. So markets are soaring, and that's despite what we are calling a sentiment recession that are plaguing most Americans. So even though the economy is still growing and job layoffs remain low by historical standards, public confidence has collapsed. Consumer sentiment is near record lows. We can measure this. So last week, we got a preliminary reading from the April University of Michigan Consumer Sentiment Survey, and what it showed was the index has never been lower than where it is today. And this is data that has been consistently collected since 1978. So you're looking at almost 50 years, and think about everything that's transpired since 1978, literally everything under the sun. And the reality is that the data has never been lower. So there's this disconnect. There's this, the data and the moods don't really match. And especially when you consider that economic growth, like GDP, is still positive. But again, that Michigan survey shows that over 60% of Americans say the economy feels, quote, bad. And I think there's a couple reasons for this. It's the inflation stacking that we've seen over the last 5 or 6 years that's left permanent lasting scars. People don't feel inflation the way that we report and measure it. It's not just like a month-to-month reading. They see it as permanently higher prices when they're at the grocery store or when they're paying their insurance premiums. That inflation shock doesn't just go away because maybe one or two soft reports, in any given month.
Yeah.
I would also say that the job market isn't as strong as, beneath the surface as what the headline numbers might show. Hiring, we know, is slowed. We also know that firing is slowed, but the job growth is really concentrated in only a few sectors, which makes the economy feel worse than it really is. And the third point I would really make is politics. They're the amplifier in this disconnect. Obviously, this administration is pursuing this New World Order and these aggressive policies that they've rolled out over the last year and a half. And I think that is weighing on sentiment. So really, I would say that the stock market has held up, earnings have held up, but that strength isn't translating into how people feel in their day-to-day.
Yeah, Blake, let me ask you this. I mean, I know you like tech, small caps, and international. That's where you see opportunity for the next 6 to 12 months. What tech names do you like, or what kinds of tech?
Great question. So we view tech as always being a core holding. These are your secular growers with strong balance sheets, pricing powers, cash on their balance sheets, and they're in so many different lines of businesses. But I would say that investors should be discerning different areas of tech, because there are some real winners that have emerged in the last 6 months, and there are those that are lagging behind. And we know a lot of this. So, you know, if I had to pick the one important group of the market, it would be semiconductors. These are the companies that are the backbone of the modern economy and one of the best gauges for risk appetite. And these assets, these semiconductor chips, are absolutely printing right now, and they're, you know, touching new all-time highs. On the flip side, we know that software is historically oversold, and we're really almost past that cusp of like what I would characterize as seller's frenzy. That's just like indiscriminate selling. So I think positioning, you know, the amount of washout in sentiment, I think there's an opportunity here for some mean reversion. So, you know, if you have a little bit of patience, there are some real names there under the surface to go picking. So within tech, there's definitely different, there's this, you know, there's this change in path really underneath the surface between the hardware and the software.
Okay. Blake Millard, Sandbox Financial Partners. Thank you so much. It's great to see you, Blake. Thanks.
Great to see you.
Coming up, the key levels to watch here on Wall Street. Looking at the charts, right now we are getting closer to 7,000 on the S&P 500. 3 weeks in a row of gains for the Dow, the S&P, and the Nasdaq. Is that what we're going to see? It's only Wednesday. Let's see. Opening bell. We'll be right back.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
Hey, Pop.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to Opening Bell. It's time for our Market Meetup panel. Joining me right now, Alex Coffey and Kevin Hinks. And I was just taking a look. Obviously, the story from the banks has been a really good one. For example, Bank of America is around a 9-week high. It's gained 17% in a short period of time. Profit and revenue higher. Sales and trading were good. I will say that the Dow turned negative here. Caterpillar, Cisco, Chevron, Honeywell, Coca-Cola, JP Morgan are among the laggards. Alex, I'll start with you. Some of your thoughts on the market action.
Yeah, I thought earnings were going to be important this week, and so far, at least for financials, they've been really strong. Over an 80% beat rate with an aggregate earnings growth for the group so far of 18%. The average one-day price change for the sector is actually a positive number. It's a small one, but 0.5% higher for an average one-day price change is certainly notable. Now, you talked about banks, and while Morgan Stanley and Goldman aren't technically in the GICS banking subsector, they're in capital markets, the 6 bank stocks are actually lower by an average of 1.3%. So that's something to monitor. All in all, though, S&P 500 is through about 6% of stocks so far this season for the quarter, and the quarterly beat rate so far is 73% on an aggregate earnings growth of over 31%. Now, we expect that to come in as we get more and more of these stocks, but we're off to a really fast start here for earnings, and financials are a big part of that story.
Yeah, ASML is to the downside. We saw that sort of going back and forth a little bit. Tomorrow we'll have Taiwan Semi. I think that comes in the morning. Also Netflix, U.S. Bancorp, Citizens, Bank of New York, Mellon, KeyBank. So more earnings to come. Kevin Hinks, some of your thoughts this morning.
I think even though the S&P is showing a small gain on the day, the NASDAQ is showing a small gain on the day. Right now, 8 of the 11 sectors in the S&P are lower. Now, the good news is 2 of those sectors, information technology and consumer discretionary, 2 of the main sectors of the S&P 500 are higher, as well as Nicole, financials are higher today. Those are the 3 sectors in the S&P that are higher so far this morning. That said, this market looks a little hesitant as we reach towards that 7,000 level.
Yeah, I should also add, I mean, I saw the New York Empire manufacturing number that rose. We saw a pickup in April. That was really some optimism right there, too. For the most part, we are seeing some bright spots. Alex, your thoughts?
Yeah, Kevin mentioned 7,000, and you can't get that number out of your head, as that's basically the all-time high for the S&P 500 cash index on an intraday basis. Well, we're within here, within 1% for sure, probably closer to 0.5% of that mark. So it's not unreasonable to say, hey, we could be there today, end of the week, which is pretty incredible given all the headlines and all the uncertainty going on. Shows how resilient financial markets really are. For the NDX, not an all-time high since the end of October of last year. Well, it's just over 1% from that mark, so it's also made quite the comeback. But to me, what stands out the most is we are set to get many of these different tech names over the next coming weeks, is that you've seen a pretty substantial correction in valuations. I know Dan Ives has talked about this in many of his notes, but stocks can correct in a couple ways. And from an index level, valuations have corrected through time. We've kind of just gone sideways for the better part of the last 3, 4, 5 months. But for many of these tech names, mega caps in particular, but also the software stocks we've talked about, there has been a pretty substantial repricing, but all the while for many of these stocks, earnings estimates have remained robust, and in some cases even only gotten better.
Yeah, well, the final thought here really is how well we've been doing and how resilient the market is. Kevin, you want to give us a final thought?
Yeah, if you look at what's driving the market or holding the market here, it's what Alec just mentioned. It's software within information technology. Microsoft, Oracle, Palantir, Salesforce, AppLovin, Palo Alto Networks, Adobe, Intuit. all higher. That whole sector within the sector of information technology is strong in holding this market, bringing it up towards 7,000. It's amazing. You look at a visualization chart that looks fairly bleak, except for one big green section, and that is software. Nicole?
All right, and have we seen the bottom? That's the question. Some people say yes. All right, Alex Coffey, Kevin Hanks, thank you. Now we get to Kevin Green, who's taking a look here at our market action and the charts in particular. Senior markets correspondent Kevin Green, your thoughts?
Good morning, Nicole. Yeah, I mean, Alex and Kevin really kind of talked about this. That 7,000 level is going to be a key area of resistance, and that's where we are seeing the majority of the call flows this morning at that 7,000 level. So that's going to be the positive dealer area, or where we could maybe see some selling pressure taking place in the market. If we break down below that, looking at 69.60 as your first area of support, and then below that 69.20. The sell semiconductor buy software type of trade, or that pairs trade, is still in effect. It's just in reverse at this point. So Microsoft outperforming, Palantir doing a phenomenal job this morning as well. So keep your eye out on that. And financials are still holding up relatively well. Now, I will say, if you're kind of looking at the price action this morning, Nicole, a little bit more jitters when you look at the volume and the moves to the upside, both to the upside and downside, but a little bit more selling pressure once we get to that upper end of resistance, sitting around 69.90 here. So keep your eye out on this market. Volatility is relatively low. Credit spreads are also relatively low too, so that's also fueling this equity rally. And I think the headline risk is still a big one. We do have Israel coming out and stating that they are not having a ceasefire with Lebanon. That's another reason why we are seeing a lot of this volatility right now to start the day.
Kevin Green, great to see you. Thank you so much. And thank you, friends, for being with me here on Opening Bell. I'm Nicole Petalides every single day, 9 a.m. and 2 p.m. So I'll see you at 2 o'clock for the watch list. Join me then. Morning Trade Live with Sam Badas is next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Schwab Coaching is concepts brought to life in the real world.
Schwab Coaching is learning constantly.
It's relatable, it's practical,
clear, understandable,
and hopefully entertaining.
Take it for what it's worth, but I think it's absolutely world class.
Schwab Coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab Coaching is that clients get access to 9 different sets of expertise.
We want to engage with you and chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade. So we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We've got this ongoing 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really unique, not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Happy Wednesday, everybody. Hump Day. Welcome to Morning Trade Live. I'm Sam Bartis, live from the floor of the New York Stock Exchange. We've got plenty to hit on both here and abroad over the next hour. So here's a look at what is coming up. We will discuss the latest international news and impact of Iran negotiations, while also checking in on the latest Asprey 6 model metrics. And over the next hour, we'll take a closer look at the Bank of America and TSMC. Bank of America is up this morning after reporting earnings, and TSMC is up nearly 25% this year. Let's take a look at where markets stand around half an hour into trading. We are looking at more of a mixed picture today. We've got the S&P 500 managing to just hold on to some fractional gains there as we are within arm's length of this all-time high here at 69.80. The Nasdaq 100 putting on about 0.3% right now. Obviously, we have been looking at the Nasdaq's 10-day winning streak. That would take us back to 2021. Bit of softness in the Dow Jones this morning. We're down about 70 points or so. It does look like a few stocks are weighing on that particular index. So the Russell 2000 just fractionally higher today for us. We are seeing quite a sea of red, a big chunk of negativity across chips this morning. Software is gaining. We've got a mixed picture across our Mag 7 names today. But let's take a look at how foreign markets are faring at this juncture, because of course we have seen a nice rally out in Asia once again. The Nikkei 225 up around 0.5%. The Hang Seng Index up 0.3%. In fact, China becoming the latest Asian stock market to get back to its pre-war levels today, following Singapore and Taiwan. Europe is nearly there, not far off from recovering the losses. The FTSE right now, a cautious tone out there. We've got some positivity out in Germany, but you've got the Stock 600 just over 2% away, which could also be an all-time high from recouping those war losses. So continuing to watch that. We'll unpack that with AJ Kaling throughout the rest of the program. But let's take a look at some of these futures products as well. Very interesting moves in Treasury markets today. In fact, the 2-year Treasury yield falling below 375 this morning for the first time since the middle of March. So that's something to keep an eye on. We've got the 10-year right now yielding at 428. The US dollar has picked up some steam right now, but remembering the Dixie is pretty much back to where we saw before the war after rising 3% on that relative safe haven bid. So we have given up nearly all the gains since the war, tracking around 6-week lows today, but holding firm there just so slightly. Gold right now on the flat line, 48.50. Crude oil sitting at $91 a barrel, and that is very much what is helping buoy stocks this morning once again today, as it does remain off those triple digits, and Bitcoin is lower just fractionally there, 74,000 and change. It caught a bid yesterday as we did see riskier assets very much rallying in the session. So let's get out to Kevin Green with everything in mind that obviously we saw this morning, and then coming off this stunning rally yesterday. Obviously, we continue to track these Iran negotiations, and the latest obviously on these energy markets. It does look like they're going to get back to the negotiating table as far as the reporting is concerned, KG, at some stage this week. Just walk us through what you're seeing, the developments and the market impact.
Well, we continue to see this commentary around a ceasefire and the hopes that we will see a longer-term solution here in the coming days. Maybe could be hashed out, and that's why the markets continue to try to rally higher, and why you are seeing pressure on the energy sector as a whole here, especially when you're looking at crude oil. But we are seeing a little bit of interesting intraday trading today, this morning, as you kind of talked about, a lot of volatility in some respects in certain sectors here, and you are seeing some comments coming from Israel regarding their ceasefire with Lebanon. It seems like their security cabinet will be meeting and discussing those terms. And we'll see if that's going to move forward. If so, if it does, obviously that might put a little bit more pressure to the downside on the energy markets, and then also could lead us a little bit higher when it comes to equities. But if we do see any type of standoff, that's where we could see volatility coming back into this market. Now, if you're kind of looking at the energy complex as a whole, for crude oil, we've kind of talked about the $75 level as the key area of support. If we do see a breakdown, there's probably still still going to be an elevated price when it comes to oil, just because of the logistic headwinds that we have, as well as the production issues and the lack of inventory in certain parts of the market. So we have to be mindful of that. But this chart is actually very, very interesting. You'll hear me talk about this 3-2-1 crack spread. And basically, this red line that's on this chart just reflects the profitability or the assumed profitability of refiners. And it's actually a really key leading indicator when it comes to oil prices. You can see that we had a breakdown or a bearish divergence where that spread was moving lower, but energy prices or oil prices were moving higher. And now we are seeing that kind of correct itself. But what's also very interesting here, Sam, is we are actually starting to see that refining margin spread increasing here over the last couple of trading sessions, even though crude oil is moving to the downside. And the reason for that is because the byproducts themselves are not pulling back as aggressively as crude oil or the input itself. So that, once again, kind of is a little bit of a leading indicator. I don't think that we are still done with when it comes to oil itself. Maybe we come down, test that 50-day moving average. This still looks like an overall bullish trend, and it looks like we're trying to resolve some of this price momentum, the aggressive price momentum that we've seen over the last couple of weeks here. But margins and profitability are still at elevated levels, and that's really that line that energy traders really focus on, rather than just the outright price of the futures market.
Yeah, that's really interesting, actually, because it's not just oil itself, is it? I mean, it has expanded to other byproducts, as you say, and other commodities. I know you've been watching helium. You and I have discussed this before over the weeks, particularly as it pertains to, the potential for the impact on semiconductor chip capacity production as well. Just walk us through the latest on that.
Yeah, so I wrote about this in Market Minute this morning, so you guys can check that out. But you also saw a embargo, or basically an export ban from Russia when it comes to helium. Now, Russia, the United States, and Qatar are the three leading exporters of helium and producers of helium in the market. So Russia's going to cut off those exports. Outside of a few countries that are within Russia's control, they have a little bit of a conglomerate similar to what the EU is kind of represents. And so that's going to take the Russian flows out of the market. The Qatari flows are already out of the market because of a strike on a production facility. And then we also have the Strait of Hormuz that's restricting flows as well. Unfortunately, the United States is not going to be able to backfill the loss of that global supply, especially if Russia is going to uphold this export ban, which they believe they're going to be able to hold that until the end of 2027. That's going to push prices higher for helium. That's also going to create this synthetic demand in this market as well. Air Products and Chemicals, this is one of the companies that has exposure to the helium market when it comes to not only producing but also refining helium for export capabilities. You also have ExxonMobil, this city or this town in Wyoming, which produces around 20% of the global supply, now is going to be in focus. So Exxon also has some exposure there as well, and Linde as well. So those are the three companies, the major companies that have the helium exposure, but it doesn't seem like we are actually seeing an easing of these supply lines when it comes to this critical input, especially for semiconductors and healthcare devices here. And this is a stock that is kind of basing out and trying to break out above that $300 level. Keep your eye out on this one as well as the others. If this trend does continue, it definitely is going to be reflected within their revenue over the next couple of quarters because of their pricing power.
Okay, good to know. Go check it out and read KG's newsletter there. Let's switch gears to what's happening with the domestic data that we're seeing coming through, particularly from the housing market, and an update from NAHB, the index data there. Just walk us through the numbers and what that's showing.
So in the NAHB Housing Market Index, this is actually a survey of home builders, not purchasers, so we have to be mindful of that. But that came in at 34 for the diffusion index here, obviously in contraction territory if it's below that 50 line. Market was looking at 37 as the estimate of that number coming in, and that's lower than what we saw for last month at 38. This is the lowest print that we've seen since September of 2025, and kind of coincides with the heightened levels of interest rates, and also the fact that prices, even though they are coming down in some respects in certain markets, is still relatively elevated. That might be pushing off consumers on buying houses, and input costs over the next couple of months and quarters will go up, especially when you're looking at lumber as well as copper and other materials like concrete. That could also dampen demand and really put a little bit more of a pessimistic outlook for a lot of these home builders. This kind of also coincides with the earnings that we have already seen from some of these home builders. If you're looking at like a D.R. Horton or a KB Homes, their commentary as far as their guidance moving forward has been a little bit bleak because of the current macroeconomic environment.
Okay, good stuff. Good to get an update on the housing market there. KG, really appreciate it. Thanks so much for breaking down some of those movers in the market for us this morning and some of the developments we're tracking. Coming up, we will check in on the latest information from the Asprey 6 model. The latest EKG chart. Morning Trade Live is back after this.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Intern, this place is incredible.
It's where I get all your office supplies.
Your golf balls,
Your fancy coffee, your giant TV.
it's everything in one place. It's like
Schwab. Everything investors need, all in one place.
Come again?
Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between.
I think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
We're back on Morning Trade Live. Broadcom and Meta announced a multi-year strategic partnership to support Meta's artificial intelligence compute infrastructure. Building on their existing partnership, Broadcom will deliver technology supporting Meta Training and Inference Accelerator, or MTIA chips. Those chips will serve as the backbone for Meta's deployment of AI data centers as the two companies co-design and scale the hardware required to bring generative AI features and personal superintelligence to billions of people globally across apps like WhatsApp, Instagram, and Threads. So Meta is 1.5% higher at $672 and change right now. Let's take a look at some of the leaders on this session. This mixed day here for stocks. Datadog is higher by 7.5%. ServiceNow is up almost 7%. So softwares are once again rallying today. I believe this would be a third winning day for the IGV if it manages to keep it up. So Oracle is among those names as well. That's been in the headlines in the last few days as well with respect to its tie-ups and partnerships as well. 5.5% up, and the trade desks are up 5.8. So it is a nice day for some of our software names, which have been getting beaten down hard, particularly over the last few months or so. So a nice green day for them. And then on the other end of it, we've got some hardware names. In fact, this is where the big chunk of red is right now across our chip space. SanDisk and Seagate both down. That's, of course, in the memory space. And then Carrier Global's down 5.5. Lennox International down 6.6. So we are seeing very much some rotation, perhaps out of some of the hardwares into the softwares today as this inevitable game of ping pong continues within the technology space. So that's a quick snapshot of the winners and the losers on the session. Joining us now is John Kosar, Chief Market Strategist, Portfolio Manager at Asprey Research. John, great day to have you on when we're really just at an arm's length away from an all-time high here on the S&P 500. I mean, what a remarkable comeback since the pre-war levels that we've seen. And obviously the US markets have very much been leading the way as far as the recovery here. What are your charts showing you?
The charts are showing me that you really kind of need to keep your ear to the tracks right now. A lot of this has been driven by news coming out of the White House regarding the war. The past two big moves that we made, the one down at the bottom that we made on March the 30th, and then the one that we made over the April 7th and 8th period where we had the big gap higher, those were both messaging that was coming out of the White House. So trying to figure that out is virtually impossible. So what we try to do is watch the internals to show us kind of what the market's thinking. And one of the ways we do that is with the Asbury 6. The Asbury 6 are 6 metrics that we put together via quantitative backtesting to tell us what the market's thinking in several dimensions. So right now you see they're all green. We have the rate of change in the S&P 500, relative performance of stocks versus high yield bond prices, asset flows, volatility, trading volume, and market breadth. You can see that most of them turned. Those are the dates that are on those cells in that April 6th, 7th, and 8th period, which is when we got the last message from the White House that we weren't going to wipe out the entire country and we we're going to give them another 2 weeks, which actually is starting to run out. So right now, despite all of the fireworks, the market is internally healthy on a tactical basis.
Okay, so if the internals are holding up okay as far as the EKG chart for the market, and what does that tell you? What do you take away from that, John, when you look at those stats? I mean, is this time to increase or decrease exposure? Do you chase the momentum, as far as what to do next based on that data?
Data's been volatile, and we're up against the old highs that we made, up around 7,000. So for me, I don't know that I want to add a lot of exposure when we're going to have the 2 weeks are going to be running out here in a couple of days and we're up against the resistance area. I don't like to buy against resistance levels because your risk reward is upside down. I would rather wait till the breakout, or I'd rather wait till the market goes down to a support level where I've got some leverage. So the market's internally healthy on a short-term tactical basis, but again, we're up against the old highs, and we could be another tweet away from being 200 lower.
Yeah, I mean, obviously we've seen plenty of jawboning over the last 6 weeks or so in this market, but they seem to be taking comfort, investors, very much in the optimism around the fact that things aren't getting worse, at least with the ceasefire and things on the talks front. Just walk us through some of the sectors and what they're showing you right now, because no surprises there that obviously utilities and energy have been performing quite well, although not so much since we've seen the rest of the market outperforming here.
Yeah, that's kind of, for us, that's really where the opportunity has been. We have another model called the CEIF model, and it's an acronym, and it's based on sector rotation. So the top 3 sectors for us right now, you can see them across the top there. We have industrials and utilities and technology, XL, I, U, and K. Those are where the money is going according to our model, and where the money is coming from as it kind of rotates around those 11 sectors, which if you put them together, it's the S&P 500. It's coming from staples and healthcare, so coming from the defensive places. Ironically, just a few weeks ago, the market was going down. So in the first quarter, our CEIF model outperformed the S&P by 7%, with a 42% less drawdown than the S&P, which just means this is a good environment for sector rotation. We're getting some breakaway sectors. We had energy. We had industrials for a while since the end of last year, and utilities has been in there. So there have been some sectors that have been breaking away from the pack, so to speak, and that's created some opportunities.
I mean, as far as what you're seeing on the charts here, and given we've managed to recoup all the wars losses so far and then add some, I mean, does anything that you're seeing as far as the charts, John, suggest to you that we're sort of somewhat going back to that pre-war playbook that we came into 2026 with, or has something changed?
You know, that's really hard to say. The market can turn on a dime here. It's very much influenced by news, you know, by rhetoric. And so this is actually when we feel the safest, because all we're doing is we're following data. We're not trying to make a forecast. We're not trying to determine what the outcome of the war is going to be or what's going to happen with interest rates. We look at stuff like the VIX. The VIX tells us if the market is afraid or if the market's confident. So you can see on that chart from January 13th, the VIX was starting to rise on a very short-term tactical basis. The S&P stopped going up for a few weeks and then it rolled over. Now look what's happening. The VIX has dropped underneath the 21-day moving average as of the 1st of April. That was like one day off the bottom, and it's dropping still. So why the market has calmed down so much, I couldn't begin to tell you. I think that's an unknowable. The fact is, it is. The market's calming down. It's taken a sigh of relief for whatever reason. And as long as the VIX stays subdued like that, this little rally, well, it's actually a little rally in time. It's a large rally in terms of, you know, in terms of the magnitude. But as long as the VIX stays down, people stay calm, investors stay calm, you know, this rally can continue.
Keep calm and carry on. I mean, some would call it resilience or some would call it complacency, John. Who knows? But it's nothing short of notable and pretty remarkable what we've seen as far as this comeback. But thanks so much for breaking down all your charts today for us. John Kosar there, Chief Market Strategist at Portfolio Manager, Asprey Research. Coming up, we'll get a closer look at the big picture with the team over at Charles Schwab. Morning Trade Live. We'll be right back.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going?
First day, so.
Sometimes, you know.
Next. Try it again.
You could have done better.
Please.
Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network. We're back on Morning Trade Live. According to the Financial Times report, Uber is committing over $10 billion towards autonomous vehicles, including equity stakes and fleet investments, to stay competitive in the rise of robo-taxis through partnerships with multiple providers and planned launches in 2026. The strategy aims to secure long-term positioning through investments, though investments do depend on partnerships actually meeting deployment milestones. So that's the caveat here. But we are trading higher by almost 5% on Uber off the back of this report. $76 and change right now. So There's the chart for you. It's come a long way off the highs here, but it's clawing back some, as you can see. Welcome back to Morning Trade Live. It's time now for the big picture. So let's welcome in the team from Charles Schwab. We've got Nathan Peterson joining us today, Director of Derivatives Analysis. Nate, always nice to speak to you. And what a day. I mean, obviously, we're a whisker away from an all-time high here on the S&P 500. We've done a round trip since the start of the war. I mean, the NASDAQ's longest winning streak since 2021. But you know, we're a little bit mixed today. There is a view out there that the market will perhaps pause and drift short term. At least that's what I'm getting from some of the trading desks, because things are looking a bit stretched. What's your view?
Yeah, good morning, Sam. You know, certainly near term, I mean, we're overbought. If you look at like the NASDAQ 100, for example, we were below 30 on the RSI, the relative strength reading. That's your oversold metric. And within 10 trading days, we basically rallied up to our overbought level at 70. We're just right below there right now. But I think technically speaking, more importantly, is just the S&P 500 is basically between this 6,950 to 7K area. Its all-time high is about, what, 7,002, I believe. And so there were multiple, there's a lot of congestion, a lot of volume, weighted average price, so to speak, within this zone, this 50-point zone. So it'll be interesting to see, you know, it would make sense if we either pause here, and then I think it would be encouraging for the bulls to get perhaps some sideways consolidation to slightly down consolidation. That wouldn't be unusual, but if we do punch above that, that's going to be kind of interesting, because generally when you break above this kind of important resistance level, excuse me, and it's also there with the Russell 2000, it's right up against its all-time high as well. Then you get the technicians, they kind of have to shift their stance. You get perhaps short covering that can come into play. You get perhaps some performance chasing. They don't want to miss out on that. But, you know, Sam, what's obviously the driver behind this continues to be, yes, it's the earnings story, but a lot of that is driven by tech, the AI infrastructure play. All the money seemed to pour back into that. And why is it going there? Sam, you're talking about these announcements every day, be it Oracle and Bloom Energy and CoreWeave and Anthropic. These compute deals are just announced basically daily. So if you're trying to get a read on what's the state of the AI infrastructure build-out theme, look no further than the daily headlines that are coming out for these compute needs.
Speaking of that, we also had this report, we just mentioned Uber before coming to you, Nate, that the CTO, the executive who's in charge of the technology, basically saying, I mean, the AI investments, the spending that they're doing here on some of this software development is blowing out the budget, saying that they've pretty much spent everything in 2026 so far, and we're only in April. That is according to these reports. So it just goes to show how costly this reality is becoming for some of these tech companies. And I suppose that it provides a nice segue to what we're seeing in this market with regards to the IGV versus the semis today. Have you got any thoughts on that? Because obviously we've got a while to go. I mean, the IGV off the lows, we're sitting at, what, 81 right now. I believe we need to get back up to levels around 85 to prove that this is not a dead cat bounce here. But, I mean, it's been an interesting comeback story for some of these software stocks with no real, I guess, tangible catalyst that's been obvious, Nate.
Yeah, you're right. So number one, technicals, let's talk about that. On the IGV, what's so classic about this is that you get this support level around 77-ish, we'll call it, where this particular ETF, this software ETF, has bounced multiple times over the past 5 years. Then you get a breach. You get a breakdown, and we make new lows, which technically is bearish, but what happens? It's the same as getting a false breakout to the upside where you get kind of a head fake and then it comes back down. This appears to be a false breakdown or a bear trap, a little bit of a bear trap, if you will, where there's been a lot of shorts that have been leaning into the software space and saying, hey, since we're not going to have an answer about whether AI is going to disrupt software or not for several months or quarters, we can lean into this play. We get Adobe down to a 10 PE. We get Salesforce down to a 14 PE. And then you get a false breakout where it looks like technically the shorts are going to get rewarded and boom, it punches to the upside. Now, We'll see, to your point, how sustainable this is, but it looks to me like a false breakdown, which a little bit of a bear trap, which we could get some momentum. There's probably some fairly high short interest figures that have been circling this sector. But Sam, the other thing is when you're getting everything else in the market that is rallying in this 10-day rally that we've seen, the normal response is for investors to scour and look for, okay, what hasn't rallied? What is the relative low valuation? Look no further than software. That's another reason we're seeing money flow there.
Such an interesting point you make. Yeah, and I mean, speaking of a 10-day rally, I mean, look at NVIDIA, for instance, at 199 right now as well. I mean, what, 19% run from March 30 low as well. I mean, that's obviously been something to highlight too. I'm just wondering what the VIX is telling you right now, Nate.
Yeah, VIX looks really, but like the VIX is telling you that we basically, the war is all but done and that this price shock from oil prices is going to be, dare I say, transitory, or just it's going to be absorbed, and it's not going to really derail a lot of these, the strong fundamentals that are in place that are pushing this economy forward, this AI, secular growth story, et cetera. So yeah, the VIX around 17, when it was comfortably sitting in the low to mid 20s, just is signaling that at least anything can happen. By the way, Sam, we all know this. We don't know if we're going to get, a resolution, peace talks, de-escalation, opening of the strait. That we still have all those question marks. But the VIX is saying, oh, yeah, this is like basically, the tariff tantrum that we had last April, and everything's recovered. You look at the VIX term structure, it's only going out to, 21, 22-ish when you go out 4 to 6 months or so, not signaling much harm there. So anything can change. We'll have to continue to monitor what happens with these negotiation talks, should they occur here in the coming days. And then, Sam, of course, we got to watch the data. We need to get into late April, early May, and then begin to look at how some of this potential inflation shock translates into the economic reports.
Yeah, as Ed Yardeni wrote this morning, the stock market, as far as it's concerned, the war is over until further notice. So obviously, we will continue to watch the headlines coming through. Nate Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research. Thank you always for your time. Coming up, it's time for the Morning Trade. We'll take a closer look at the Bank of America, which reported earnings this morning. Morning Trade Live. We'll be right back.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
We're back on Morning Trade Live. Let's focus on Bank of America. Looking at this chart, down slightly for the year, but up close to 10% this month. It's a big week for bank earnings reports, and Bank of America was the latest to disclose their latest numbers this morning. So that is the focus of the Morning Trade. Joining us now for a closer look to dig into these earnings numbers is Marley Caden. What did we find out, Marley?
Good morning, Sam. Yeah, a good quarter for Bank of America, seeing a nice response in the markets as well. Their first quarter profits and revenue both rose more than expected, topped expectations, boosted by strength in sales and, of course, their trading revenues, like we saw with the other banks as well. For their EPS, earnings were up 17% year over year, came in at $1.11 per share. That was about 10 cents better than the estimates. Also marked the highest EPS for B of A in about 2 decades. For revenue, it was up more than 7% to $3.43 billion. That was better than expectations as well, boosted by higher trading revenue, fees from investment banking and asset management, and rising net interest income. Their equities business saw revenues soar 30% to $2.83 billion. That bested expectations and also helped their trading operations have its best quarter in 15 years. Much of that thanks to the recent volatility we've seen because of geopolitical tensions. Also, an easier regulatory environment boosted merger and acquisition activity, helped drive 21% increase in investment banking fees. Now, the second largest lender, that's B of A, saw their net interest income, which is the profitability metric for loan making, increase by 9% to $15.9 billion. That was also better than expectations there due to higher loan and deposit balances, fixed rate asset repricing, and of course, markets activity. Now, they previously had projected that their net interest income growth would be between 5 and 7% this year. They raised that guidance. They're now projecting it to between 6 and 8% due to the outperformance that they saw in the first quarter, Sam. Now, also in a sign that the bank's borrowers are not deteriorating, the firm posted $1.3 billion provision for credit losses in the quarter. That was lower than the expectations for what the year earlier period and about $190 million below the estimates. So overall, good for the borrowers there. The CEO, Brian Moynihan, came out and said, "We remain watchful of evolving risks. However, we saw healthy client activity, including solid consumer spending and stable asset quality, indicating a resilient American economy." However, like we saw with Goldman Sachs, they did see their fixed income revenue come in a little bit light. So this is the second bank that we've seen that for. The business generated about $3.5 billion in revenue, missed estimates by about $330 million. But this is now the second time we've seen that so far with the big bank reportings. Their net charge-off ratio, this is another important metric. This is the proportion of total loans that were deemed to be uncollectible, also improved by 6 basis points during the quarter to about 50 basis points. Consumer banking, global wealth divisions each gained about 20% also in net income. So overall, for B of A, if we're looking at the consumer from B of A's lens and any credit concerns, they aren't citing any. Of course, CEO Brian Moynihan saying they're watchful of risks, but not having any concerns here, which is a little bit different of a story when we started having these cockroach conversations last quarter about concerns in the credit space. B of A not citing any here, Sam.
Yeah, it's fascinating how this time around the banks have been so explicit in their exposure to private credit as well. But yeah, I mean, great breakdown. And it's interesting that they have talked about the resilience of the economy. So a good tone setter, you could say, for earnings season. Molly, thanks so much for that. I'll chat to you later. Let's trade this name now with Joe Tigay, portfolio manager of the Rational Equity Armor Fund. Joe, good morning to you. How would you approach an example trade for Bank of America?
Yeah, thank you, and good morning to you also. Yeah, I would just say this is a really great sign for the U.S. economy. Just some solid ground here. Obviously, we know the risks out there, but we are on solid ground. That's why we're seeing volatility being subdued here. We're seeing the VIX under 18. So, of course, people are a lot more comfortable, even though there's a lot of uncertainty, as we know, out there in the world. Great report, of course, for Bank of America. Great to see their liabilities are not going crazy, and of course they're seeing the consumer doing great too. So for me, rather than just jumping in and buying the stock here, I would look at a call spread here, looking into May. Just something simple, the 52.5, 57.5 call spread. It's very similar to a buy rate, except instead of owning the stock, I'll own this call. It allows me to get the exposure to Bank of America here with limited downside risk. Just looking at $2.33 turned into $5, of course. At the end of May, that would be fantastic, but it's already worth about $1.90, $1.80 right here for where it is right now with the stock.
Okay, trading higher by 2% right now, 54 bucks and change. Joe, thoughts on the overall market today? As of course we are within arm's length of this all-time high. Bit mixed, so some cautious optimism it seems, but nothing short of a pretty remarkable comeback here since pre-Iran war.
Yeah, it's been a remarkable comeback, and it's happening pretty broadly. Yesterday we saw the software stocks getting a really big bounce back. It's being broadly bought here. Some of the biggest losers are being bought back here. definitely a great sign for the markets. A new all-time high would be a fantastic sign. It would just be signal technically like we're ready to go here for the rest of the year. So I think the market's optimistic that things will be looking good for the rest of the year. Again, though, volatility, it can come back in a heartbeat. We know that. So I'm very glad that the market is here at these close to these all-time highs, but I'm ready for it to return to a low.
Great stuff, Joe. Always appreciate it. Thanks so much for joining us today. Joe Tigay, portfolio manager of the Rational Equity Arm of Fund. Coming up, we will take a closer look at the international headlines impacting global markets. Morning Trade Live will be right back.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning Movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Sam Vardas coming to you live from the New York Stock Exchange. It's time now to take a look at international stories impacting markets right now. So we're joined by AJ Kaling, who's the Director of International Trading, Charles Schwab. AJ, always nice to have you on the program. You know, U.S. markets have really been leading this recovery back to pre-war levels, but China joined the party today. I know Japan, Australia, and Europe are not far behind there. In a way, you can understand the U.S. because the story and the narrative here has been, hey, look, America perhaps is in better shape than maybe the Asian markets are concerned. Can you speak to what we've seen in these international markets?
Hey, Sam, good morning. Yeah, you know, it's been really interesting watching the past 6 weeks, you know, the stories play out in these Asian markets. While I mentioned it last time I was on, the Asian economies are structurally vulnerable to any oil shock, especially the one going on right now. But we haven't seen the Asian stock markets really pricing in a worst case scenario, at least not recently. You know, we go back to our, common sense here is that markets trade on expectations, not perhaps damage that is already done. So you saw it last night, the Kospi up about 3% in South Korea. The dire scenarios that had been talked about or possibly priced in early March of full strait closure or blockade, oil above 100, above that 120 level, just hasn't played out recently. Since late March and early April, we have seen kind of a controlled environment base case where we get intermittent ceasefires. Discussions are ongoing. I know possible in the next 36 hours or so here, partial energy flows. And I think it's interesting, the markets might be pricing in or perhaps even predicting some pressure from China and India to get a deal done here, or at least a ceasefire deal. And so we talk about how the markets are really trading on expectations. I think one thing we need to watch out for, and you may have reported on it yesterday, was the China export figures that came out here. Now, there was a wide range of probabilities or possibilities from economists, anywhere from growth of exports between 3% all the way up to 27%. The number came in at 2.5% growth, so significantly lower growth than expected for China exports. Might be something to watch out for, maybe giving us a little bit of signal about global demand in the wake of what's happened in the volatility of March. So something to watch out for. But so far, like I said, Asian stock markets at least are performing quite well.
Yeah, absolutely. I mean, some would argue it's seasonality. Some would argue that it's too early to tell if that is really a key indicator of a pullback in global demand here for China. But certainly an important metric to keep an eye on, Andrew. And I'm just wondering, as far as earnings are concerned, because now obviously the markets get to go back to fundamentals. We have seen those earnings revisions are coming in as far as the expectations higher in the US. But what about Asia? Because I'm thinking about Samsung, which has been giving out guidance this month, expecting a record. You've got TSMC that's going to be reporting tomorrow in a week where we've seen the TAIEX at a record thanks to that heavyweight. You mentioned South Korea. I'm looking at some of the earnings expectations here for that particular market, and I know that they've been climbing higher as well. Just give us a sense of where the fundamentals are expected to come in for some of these markets.
Yeah, Sam, I think that's really the story today or this whole week, is that the markets are excited to go back to looking towards the fundamentals. Not to say that that the conflict in the Middle East is over, but they're really turning their attention to earnings season. And when we come to some of the Asian economies, of course, very AI-driven, software, chip making, like you said. The discussion lately has been about the banks, at least in the U.S. And you take a look at the Goldman Sachs numbers, and you want to be cautious not to apply that broadly, because as we saw in terms of at least the trading across the trading desks with some of the other banks, the story didn't translate. Now, I bring this up because you saw ASML report earnings recently, and fantastic chip making tool earnings report there. Can that be applied to the things in Asia? We saw TSMC and perhaps Samsung. Maybe a little too early to tell, of course, but the markets are kind of pricing that in, as we saw with the rally, at least in the tech-heavy Kospi yesterday. So I think that there is an opportunity to be optimistic here as we go into this earnings season.
Oh, absolutely. So which market in the international sphere are you looking at right now, and which one is important to keep an eye on?
Well, we of course, the topic of the year, the past couple of years has been AI. Hong Kong has been an interesting story, specifically this first quarter in terms of their IPO growth. I want to make sure I get this right here. $14 billion US dollars of listings across 40 total listings in Hong Kong so far this year. Now, to put that in perspective, that's a 480% year-over-year increase and a 5-year high. So we're seeing a lot of spatial design, AI software firms coming public here, and energy storage as well. And the Hang Seng is kind of being compared to the Nasdaq in the internet days. However, these investors these days are looking for more deep tech stocks, and less, of course, consumer internet. Hong Kong can't compare to New York, though. I'm not trying to do that, of course, because when you see things like SpaceX and OpenAI come out possibly later this summer, those are going to dwarf the listings in Hong Kong. But from a pure valuation play, it is an attractive market for global investors right now.
Absolutely. I mean, relatively cheap, isn't it? And a good barometer of Chinese progress, particularly on AI with its so-called AI tigers. AJ, always a pleasure. Thanks so much for your international perspective for us today. AJ Kaling, Director of International Trading over at Charles Schwab. Coming up, it's time for Inside Out. We'll take a closer look at TSMC and bring you an example trade when Morning Trade Live returns.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, Powerful trading platforms and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
We're back on Morning Trade Live. TSMC reporting earnings tomorrow before the market opens. They're up over 140% year over year and 25% so far in 2026. It is a stunning chart, as you can see here, for Taiwan Semiconductor. These ADRs right now, and obviously, as I mentioned, hitting an all-time high over in Taiwan on the TAIEX, taking that index to a record this week. And this is on the insatiable demand that we've seen for AI and the chips that they produce. Obviously, a supplier to the likes of NVIDIA and Apple. So let's go inside out on TSMC. Joining us now is Eric Clark, portfolio manager of the Logo ETF. Eric, so nice of you to join us. So, I mean, you know, we do get clues about TSMC in those monthly numbers. So we could probably anticipate quite a solid quarter coming from this company when they report tomorrow. But what are your expectations?
Well, big picture, I think, is the most important thing. You know, every quarter, there's always noise, but we expect great things from TSM for many years to come. I mean, they're at the center of so many different important trends that any noise through a quarter that provides some weakness is just a good buying opportunity. And we felt that way for 3 or 4 years now.
Yeah, I mean, you can see it on the chart. What metric will be key to hone in on tomorrow?
Well, we want to see the CapEx guide. They already gave $200 billion, so I don't know that there's going to be big changes there. We want to see the capacity constraints, and obviously the AI part of the business is what's driving it. Other devices might be a little bit sluggish, but the AI is really the story. And as agentic AI gets underway and starts really gathering momentum, that's going to drive more need for compute.
You like the PE multiples here, currently trading at attractive levels, you say, relative to historical cycles that we've seen. You say that you've got a high conviction buy on this name. I'm wondering, just as far as what else you said here, which I found really fascinating, the surge in AI demand is currently decoupling TSMC's performance from traditional cycles of smartphones and consumer electronics. What do you mean by that?
Well, we know that semiconductors historically have been very cyclical, and there's still some of that cyclicality. But the AI story, remember, it's AI, computing power, and energy demand. And the energy demand is a real bottleneck. And so this cycle is going to last a lot longer than people think. And that leads to really good returns for things like Broadcom and NVIDIA and TSM, and TSM's obviously the cheapest. And none of the other brands can do what they do without TSM.
Understood. Very, very quick one. Just if I can get your thoughts on what it's going to mean. I mean, you mentioned NVIDIA, Broadcom for the rest of the space as far as a tone setter this earnings season.
Well, I think it's just more of the same. I mean, for a while, tech was under pressure because of AI and some of the disruption, but the infrastructure layer of AI has been pretty stable and predictable. And, even NVIDIA took a little took a little consolidation break and is now breaking out to all-time highs. Broadcom the same, TSM the same. So we love that trio for the AI infrastructure layer for sure.
Understood. Looking for that confirmation come tomorrow morning. Eric, thanks so much for the preview. Really appreciate it. Eric Clark there, portfolio manager of the Logo ETF. Let's trade TSMC now with Tom White, host of Fast Market. Good morning, Tom. Just walk us through an example trade for TSM.
Yeah, it's been a spectacular run here for TSM. Just a couple percent off of those all-time highs that we recently hit, up about 25% so far this year, 145% over the last 12 months. So it's had a great run. The option market's only pricing in about a plus or minus 4% move in the stock. Now, remember, TSM reports monthly data points as far as sales goes, so maybe a little less implied volatility than some other names going into an earnings event like this. So you got to take that into consideration. So I looked at a strategy, kind of sets up with your guest outlook here. If you think this stock's going to go higher, let's create an option strategy that takes advantage of that over the next couple of days if it's positive earnings. So went out to the April 17th monthly options. They expire in just 2 days. This is an earnings type example trade here. And we're going to buy the slightly in the money 377.5 strike call. That's the bullish portion of this strategy. And then against it, we're going to go about that one standard deviation move that the option market's priced in until the end of the week. We're going to sell the 395 call against it. So if you take a look at this, this is a $17.5 wide bullish call vertical. It sets up with that one standard deviation move that the option market's pricing into the upside. On this $17.5 wide bullish call vertical, you're paying roughly about a $6 debit. Might be a little bit higher than that right now. The stock continues to move higher. But that debit you pay is going to be your risk. So if you pay $600 in risk, that can expand to $15 or $17.5. So pretty good risk reward setup on it. The key here is the break even on this one, 383.50 over the next 2 days. That's only about 1% above the current share price in TSM. So well within that one standard deviation. And because you're buying a directional vertical like this, it gives you some flexibility as far as closing it or managing this position. You don't have to wait 2 days to get out of it. If you get the move that you want above that break even of 383.50, you can start closing all or a portion of your trade prior to expiration on Friday's close. So this is a bullish trade, taking advantage of maybe lower implied volatility, but you definitely need to move to the upside. But on a percentage basis, only about 1% to get above that break even.
All right, we are trading around the flat line right now, looking for some direction from those all-important numbers tomorrow. Thanks so much for the preview and the example trade, Tom White. And checking in on these markets, we are a whisker away from an all-time high here on the S&P 500. It's a nice day for Broadcom. It's a nice day for some of the softwares, not so much for memory. We are looking at a bit of a mixed picture across our major averages. The Dow Jones slipping a bit, so a little bit of cautious optimism in these markets. We'll continue to track the action throughout the course of the day. Thanks so much for joining us here on Morning Trade Live. I'm Sam Vardas. Download the Schwab Network app, available in the Apple App Store. Tune in 24/7 on schwabnetwork.com. Trading 360 with Marley up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
We're 90 minutes into the trading day. Welcome to Trading 360. I'm Marley Caden coming to you live from our Chicago headquarters. Here's what we have coming up for you in today's show. In our 360 Spotlight, we'll take a look at the struggles that could continue with everything happening with the Strait of Hormuz, how that closure will impact businesses, and how consumers could be affected. Then in our Disruptor segment, Kevin Green will join us to take us through a note from KeyBank that lowers the price target on Zscaler, citing geopolitical uncertainty and AI pressure while still maintaining a bullish tone. Then finally, in our 360 round, we'll go through the latest financials from ASML this morning. They had their earnings overnight. The chip manufacturer beat on both the top and the bottom lines, raised guidance for next quarter, but is still moving lower. We'll tell you why. But let's take a look at how the markets are faring as we're into the trading day now, about 90 minutes. And the S&P 500 trading up about 0.33%, close to 7,000 here. We're about a stone's throw away from that record high. The NASDAQ at 26,003 right now. That is up 0.6%. On the Dow, we are down ever so slightly, about 0.4 down at 48,334. Shed about 200 points so far today. And the Russell 2K 2707 right now. That is up marginally. The 10-year just a little bit higher, but still below 4.3. We're at 4.28 right now. The dollar at 97.88. It's mostly unchanged. For gold, slightly lower, 48.3740 a troy ounce right now. Crude oil at 92.38 a barrel. That is up slightly, but well off those $100 levels we've seen. And Bitcoin still range bound, 74,250. I do want to bring in Alex Coffey, our senior equities contributor here on the network, to take a look at some of the big headlines this morning. Stocks on the move. We've got two big names on the move, Broadcom and Meta today, continuing to expand their partnership.
Yeah, two tech heavyweights pairing up again here. Meta and Broadcom deepening their multi-billion-dollar custom AI chip partnership, Marley, focusing on powering Meta's training and inference infrastructure. This agreement includes an initial commitment exceeding 1 gigawatt of computing capacity, with multi-gigawatt expansion planned over time. This partnership supports the training and inference accelerator chips that Meta has been focused on. It's a key part of their push to lower those AI costs and reduce reliance on both NVIDIA as well as AMD. As part of this announcement, there was also an announcement that Broadcom's CEO, Hock Tan, will step off Meta's board at the end of his term and transition more into an advisory role. Makes sense as they're deepening their partnership. Don't want those kind of cause for concerns and potential headlines out there. Beyond that, Meta framed the deal as foundational to building the massive computing backbone needed to scale AI across billions of users. The market reaction, pretty positive. You see an up 3.5% move here in Broadcom. You see when that happened in pre-market. It's basically held those gains. Now, Meta up as well, a little bit more modestly, up about half that much, about 1.75%, 2% last I saw. So all in all, Meta doubling down on this custom silicone process as it scales its AI, and you look at Broadcom there to reap the benefits as one of these hyperscaler suppliers for these custom chips and more.
Yeah, and I'm certainly not the first name we've seen Broadcom popping on headlines. They've had many partnerships, but Alex, whenever we get these partnerships, we tend to get some commentary on who we think the beneficiary might be or which name the analysts are mentioning more in their commentary. Does there seem to be a winner here in this Meta Broadcom pairing?
Yeah, clearly. I mean, this is business one for Broadcom, so most of the analysts reporting on this or covering this looked at it that way, but this also does quell some of those concerns for Meta on actually getting this project done. That said, Bloomberg talking about this expanded deal, providing what they frame as rare multi-year AI visibility through 2029, which is longer than the market had assumed for Broadcom. They say it reinforces their position not only just in silicon from a custom basis and networking, or including custom silicon and networking, not just chip design. Harlan Sur over at JP Morgan, overweight $500 price target, strong confidence in a multi-year revenue ramp tied to Meta. And then Citi's analyst covering this, also a buy $475 price target, says that the partnership provides supply assurance and extended visibility. So that's the key takeaway is, hey, there's a lot of uncertainty, but less and less for Broadcom as we're talking 2029, 2030, depending on some of these deals. That's a lot of visibility that a lot of companies can't say they have.
Yeah, certainly a half decade isn't going to hurt anybody. Alex, thanks for breaking that down for us, that move higher in both Broadcom and Meta on that expanded partnership. I do want to welcome in our next guest, though, joining us this morning, Jim Iuorio from JI Financial Strategies. Jim, great to have you back on the show. I'm so glad we have you today with the setup that we have in the market. You know, we're within shouting distance of a new all-time high on the S&P, and yet we're still technically at war with another country. So I can't wait to hear your take on how we got here.
So there's something that I don't think people are talking about quite enough, and that's, let's rewind the tape 2 weeks and the situation we were in then. Crude oil prices were high, and that was bad. But the worst part of it is that we believed that the labor market was totally deteriorating, which brought up the word stagflation. Now, if it's stagflation, the Fed is painted into a corner. They can't ease to handle the labor market because of the inflation from crude, and they can't hike for crude because of the labor market. Now, so then let's look at the April 3rd unemployment numbers that came out. They came out fairly blockbuster at 178,000 gains. So maybe the market is not as concerned about that wicked stagflation as they were before, and they can look at the oil market and say, I think the economy is strong enough to handle this. Now, there's a lot of things that can come into conflict with that. If we have some data points that show we are deteriorating, the Atlanta Fed GDP now is 1 point something, not very big. So it does seem like we're not completely out of the woods. Now then you take the oil piece, which has gone down from 105 on Sunday night to 92 right now, which is a very significant support level, by the way, too. But it is kind of signaling to us that the market believes that the worst of this is behind you. And one thing I encourage everybody to do is, you can hear a million different analysts talking about what's going on in Iran. Most all of them have some sort of bias. The only true signal is price. And right now that price is pretty enthusiastic.
So, Jim, if we're not, I know last time we talked about stagflation. That was one of the conversations that we had. If one of the legs is standing firm, the other one that we have to be concerned about here, obviously, is inflation. Yes, oil prices are down right now, but do we have to be concerned about the path forward there and an uptick in inflation going forward, which, you can only stand on one leg for so long?
Yes. So the one thing about inflation and oil is that there is no question that for the first 6 months of an oil shock, that oil translates right one for one into inflation. Beyond that, it starts to become disinflationary because it starts to become such a tailwind for a recession, a headwind for the economy, that things start to deteriorate. Now, we're only 2 months into it, so I don't think it's a huge deal yet. I think the market, and not that the war is not a huge deal, don't get me wrong, that is obviously a huge deal, but the market's saying the disruption right now isn't that huge a deal. And I will say that the latest development of blocking the ports in Iran and trying to keep the straits open seems to be being blessed by the market as working.
It certainly is. I'm going to throw out a word here that I know will make you laugh because I've seen you laugh at it before. Are you saying this is transitory, Jim?
I am saying it's transitory. And everyone who's watched this and doesn't know what we're referring to, which is probably 1% of the people, transitory was the word that got us in an awful lot of trouble in 2021, where Jay Powell believed the inflation was transitory. But when you see the CPI number comes out at 3.3, the PPI number comes out at 4%. Now, those are the first two inflation data points that encompass the rise in crude oil prices. And the market rallied off both of those. The market definitely believes it's transitory, which is far more important than Jim Uriel believing it's transitory, but I do as well.
So then what's your outlook for the Fed, Jim? Because we got, Bessent coming out with sort of not a change of course, but a different tone than normal, saying wait and see was okay, not pushing for rate cuts, saying they were still coming, but just they didn't have to be right now. Then we got Cleveland Fed President Hammack this morning saying we're good for a while on any change in the rates. Do we have to be higher for longer for the Fed for a bit to see how much inflation is actually going to tick upwards? What do you project for the year?
Every part of that, when I hear anyone from the Fed speak, it sounds to me that they're very, very gently saying, yeah, our hands are tied and we're painted into a corner. That's what I'm hearing from them. Here's my base case. I believe in the oil market. I believe the oil market is telling me that things are happening. If oil settles below 92 and then heads lower, that'll be an even stronger signal. I know some people might think it's odd that I take the news signals from the price, but I do. Then I'll think this thing is winding up, and it will be. And again, President Trump said this morning, which I don't put too much credence in it, that he thinks it's winding up very, very quickly too. And I don't think that that's very important because he obviously has a history of being somewhat hyperbolic. But I do think the market is telling us that it is going to be winding up soon. And if 2 weeks oil's back in the low 80s, I think the Fed's back on the table for eases toward the end of the year, and I still think there will be eases before December.
And Jim, you mentioned there that you stay focused on the price, try to drown out the headlines here, and you said something really interesting in the note you sent over. You said that if you parsed every headline out of Tehran, it would, quote, get you killed as a trader. So how do you filter signal from noise right now?
So I do watch, and again, when I say, oh, I don't look at the news, I look at the price, I'm lying a little bit because, of course, I look at the news. I think that 30 to 40% of my trading is based on fundamental analysis, but it will make you crazy. In this particular instance, I think it's more so because it's so politically charged. So and again, I like to stay away from politics. I care very much about policy, but right now the transmission mechanism of the actual news, I think, is being kind of clouded. So that's why right now I think the only thing we have is the signal that you get from the price, which isn't always the case. I think it's usually blended, the price versus the news. But this time I'm getting tired of the news always being in one direction.
So, Jim, I'm going to jump backwards here a little bit. You mentioned sort of quietly that we were approaching a very important level for oil. Right now, we're about 92.70-ish and 71. You said 92.50 is a key level here. Why are you watching that level specifically?
It's an old low from a bit ago, a couple of weeks ago, and it really we rejected it at that level, and I think it's significant right now because of that too. And again, a lot of people think that technical analysis is some sort of voodoo and lines on a chart. It's not. It really is a measure of sentiment and momentum. And if the sentiment drives the market down below that level, I think that it could be significant.
All right, so we're running tight on time here. So what's the most important level or data print or earnings that you are keeping the closest eye on to determine where we might go from here in the coming weeks, Jim?
It's still oil. Earnings are important, but I do think I want to see 80 handle on oil. And I believe we will see an 80 handle on oil in the next 2 weeks. But that doesn't mean I jump on the trade yet. If I believe that, I think at the same time, the equities will take out their old highs. I'm speaking to the S&Ps. And then I think it'll be a game on. We always thought that 2026 was going to be tumultuous at unfilteredinvestor.com and at JI Financial Strategies because it's a midterm election year. Also, it's a fourth year following 3 straight 20-plus year gains in the S&Ps. Those always indicate some tumult. I believe we've seen it already, and if we get those things to fall into place, I believe it's over.
Jim, always a pleasure to talk to you. Love having you on this show. Look forward to our next chat, but we have to leave it there. Jim Uriel, CEO at JI Financial Strategies, and we've got a lot more for you today. Next, of course, the big three is coming your way. We've got 3 stocks, 3 charts, and 3 trades. Rick Ducat will be taking us through the technicals. Don Kaufman is joining us to take us through his trades for Target, the VIX, and Home Depot. That's next on Trading 360 on Schwab Network.
most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
She looks like you, Dad.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got 3 stocks, 3 charts, 3 trades for you. Rick Ducat, of course, will take us through the charts as usual. Here to take us through the trades, Don Kaufman, the co-founder at Theo Trade. Don, great to have you back on the show. You know, I'll start with basically the same question I asked my last guest because I can't wait to hear your take on this. You know, we're approaching another all-time high on the S&P here. We don't have any more resolution in the conflict in Iran than last I spoke to you. What's going on?
Right now, it's tech. Tech is back and back in a very, very big way. I mean, even if you're looking at the advanced decline line in the last couple of trading sessions, it's tech. I mean, we've seen a 50-50 advanced decline line like in the S&P 500, maybe 60-40 at most in like the S&P 100. But yeah, this is a story of all of a sudden we are back in the bid. But it's Amazon, it's Broadcom, and those Nvidia. Those are the stocks that are actually really behind this rally, along with a little Microsoft, which has really been beaten down badly recently.
Yeah, it certainly has. Your first pick of the big three, though, not in tech at all. We're in retail here, talking about Target. Target's had a pretty good year so far, despite a mixed market. Take us through your play on Target here, Don.
Yeah, I prefer not to jump on the tech bandwagon because that rally right now might be a little bit long in the tooth. So instead, I'm going to go over to what is much more of a cyclical trade. The reason I'm looking at Target is right now, Target could be under a degree of pressure right now, right? So looks like it kind of be in a topping formation. Of course, we're going to have Rick look at that in just a moment. But consumer staples, okay, that trade has been very, very defensive in the midst of some of the geopolitical risk. And I would anticipate a little bit more sell-side activity coming into some of these consumer staple names, specifically like Walmart, which we've seen. Target, of course, would be on the dance floor for this as well. And that's exactly why I'm taking not a huge bearish position, just a bit of a bearish position, looking for kind of a pullback here in the near term. As again, you look at the advanced decline line right now and you're seeing, again, it's a very split marketplace. Places that were defensive like Target still backing off. So my trade is the May 8th expiration. I'm just going to buy the 120 puts and sell the 116 puts against them. This one's done for a $1.55 debit. So I'm paying $1.55 for a $4 wide spread, nice defined risk trade. Looking for, again, I'm not like outwardly bearish in Target. I just think that some of this rotation, some of this defensive rotation, we're going to back away from it as some of the geopolitical risks simmer.
All right, Rick, so as we look at the technical setup on Target, are you also seeing the potential for a pullback here in this name?
I could see the thinking behind that, to be sure. What we have here with this chart was a high that was established near 126. From there, you could draw a lower high. You could connect those here, and then you could also draw a line connecting these higher lows to give you this more triangular type shape here. So what we have is price kind of bouncing around into increasingly narrowing ranges here. Low volatility can often be the precursor then to subsequent high volatility. So I would notice as well that while we have had a nice couple of sessions here, we have not really tested our old high point here near around 124. So some levels to watch out for would be the low point here, 117, as well as the lows here near 113. Finally, old highs, subsequent lows near 111. The trade in question too would be roughly looking for price to kind of break a bit lower here. Break even would be roughly around kind of the worst close that we saw from a few sessions ago here. So if we were to explore our moving averages next year that we follow, we can see that our price activity has crossed above our two shorter term moving averages, our 5-day in dark blue, our 21-day in teal. Those come in roughly around 120, 121 or so. So those could be an area to watch out for if we do start to pull back for potential stabilization or further breakdown. So RSI, our measure of momentum, also is exhibiting a bit of a decline here. We're not really seeing it keeping its strength as you would hope if you were bullish here. We are still in bullish territory, though, above that 50 midline, but kind of a matching trajectory here as our price activity. You could draw that kind of symmetrical triangle shape once again. So when we do finally look at our volume profile study to assess the heavy trading concentration areas, there is a node that stands out down here near about 115 or so. Things do start to drop off pretty significantly around 121 as well. Beyond that, a large gulf here until we get to about 104, 103 roughly.
All right now target a little bit north of 122, trading up 2% higher after Morgan Stanley reiterated its overweight rating and its bullish nature on its turnaround story here. But your next one, Don, not one you've brought to us before, or anyone I don't think since I've been doing the Big Three. You're going to trade the VIX.
Yeah, so there's a couple of different ways to look at this next VIX trade, and of course some of the technicals might not play too nicely with what Rick is going to look like in a minute here. But let's talk a little bit about the VIX. Okay, one of two ways you can think about this. You can think about buying a VIX spread as an aggressive bearish trade, but that's really not the intent over here. I think that there's a lot of people that are looking at this rally that might be involved in this rally, but they're nervous, and rightfully so, because could geopolitical risk come out of left field again? Although, yes, I think that there's a lower probability of that occurrence happening, but it's still a real risk. And one of the things that's just seldom explained is that, in the professional trading world, we hedge. And what does a hedge mean? Well, that's exactly what this style of VIX position is. And I wanted to bring that to everybody specifically today because this is how we hedge what we term tail risk. Tail risk is the idea that maybe the S&Ps turn back around and sell off dramatically. As I said, I think that that's probably a much lower probability, but well, we can actually reduce some of that risk. With this VIX trade, I'm going out to the May 19th expiration, so it's relatively short term. I am buying a 25 call. So that implies the VIX got to get above 25 just for this thing to get rocking, and then I'm selling a 35 call against it. So it gives us a full $10 of protection. So one contract on that could be worth as much as, of course, $1,000. This one's done, though, for a 60-cent debit. And the reason I bring up the debit there of 60 cents is it's kind of a nominal fee to pay to reduce risk between now and May 19th. And literally every 60 cents you pay gets you basically what, $9.40 of downside protection should the marketplace, all of a sudden volatility take off back to the upside and the marketplace sells off. You've got yourself a degree of protection. Again, this to me is much more about hedging some of that tail risk at a relatively reduced price.
All right, so Rick, as you're looking at the VIX, I know Don flagged there that you might not be in agreement with him as you look at the technicals. So point out what you agree with and what you don't agree with from a technical perspective.
Well, first of all, I can certainly see the thinking. I mean, you want to have your umbrella before it starts storming. It's kind of too late once it happens here. But just kind of a general comment, technical analysis on the VIX is kind of a gray area here. What you're looking at with the VIX is not the price of a tradable product. It's the reflection of the premiums on S&P options here. So some of our conventional methods maybe don't make quite as much sense to apply here, but we can still look for notable price extreme points here. For example, the highs here, 22.17, another notable low here near 24.34. That's around where the 25 mark would come in, where we would need to push above for the trade to start to pan out here. But now the thing I noticed too is we're starting to get to these more low extremes here, 1750, 1675, 1530 here. A reading of 15, 16 on the VIX is usually fairly low here. So if it's kind of notable idea to think about when volatility does get low. It can be a time to establish some potential bullish position, bullish from the perspective of it going up here, while it's relatively cheap here. So again, not really going to use our moving averages or RSI on this particular product. I'm going to cheat a little bit here too and look at VIX futures here, because this does have volume here. So we can look at where we do have notable volume on these VIX futures. Notice as well too, this gap to the upside is based on a contract change event. It's not a huge spike in volatility, but we can see that most recently we did hit our point of control on these futures near about 1860 here. So I thought that was kind of interesting here. We're kind of pushing into the lighter volume area, the less heavily traded area, and things do start to pick up pretty notably again around that same area. Don and I were discussing earlier, kind of that 24, 25 area is where we see a bit of a spike in activity here. So if we do start to push above that level, you could see very fast moving prices. The times when volatility is spiking is the time when things are most uncertain, and you can get those kind of runaway moves to the upside.
All right, right now the VIX is holding at 18, but I mean, just a week ago we were right at those levels you're talking about, that 25-ish level there. Now, Don, your last one, we're going back to another retailer here, a more beleaguered one, Home Depot. Take us through this one.
Yeah, Home Depot in a very solid downtrend. Just recently got a little bit of a bid back under it, but I think this meaningful downtrend is likely to continue to play out. We still have relatively higher rates. Look, the rally that you're seeing in the marketplace right now is clearly not taking place everywhere. As I said, this is a tech rally, and Home Depot is just simply not part of that right now. So I do believe it's going to continue a degree of its downtrend here in the near term, and I'm actually going to take advantage of that. And the way I'm going to take advantage of that, though, I am going to go out in time and use a nice big spread. And when I say that, again, I cannot stress enough, with Home Depot, and to get very, very specific in here, this is a large spread, a $10 wide spread. It's an out-of-the-money spread, and I'm doing a June 18th expiration. So that when I say it's in a meaningful downtrend, it's going to continue. In the near term, that downtrend starts to continue, but I'm using just the last few days, this very small up move, to make that like kind of perfect entry, if you will, for this kind of downtrend. This trade happens to be, as I said, the June 18th expiration. I'm buying the 330 puts and I'm selling the 320 puts against it. It is a $3 debit. So we effectively have $3 at risk, okay, for a $10 wide spread. So the $7 of upside, but you need, again, a fairly dramatic move to the downside, which, look, we've already seen, as I said, a meaningful move to the downside. It's just, will this be a continuation pattern?
All right, so as we look at Home Depot and the technical setup here, I mean, I can see we did have that meaningful move to the downside, but as Don mentioned, we have been moving higher of late.
Yes, we have had a collapse to the downside here after our earnings event, but we do seem to have stabilized for now around 320, roughly our lower green line there. We had a gap in this area between 325 to 329 or so. Now the short-term high point seems to have come in near 343 based on yesterday's session. We also can see that there was a low point, then high points around 348, 350 or so. So if we do start to move lower, look for a breakdown below our short-term trend line that's been established so far during our past couple weeks of trading here. So our moving average picture shows that we are starting to trail off a little bit here. Our 5-day blue EMA here is starting to flatten out a little bit. It has been supportive for now still, but we have our 5-day and 21-day lining up very closely with that trend line near about 337, 338 or so. So this gives us a notable confluence point to watch out for a potential breakdown area here. So when our moving averages start to change their slope, when they start to become more sideways, when they start to especially shift from an upward trajectory to a downward trajectory, those are signs of potential trend change to be on the lookout for. RSI also giving us more of a bearish signal in this case here. We did have a little bit of bullish divergence here in that price was making lower closes, but RSI was trending upward here. But now we're starting to drift back below that 50 midline once more, which is more of a bearish take on the situation. So volume profile, not super helpful as it can be when there's very clear nodes here. What we have rather is a very large concentration of trading that takes place between 346 to about 382. There are some notable spikes in this area around like 355, 360 or so, but we're in more of a lower activity area here. So look for that 350 area roughly to be more of a potential resistance point to keep track of.
And even with that descent that we saw off of earnings, as I'm just taking a look at some of their performance year to date, we are only off the flat line about 2% for Home Depot. So not a catastrophic year. But Don, I want to thank you for being with us for Big Three today, for bringing those picks to us, names we haven't talked about in a while. Don Kaufman, co-founder of Theo Trade, and of course Rick Ducat, our lead market technician, for breaking down the technicals for us. Coming up next, we are going to spotlight the supply chain, how businesses should be adjusting their strategies amid the closure of the Strait of Hormuz, and how it may affect consumers. Stay with us.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
My man. Hey! Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning Movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Schwab Coaching is concepts brought to life in the real world.
It's absolutely world class. We have coaches who have been in the industry and around the industry for a long time.
We have different formats because people learn differently at different times.
We have webcasts running through YouTube all day, every trading day.
We've got events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
How incredible is that? And it's free.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight supply chains, especially how businesses can pivot amid global conflict. Joining us now, Steve Hochman, the Managing Director for North America at Nagarro. Steve, great to have you on this show, and a great time to have your expertise, obviously, with the blockade still in place in the Strait of Hormuz. So as we look at the blockade, we're talking a lot about oil prices, but there's much more of a cascading effect in terms of how it affects supply chains. So can you just sort of walk us through everything viewers might need to know about once we see a resolution here? It's not really a resolution in terms of the supply chain and potential impacts.
That's exactly right. You know, what you're seeing on the surface today is really the tip of the iceberg from a supply chain perspective. What are we experiencing, right? It's price increases at the pump if you're a consumer. And oil price spikes that are in the news and headlines every day. But what's really happening from a supply chain perspective is oil takes several weeks to flow from, say, the Strait of Hormuz to Asia or North America. And you don't necessarily see the impact of the physical disruption until those few weeks pass. And then you go one step further in the supply chain and production happens in a factory, whether that's semiconductor or you're making commodity materials, fertilizer, and so on. Regardless of the industry sector, it can take months for the shortages to show up, either in terms of the energy shortages required to produce product or the physical inputs of those petroleum-based materials flowing through to be able to produce things like, say, plastics or, again, fertilizer and so on. So what we're seeing on the surface will probably take several weeks, if not months, to show up in the macroeconomy. And we're not seeing that in the news by definition. because those effects are still yet to be to emerge. And at the same time, companies aren't standing still. From what we see and working with supply chain leaders across sectors is that they're on offense, right? We've been through various cycles for quite some time over the past 10 years, whether it's COVID, Suez Canal crisis, Ukraine war, and so on. Supply chain leaders are looking at this situation and they're not sitting flat-footed. They're actually getting ready with tool sets and processes, essentially like war rooms, but in this case applied to supply chains, looking at scenarios, anticipating where they ought to be pre-positioning materials, for example, to be able to work around a work stoppage that's resulting from Hormuz, or how should they be putting inventory buffers in place to be able to prevent a shortage at the consumer if you're a cosmetics manufacturer. So the tool sets as well as the processes are very much of a whole game of anticipation and scenario planning and gaming. That's what's happening. And what's really exciting, even though this is a historically tough situation, is that technologies are actually equipping those war rooms with far more intelligence, far more predictive capability. And the net result is resilience. So risk is absolutely today's news. And we're also expecting to see even more impact down the line over the next weeks that's up to the negative. But the converse is the muscle that companies are building and that we're helping them build across sectors, leveraging technologies like artificial intelligence, simulation, and so on, is helping those companies actually weather the storm and even get ahead and compete on the basis of response to those issues that are emerging.
And Steve, how many of these companies were actually prepared? Yes, we have some historical perspective to learn from, and you're mentioning many of them were nimble and able to make pivots and adjustments. But realistically, what percentage of companies was actually prepared for a scenario like this in a way that will be meaningful to the consumer, meaning it's not going to translate to them? Yeah, great question, Marla. There's really, I would say, if you look at it from a percentage basis, it's kind of the classic 80-20 rule in the sense that there are 20% of companies who we would call leaders, who've really pioneered and experimented with some of the technologies and tool sets that I described that put them on offense. And then there's an 80% that are catching up, imitating the leaders like the Walmarts of the world, or Schneider Electric, or Maersk in the shipping area, where they've really been investing for years in these capabilities. And those companies are at greater risk. What you could expect if you look over the course of the next several months is that 20% will see some negative impact just by virtue of the physics of these cost increases, right? They won't be able to absorb all of it, but they'll be in great shape coming out of this crisis, which will eventually end, in a position of strength relative to their peers, and will be able to put great numbers up on the scoreboard from an earnings perspective. The other 80%, it'll be a TBD, very much of a TBD. Will they be able to catch up and build the capabilities necessary and weather these shocks? Some will, some will not. It's of course hard to have a crystal ball and know exactly how those outcomes will go. But what we do know is that those who are making strategic investments in the underlying capabilities around, say, scenario planning, simulation, and prediction using artificial intelligence, things like that, they're going to be in great shape. And Steve, we're a little tight on time, but you mentioned AI, and we always are having somewhat negative conversations about AI. So I do want to ask about AI in this sense. How much is it supporting the processes and preparedness, and also is it meaningfully in any way offsetting rising costs and delays? Yes. It's indirect. What we see with artificial intelligence is essentially it's a second brain that helps you predict, taking advantage of data. For example, if you have supplier outages, which is very much of a reality when suppliers can't get energy, or you have a constraint where energy is simply not getting to a semiconductor manufacturer in South Korea, these tool sets are that second brain is essentially allowing those companies to predict, not perfectly, but far better, leveraging data that's coming in real time from across the supply chain to be able to anticipate a little bit better.
and that little bit can actually be the difference between survival and not, or between a positive earnings announcement and not. And so on the margin, it's a margin game. Artificial intelligence really is changing the game because companies are far more equipped to at least be able to anticipate the possible outcomes. Whereas if you were to look 5 years ago, those same tool sets weren't available to them, at least not with the same robustness. And so it really is moving the needle. Can we quantify precisely the impact of AI on this particular crisis? No, but company by company, we're seeing double, triple-digit improvements in forecast accuracy, for example, which is a key metric, leveraging artificial intelligence, which translates to substantial, meaningful earnings outcomes.
Well, Steve, we really appreciate you bringing your expertise to the show today. We have to leave it there, sadly, but really appreciate you joining us. Steve Hochman, the Managing Director for North America at Nagarro. Coming up next, we've got the disruptors. We'll be taking a look at Zscaler had a price target adjustment over at KeyBank. We'll tell you why. Stay with us.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning, Nicole. I was just checking the board ahead of our talk to see if perhaps we were going to pop over that record for the S&P, but we are very, very close, inches away.
Yeah, right? I mean, I'm sure when you were looking, you saw the intraday high of $699.99. Okay, so right, Marley, so we're almost at 7,000. The high on the S&P 500 is 7,002. So we're a stone's throw away from record highs. I mean, after 5 weeks of selling, we all remember we were in correction territory and people were feeling pretty crummy. And then you had 2 weeks of gains, and now we're in our third week of gains, completely erasing all of those losses, at least on the major averages. Not necessarily on some of the tech stocks or some of the other names, but just the comeback trail really makes people feel better. Of course, the de-escalation language from the president, the administration, the talk about another meeting in Islamabad with Iran to try and move forward to end this has brought oil down. In fact, we even had an 8 handle for a brief moment. Right now, oil's at $92, but certainly so far off from nearly $120 the barrel. We've had a lot of news when it comes to the bank stocks, and for the most part, we've been getting some great news. We've heard from Goldman, JP Morgan, Morgan Stanley, Bank of America, PNC. I mean, we're seeing Bank of America up higher. Morgan Stanley has also gained. That's some good news there. ASML has sold off, but really had a good quarter and raised the outlook and talked about demand just being really incredible. And so those are some of the names that we're watching. We have a big deal, the partnership that was expanded between Broadcom and Meta. Just another day, another AI spending tie-up. That always brings some optimism. But for the most part, part, most of the guests who are coming on have higher targets for the S&P 500 by the end of the year. Marley.
Yes, certainly did. And I'm glad you mentioned AI there, because our next conversation is going to be about AI. But, a positive for investors in Snap, I guess, but potentially not for some of its workforce, as they're laying off a pretty decent portion of it.
Yeah, and we got a little prelude to this on the 31st of March when we heard that activist investor Arena Capital had built a stake in the company and that they were really trying to work with Snap to move to profitability, which could include layoffs. And it's very interesting because had you read that, you might have seen this kind of move coming, because month to date, that was on the 31st of March. Month to date, April, this stock is now up 32%. So if you were paying attention, which I wasn't, but I'm just saying, it's incredible if you look back, right? Hindsight is 2020. So the news here today is that Snap is now really getting a lot of pressure on profitability from investors. And so part of this plan here is to erase some of the staff. 1,000 members of the staff will be gone, 16% of the global workforce. They had 300 open positions. Those will be closed. And this is all part of the activist investor moving this company more towards profitability. These moves will, in fact, improve the cost basis by more than $500 million annualized by the second half of 2026. Evan Spiegel did put this in a letter to the staff and saying that he described last fall that Snap has been facing a crucible moment, requiring some new ways of working that were faster and more efficient and pivoting towards profitable goals and growth. And that's what we're seeing right now. I saw Wells Fargo has a $6 target and an equal weight. It really is at $6.11. So right in line there. But we are seeing the stock here surging about 9%. And as I mentioned, month to date, up 32%. Pretty incredible, Marley.
Yeah, a nice move for Snap. Block sort of laid the foundation for everybody when they announced their layoffs, and we saw that 20+% pop to the upside. So not entirely unexpected, as you pointed out, but thanks for taking us through that one, Nicole. That's Nicole Petalides. Now it is time for the disruptors. Kevin Green, our senior markets correspondent, here to talk about Zscaler today. KeyBank lowered the price target on the company KG, but they did keep their overweight rating, but the price target down to 160 from 220, still higher than where we're trading, even with the move to the upside today. Take us through what the analyst comment was.
Well, we have seen Zscaler getting hit to the downside here, especially after artificial intelligence and Anthropic's tools have been hitting the market, maybe threatening some of these software security names. And we are seeing KeyBank lowering their price target to $160. That's down from $220, but maintaining their overweight rating. They also received some feedback from the industry as a whole here. They actually polled 36 IT and security professionals, and it came out really mixed for Q1 when it came to not only the uptick when it comes to demand, but also their spending moving forward. And they are highlighting several key areas: the elevated component pricing, especially when you're looking at Zscaler compared to some of their competitors, as well as geopolitical uncertainty and then the AI-driven disruption within the market. Now, overall, they still saw a meet or a beat rate when it came to the overall product offering in itself. But the fact that they are seeing maybe a lot of companies pulling back enterprise spend, rediverting some of the dollars that may have gone to Zscaler's products and focusing more on AI native platforms when it comes to cybersecurity is a little bit of a concern for this name, which is why they are also pulling this price target to the downside here. But Zscaler still has some exposure when it comes to networking, servers, as well as storage. They do see some positives in that light, but just the near-term risk and headwinds that they are seeing is the reason for this pullback in the target price or the price target at this point in time here. So overall, not that great when it comes to the price performance for Zscaler, but we are seeing up over 3% in today's session, so maybe a little bit of a rebound.
Yeah, I mean, it's still some 25% upside implied even with the lowered price target here. But, as you mentioned, year to date really caught up in this SaaS-pocalypse, down about 42+% even with the 5% move to the upside. So, Kevin, as you're looking to trade this for example purposes, how would you approach a trade here for Zscaler?
Well, if you're looking at a one-year daily or even a 3-year weekly chart, you have seen buyers stepping in at around this $100 level. So this trade is actually a little bit more bullish to neutral. In fact, looking at that $100 level as a key inflection point for the stock. So this is actually looking at the June monthly expiration, selling the $100 put, buying the $95 put, taking in a credit for 95 cents. So the max gain on this trade is going to be that credit received, $95, with a max loss potential of $405. And that is if the stock is below the $95 at the time of expiration, with a break-even point at $99.05. Once again, neutral to bullish. If the stock stays above the $100 level, this would be profitable and max profit. But if it goes below, then you may need to manage the position, and just leveraging the technicals as a, once again, a key support level that maybe some buyers try to step in here. So some risk to this trade, but you're trying to take in premium, trying to leverage the high implied volatility in order to receive that credit, and hopefully seeing this stock stay above that 100 level at the time of expiration.
Yeah, and we do have earnings in that period as well. Earnings on May 28th for Zscaler, but right now well above that 100 mark. We're at 128.82 with a 5% move to the upside. Kevin, we appreciate you joining us for the Disruptor today. That's Kevin Green, our senior markets correspondent. Coming up next, we have got our 360 round. We'll be taking a closer look at ASML's earnings from this morning. Stay with us.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round to discuss ASML. The chip manufacturer blew away expectations on the top and bottom line, driven by rapid expansion in the AI space and high demand for semiconductors. ASML also anticipates continued growth, upgrading its full year 2026 net sales expectations to between $42.4 and $47.2 billion. Second quarter guidance projects sales between $9.9 billion and $10.6 billion. Here to take a deeper dive into those numbers, Stephen Sopko, the semiconductor and deep tech industry analyst at Hyperframe Research, and Brendan Burke, research director, semiconductors and supply chain emerging tech at Futurum. Great to have you both with us. Stephen, let's start with you. We had some really impressive numbers. They raised their guidance, but we're still seeing the stock slip this morning. So what's the disconnect here?
Well, I think one of the things we need to realize is a lot of the machines that these companies sell they're going to be delivered in 15, 18 months longer. So I think one of the things that people tend to do is they look at this company through a short-term lens, but we have to realize that they build the machines that are going to build the next generation semiconductors. So that's a much longer term. And historically, we've all watched these earnings for some indicators about where the market as a whole is going. And that's something they told us in 2025 they were discontinuing. And so this is sort of the first quarter they haven't shown us where their bookings are coming from. Because remember, if we're looking at bookings through a quarterly lens and they're not going to recognize that revenue 15, 18 months from now, it can create sort of a shear between reality and the market. So I think that's one of the reasons why I'm seeing the company make that change. And I think all in all, it's been a good thing.
And Brendan, what are some of your takeaways from the numbers we got this morning, and also what Stephen was just mentioning there, that they're not going to report those order intake numbers anymore? How meaningful is that for investors?
I think the company is well positioned for a wafer fabrication equipment super cycle that will extend into 2027. And the sell-off today could be due to slightly lower expectations for the June quarter, which should be viewed as a blip that is just on the way to significant increases in fabrication equipment spending in 2027 and beyond. And what is meaningful from an expectations perspective is how the transition to EUV is going, as well as the diversification to multiple foundries. And with management giving a clear indication that memory is a driver of net sales in the quarter, becoming a larger contributor than Logic. That suggests that the company is well positioned to diversify its customer base, even if it doesn't disclose the exact bookings contributions.
And a few things I want to follow up on there, but the first one I'm going to go back to Stephen for, without those booking numbers, and Brendan just mentioned that we're ripe for a super cycle here. Are investors now flying blind because we aren't going to get these order numbers that we've historically gotten?
I wouldn't say blind. I think the thing to realize is it's not very many people who are going to tell you sort of where their orders are coming from. I think that's been something that we've all relied upon. Investors need to look at this as, when they're announcing that SK Hynix on the memory side is putting in an $8 billion order for these EUV machines, that's really, to us, an indicator of where these companies are seeing the memory and therefore the AI market being in that 12, 15, 18th month timeframe. So I think instead of flying blind, we need to look at these companies as bellwethers of where everybody expects things to be in late 27 and into 2028.
And so, Brendan, with that SK Hynix placing those massive orders, and as you mentioned, memory is a major driver here. Memory is now more than 50% of their system sales, as I'm looking at the number. Does that change the growth profile for ASML?
It does meaningfully, because memory makers are on pace to rapidly expand their fabrication capacity and experiment with leading nodes in order to drive competitive performance gains in their underlying chips. And the area where investors do have visibility is into the CapEx plans of memory makers. The CapEx intensity of these companies is actually at historic lows, just given the rapid revenue growth that they've achieved recently. And it's a coiled spring setting up where these memory makers need to expand their fab capacity in order to serve all the demand that's pent up in the market. And so that's an area to watch, highlighted by Samsung's great earnings last week, as we look into SK Hynix, as well as Micron, as potential growth customers that can expand their CapEx plans and flow through directly to EUV machine orders.
And Stephen, we're very tight on time here, but before we lose you, I want to ask one question just about China and the China story. How big a risk are U.S. export restrictions to the China business here?
Not so much for ASML. They could lose really all of the DUV business they're still selling to China. And a lot of people are saying that's a sub 15% hit on their revenues. So, and I think that would be made up elsewhere. So I'm not going to say it's no risk, but I don't think it's the major part of this story.
All right. Well, appreciate you both being with us today to take a closer look at ASML, those impressive numbers, but also this almost 5% move to the downside. Stephen Sopko, semiconductor and deep tech industry analyst at Hyperframe, and Brendan Burke from Futurum. I also want to thank all of you for being with us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app in the Apple App Store. You can also tune in 24/7 on schwabnetwork.com. Don't go anywhere. Fast Market with Diane King Hall is coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Schwab Coaching is concepts brought to life in the real world.
Schwab Coaching is learning constantly.
It's relatable, it's practical, clear, understandable, and hopefully entertaining.
Take it for what it's worth, but I think it's absolutely world class.
Schwab Coaching is actionable, individualized, community, growth, and empowering.
It's really a human touch with your investing.
We have coaches who have been in the industry and around the industry for a long time.
So the nice thing about Schwab Coaching is that clients get access to 9 different sets of expertise.
We want to engage with you and chat on the shows we host. We want to engage with you outside of the classes we host.
A consolidation that could add to this trade. So we shall see.
We have different formats because people learn differently at different times.
If somebody's a real bookworm, we've got courses for you to learn from. They can dig in, go at their own pace.
We have webcasts running through YouTube all day, every trading day.
We've got this ongoing 24, 25 times a year events that are making their way around the country.
So you get that opportunity to share experiences and knowledge with other traders.
They're kind of helping each other learn step by step along with the education that we provide them as well.
We're going to be able to help you regardless of where you are on that path of education.
It's really unique, not just that it exists, but that you can tap into 30 some hours worth of it each and every week. How incredible is that? And it's free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are. Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. Coming up on noon Eastern here at the New York Stock Exchange, Wall Street has been mixed as investors keep one eye on headlines tied to the U.S.-Iran war and one eye on earnings. Let's get right into a check of your scorecard as we hit the lunch hour on Wall Street. We've got the S&P 500 higher. It's approaching a gain of 0.5% right now. The Dow is still under pressure. It is off by just shy of 0.5%. NASDAQ 100 at the top of the leaderboard, better by more than 0.75% there. Meanwhile, the Russell 2000, those small caps, taking a small step back today as investors continue to monitor the latest with regard to the potential for progress on peace talks between the U.S. and Iran. Meantime, here's the roadmap for today's show. We'll look at example option strategies for Taiwan Semi ahead of its earnings. Those are due tomorrow. Plus, the team from Likefolio will be along with new sentiment data on PepsiCo, and Salesforce is on our radar today as it stages in advance. Now that we've got the roadmap for today's trading action, it is time to bring in my co-hosts. You've got Tom White in our Chicago studio and Kevin Hinks joining us live from the CBOE. As you know, we've got you covered from exchange to exchange and beyond. So we've got this push-pull on Wall Street continuing. The bulls trying to extend gains. We've got strength in the S&P 500 led by tech, financials. Meantime, we got oil prices sitting around $92 a barrel. Investors seem to be hoping for this peace deal between the U.S. and Iran. We had President Trump out in some interviews, kind of, it seems like teeing that up. Tom, your thoughts as you look broad strokes across the market?
Yeah, it seems like the risk-on assets, the equity market, is kind of pushing aside any geopolitical tensions at this point, maybe focusing more on what's going on in the corporate side with earnings coming out better than expected out of the financials. That's probably driving the optimism in the markets at this point, because when it comes down to it, Diane, historically we've seen this played out repeatedly. When there's geopolitical tensions, when there's things like this that happen, spikes in crude oil, the market eventually pushes those concerns aside, and relatively quickly. And we've seen that right now. You got the S&P 500 just below record highs at this point. If we settle right here, that's going to be a new closing record high for the S&P 500. So that V-shape, it's kind of similar to what we saw last April when we had the tariff consternation hitting the markets and pulling them back. But this is to a lesser degree, right? We went into correction territory in 3 of the 4 major indices. Now we're right back near all-time highs for the S&P 500, the NASDAQ, and the Russell. The Dow's lagging just a little bit, but this typically happens. And when you see volatility, spike back above the 30 level, and now it's back to the levels that we haven't seen since the end of February. This is typically what happens, and you should be prepared for it, because when it comes down to it, the equity market can get roiled by these geopolitical risks and tensions. But at the same time, it's going to all come down to what these companies are saying and what the consumer's doing and keeping the economy going the way that it is. We're seeing record profits for a lot of these financials. And will that parlay into more gains for the other 485 names that aren't financials in the S&P 500? And it looks like it's setting up for another good earnings season.
Yeah, indeed, closer to a record high than not. The last time we saw one was in late January, and then we had all this volatility, which many analysts that we talked to said that would mark the year. The why, though, wasn't about the geopolitical risk. Kevin, what's your thought when you look broad strokes across the market today?
I think it's not the how many, it's the who are higher today. If you think about it, the market is up. S&P's up almost 0.4%, with 7 sectors down and 4 up. But with the ones that are up are critical. Obviously, financials are higher with all their earnings out, but it's information technology, it's communication services, it's consumer discretionary. Those 3 big behemoths, as well as financials, is what has this market higher, despite, like I said, more sectors being lower. The equal weight S&P is actually down 0.25%. So this is a, information technology, and even more closely, a software-driven rally in terms of it within information technology. So the leadership of the market, all the biggest names, those are what's higher. Amazon is, up, but Tesla's having a monster day. Microsoft and Apple, Broadcom and Nvidia, all the leadership, Meta. These are all the leaders that, that have these markets up. It's the leadership taking stocks higher. I thought we'd get back to 7,000, just didn't think we'd get back this quickly, frankly.
Yeah, I did not think we'd come back this quickly. And, I know it's not a roar right now, but it feels like we're roaring back right now. So let's get into the earnings that you kind of alluded to earlier, Tom. There's strength showing up in the banking sector, continued strength there. Bank of America saying the consumer holding up. That was CEO Brian Moynihan. They did better than expected. Those shares ticking higher. Morgan Stanley also better than expected. That has a bigger advance right now. That stock is up more than 4%. ASML, though, they were out with their earnings today, and although they had some strength in the forecast, looked good, you had some pressure there. Tom, what's your take, either looking across the banks or ASML?
Yeah, productivity going well for these financials, especially these, broader-based investment banking companies. They said they generated almost $1 billion more in revenue than they expected on the trading side of it, so that's going well. Profits jumped 29% to $5.57 billion. That's going really well. Equities trading up 25%. Fixed income revenue rose 29%. Remember, the fixed income portion of Goldman Sachs results was a little bit weaker than anticipated, but Morgan Stanley's rose 29% to $3.36 billion. I think we talked about this, last week when we were kind of previewing these. And the Bank of America comments, I think, hit home pretty well, where, hey, the consumer's starting to get stressed out about inflation, but at the same time, they're still spending and propping up this economy at this point. If you take a look at some of the financials here, it's a good environment, right? Remember, the first couple of months of this quarter is when the stock market was at all-time highs. We had that wealth effect taking place. The job market's still robust at this point. So a lot of things going right for the economy. And then you throw in maybe that last 3 to 4 weeks of the quarter where, hey, this geopolitical tension really didn't dent what's going on in the economy. And I think that's a key takeaway for these. Morgan Stanley, hitting a record high today. Bank of America up, even though maybe their results weren't as good. Wells Fargo previously had fallen post results. But overall, a good tone to set for the overall equity market here moving forward with these financial results.
Kevin, your take on either the banks or ASML. I'm curious if ASML is like a buy the rumor, sell the news kind of thing.
Well, ASML, remember what we talked about in yesterday when we discussed ASML was gross margins. And They put up a number of 53% gross margins. However, they guided to 51 to 52 for quarter two. That is worrisome. Remember, they want 57% by 2030. They're going in the wrong direction, Diane. It dropped from 54 to 53, and now they're guiding to 51 to 52. So I think that's down just because of the guidance on the gross margins. The banks, you see what's happened in financials right now. I think it's really interesting because Goldman Sachs and Morgan Stanley are such a tight correlation between the two firms and what they do and how they make their money. For Goldman's FICC to be lower and Morgan's to be big higher, that tells you that someone's eating someone else's lunch, because normally those two fight it out and they go in the same direction. So I think that's big news for Morgan Stanley. So yeah, all things considered, we're consuming and digesting a lot of earnings here. And remember, we were worried about the valuation on ASML before, and it was the gross margins we thought that would propel the stock or disappoint. It did, Diane.
All right, let's go back to tech, guys. So we got Meta doubling down on those custom AI chips. Broadcom is at the center of that build out. They've got plans to deepen a partnership between these two heavy hitters. You got Meta higher, you've got Broadcom higher. Tom, your take.
Yeah, I think this is good for Broadcom because you're seeing other companies within the tech space kind of dispersing where they're getting maybe their chips in the future, and they can use these more specialized chips that Broadcom has the corner on at this point. This MTAI chip that's going to be running their platforms and expanding throughout 2029. I think this gives them a little bit of leverage where they're not going to rely on NVIDIA so much in moving forward in the future. And this is going to be a sustained multi-generational roadmap to serve that growth. Remember, over 3.6 billion daily active users across their platform. CEO Hock Tan, he's leaving Meta's board. He's going to get an advisory role. So this is also another one of those around-the-wheel type of investments, trying to expand their footprint and not rely so heavily on maybe one or two of the chip makers at this point. So this is probably good for both companies. You're seeing the reaction in the stock. But, hey, you know what? This is still going into the fact that these hyperscalers, these big companies like Meta Platforms, continue to spend a lot of money. Let's see some monetization.
Okay, well, today it seems like what's good for the goose is good for the gander. Kevin, your thoughts?
This partnership, and let's face it, one of these gets announced every other day, it seems like, in the market, but this is a pretty significant one. I think this is two companies getting much closer. The fact that the CEO of Broadcom has to go off the Meta board I think that tells you that these companies are getting closer together. And 1 gigawatt of the commitment, it seems like a big number. I don't know exactly what that is, but I know it's a lot of power that they're adding. And remember, what Broadcom does, they're basically in the same business as NVIDIA, but theirs are more customized chips. So the fact that this partnership is closer, again, we get one of these announced it seems like every 2 or 3 days, but this seems like a pretty big one and a much different long-term, what they call it, multi-generation strategic partnership. Diane?
All right, let's talk Uber, guys. Shifting gears here. Uber shifting away from its asset-light model, at least from this report. The Financial Times reporting it will commit more than $10 billion towards autonomous vehicles. You've got shares of Uber rallying today. Tom, your thoughts?
Well, we always talk about Uber having, the best platform for ride-hailing, right? And there was some consternation about a year and a half ago where, hey, maybe Uber is going to lose their place when these robo-taxis come out, right? But what they've done is create partnerships across the board, whether it's with Waymo, whether it's with Lucid, Rivian, Alphabet, the Waymo, NVIDIA announced plans to have their own robo-taxi. So the partnerships are going to be key moving forward. But we've always talked about Uber being an asset-light model, right? Well, now committing $10 billion. I think maybe the red flag's been raised at that company. The stock's still down about 24% from all-time highs where, hey, maybe that partnership with Tesla is what everybody kind of wants at this point, because we all know the algorithm that Uber has is probably, put them in the lead as they were first to market in ride sharing. But maybe there's some concerns here. We're getting a nice pop here in Uber stock, but as I mentioned, it's been pulling back for the last 6 months or so. So, yeah, this is, I think, just kind of digs into that where, hey, now they're committing capital to something that they maybe don't want to get left behind on. And maybe these partnerships that they have globally, I think they've got over 10 or 11 partnerships already with autonomous vehicle companies at this point that, hey, they've got to be in the mix here moving forward so they don't get left behind.
That makes sense. Yeah, you don't want to get left behind if this is the future of transportation. Kevin, your thoughts?
Diane, we've been covering this stock for years. And the question always was, when there's no drivers, it's going to be much more profitable. But the question was always, if there's no drivers, whose car are you going to use? Well, now we're getting a little clearer picture on that as Uber is going to buy cars. Now, that seems like they'll own the whole business. However, that's going to cost a significant amount of money. Think of how many cars Uber uses owned by other people. Now, this is a much bigger commitment as autonomous driving and Uber and all these companies progress. They're not, they're starting to finally own the cars and invest in the car companies. We know Uber's app is the best one and their software is the best one. However, they didn't have drivers or they didn't have cars. So I think this is the next evolution that, frankly, if you looked down the road, we all knew this was coming. It was just who and what they were going to do it with. So, yeah, this is the evolution of Uber. And does it just keep going as they keep rolling profits? They got to keep buying more cars, Diane.
Kevin, would you get into a driverless car?
100%. I trust machines way more than I trust humans.
Tom, same question to you real quick.
Oh, in a heartbeat. Kevin's right. I mean, you drive around Chicago, Diane, there are some idiot drivers out there, so I have no problem getting into one. The problem is we can't get them here in Chicago yet. So, yeah, start knocking on some politicians' doors. Maybe we can, but I no hesitation whatsoever getting behind the, driverless car.
All right, so we need some policy changes there. All right, guys, let's put a pin in it. We got bull versus bear coming up. The guys will get their example trades put together for Taiwan Semi. It's got earnings due tomorrow. We'll have more Fast Market after this break.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Taiwan Semi set to release its quarterly report card tomorrow morning, and expectations are sky high. The world's largest contract chip maker already told investors first quarter revenue surged 35% year over year, powered by relentless demand for AI chips. Wall Street is looking for earnings of $3.31 per share. That's on an adjusted basis on $35.5 billion in revenue. That stock is up already about 25% this year, sitting just 2% below an all-time high. Taiwan Semi remains a critical supplier to names like NVIDIA and Apple. It's a key read on the broader AI build-out. Investors will also be listening for any caution on smartphone and PC demand, rising costs, and geopolitical risks. All right, time now for the tug of war on TSM. For that, let's welcome back in our co-hosts Tom White and Kevin Hinks. It is bull versus bear time. So before we get to your example trades, we've got to get your thoughts on Taiwan Semi. Kevin, I'll start with you, your take.
Yeah, it's very hard to be bearish on this company, right? Think about it. They manufacture semiconductors. How, in this world of AI that we find ourselves, how could this company not be extremely popular and extremely busy? Their guidance, they're guiding for, in quarter one, they guided for a 40% year over year revenue growth, $34.6 to $35.8 billion. This is a company that really, much like ASML though, one of the big problems is the valuation. It is trading 30% above its 5-year high in terms of 5-year average in terms of valuation. So this is certainly something that the bar is high, but good Lord, they are right in the middle of manufacturing semiconductors. So they are an extremely popular name. Does that mean the stock's going up? I don't know that for sure, but the numbers and the growth they're going to put up are going to be pretty substantial.
Tom, your thoughts?
Yeah, I think you're seeing a little bit of consolidation here today, probably on the back of ASML earnings at this point. But Kevin's right. I mean, you look at what these big tech companies are spending on chips, right, and AI infrastructure build out. Well, who reaps the benefits of all that? Taiwan Semi does, right? They make stuff for Broadcom as far as the specialized chips goes, right? They make stuff for Google Alphabet and the TPUs. They make stuff for NVIDIA. They make stuff for AMD. So they're the store that all these companies have to go to actually produce these chips. And Kevin mentioned the valuation's going up, but hey, they're expected to grow 320 or 331. That's over 55% growth from year-ago levels. So the growth rate is there. They don't have enough supply to meet the demand as everybody wants more chips, better chips. Then you start looking at pricing. They're expected to start raising prices. Is that going to help their margins moving forward? Well, CPU prices are going up. Memory chip prices are going up. What does that mean? Well, Taiwan Semi can charge more, and they probably will charge more. So that's why you're seeing this exponential rise over the past couple of years in this stock. But then you have to start wondering, as Kevin mentioned, is the market already ahead of what we're expected to hear? Remember, Taiwan Semi gives monthly data as far as sales goes. They just gave those about a week and a half ago, 35% year-over-year gains last month that they reported. $35.76 billion. So we get some clarity, and that's maybe why implied volatility levels aren't as elevated on a percentage basis for a potential plus or minus move due to the fact that, hey, we get some clarity on a month-to-month basis from Taiwan Semi.
Yeah, and that's the thing, that we get that regular cadence, so is it already baked in? So let's jump into the example trades. Kevin, let's start out with yours. What's your approach today?
So I did something complex where basically I took two strategies and combined them together, but I did it a little differently. So what I looked at is the recent high was about $390, and the expected move is about $14, $14.50. That takes you right up towards $390, $391. So what I did here, I gave myself a little, it's similar to a butterfly, but it's also similar to a calendar spread, which is I bought the 1 week, April 24th, April 17th, 390 calendar spread, right? But then I took another one of those 390s and sold the 390, 395 call vertical. So I chipped away at my net debit on the 1 week call calendar, which can be quite expensive, and I gave myself a little extra theta, a little lower debit, and a chance to be profitable if nothing happens. If it sits right here, this trade is profitable. So I combine the call calendar with the short vertical where the combined strike is that 390 strike, Tom. Kind of an interesting, subtle way to be bullish.
Yeah, let's break this one down because in the near term, April 17th, monthly options that expire in just 2 days, that's where you're selling the call vertical. You're selling one of the 390 calls, buying one of the 395 calls. And then you combine that helps pay for part of the call calendar where you're buying the April 24th weekly options, the 390 call, selling another one of the April 17th 390 calls. So you've got two short options on the April 17th 390 calls, long one of the April 17th 395 calls, and then long one of the April 24th weekly 390 calls. So there's your setup on this complex three-legged spread with short two options in the near term that expire in 2 days on the 390 call. You're paying roughly about $1.80 debit. So where's my risk come in on this? You can see this risk profile. The apex of profitability is where you sold two options, right? Right at or near that 390 strike call. But you've got a short $5 wide call vertical up about $3.99 is where you start losing money on this type of position. Because you've got that $500 in risk on the short call vertical plus the debit that you're paying for this, so about $680 in potential buying power risk on this trade. Now, on the downside, you still got a little bit of risk, but it comes in probably around that 370 level because you're still going to have some value on that calendar portion of this trade on the 390 strike. You've still got a range in that also, but what you're looking for on this type of trade is a grinding up about $13 from the current share price up at or near that 390 strike. But as Kevin mentioned, if the stock stays right about here, maybe grinds up to 380, you're still going to be profitable on this trade. What you don't want to happen is you don't want the stock to fall out of bed and go below 360, or you don't want the stock to go above maybe the 399 level, 400 level to the upside, because that's where you're going to realize the most losses on this. But keep in mind, this trade that Kevin brought, it's complex, but it's risk-defined also. So you know exactly what your downside is on that. Kevin, I went a little bit not simpler, but a little bit more basic than yours. It's not complex trade, but I'm taking advantage of the implied volatility levels between different option series. So on my bearish example trade, I just looked at a 1 week wide put calendar to the downside, about that one standard deviation. Stock has pulled back a little bit, but the option market's only pricing in about a $14.50 move either way in the shares. So went out to the April 24th weekly options that expire in 9 days, bought the 365 strike put out of the money to the downside, sold that same 365 put in the near term April 17th monthly options, creating a 1 week wide bearish put calendar. You're paying roughly about a $270 debit for it. The debit you pay is going to be your risk on this trade, so you know exactly what your downside is going into this position. You do have some assignment risk on your short option, though, over the next couple of days. But that $270 debit on this one, Kevin, that's your risk on this, but you've still got a range. You're looking for 365, about that one standard deviation move to the downside. But at the same time, you've still got a range on this one, probably between about 355, 358 on the downside, maybe 375, 380 on the upside, Kevin, to be potentially profitable on this. And it costs a little bit less because you're buying a lower implied volatility than what you're selling, right, Kev?
Yeah, exactly. You're taking advantage of the difference between the implied volatilities. You're selling about a 75, buying about a 51 implied vol, Tom. And even though you're spending $270, it's a kind of a chunky 1 week calendar. That's because that front expiration 360 or 390 call is still about between 3.5, 375. So it's still got a fair amount of premium, even $13.50 above the market. So big premiums on these names, and that means that those calendars are going to cost a little more money than normal. But like I said, now you see why that short call vertical chips away at the net debit on the call side. Your put vertical, you don't have the risk, the directional risk that we do on the upside, on the downside, but you're defined by the debit paid on your spread, Tom.
Yeah, and I think you meant puts on that because the 365 put in the near-term series that I'm selling in this example, there's still $3.15 of option premium on it, and it's $13 out of the money to the downside on this one. So, yeah, there's still a lot of option premium in those near-term options that will decay away, and implied volatility levels will come in post-earnings. But there you go, Diane. There's the setup. Mine's a little more basic than Kevin's. Mine's bearish. Kevin's a little bit more on the bullish side, but his is also neutral.
Well, that's all right, especially because I know that we have different types of viewers who watch our shows, those who may be more newer to trying these example strategies out, the paper trades, if you will. And then I like what you said, a subtle bull there, Kevin. All right, guys, we've got Cash Acts coming up. The team from Likefolio will be along with new data on PepsiCo. It's got earnings coming up. Will that stock continue to fizz up? We'll see. Stay right here on Schwab Network. Fast Market. We'll be back after this break.
Hi, I'm Alex.
I'm Jane.
And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our Cash Tag segment. For that, we want to bring in our next guest, and that's Landon Swan, co-founder of Likefolio, taking a look at PepsiCo today. All right, Landon, good to see you today. That stock's been fizzing up so far this year. It's got a test in front of it with earnings due tomorrow. Why don't you walk us through your latest data and what sentiment looks like?
Yeah, absolutely. I like the fizzing up call there. And when you look at Pepsi, I mean, this is, make sure investors don't get confused. This is not the just pure rival of Coke. They're about 60% snacks, 40% drinks when it comes to revenue, and so it's a completely different animal. And when we look at overall what Pepsi's looking at, You can argue that, we talk about that K-shaped economy a lot. You can argue that they're a little bit on the wrong side of that, where, price and affordability come into play for consumers significantly. We see that a lot in the data, a lot in consumer mentions, people talking about it. But they're taking action. I mean, they're reducing prices. They're increasing the availability of value packs, which is actually helping quite a bit on the affordability side, especially on the snacks. Now, when we compare to some of the drink categories, they're not doing great. I mean, they're up on a year-over-year basis, which is good because they were in a big slide for quite a while. So they have sort of stopped the bleeding on the drink side of things. And you can see here, with some of their competition, they're not keeping up. But again, we'll show a chart later that shows that they were in a pretty sharp decline for a while until spring or summer of 25, where they kind of turned things around. And the stock has followed. So it's actually good that they're plus here, because, if you'd asked me not too long ago, they would have been negative and heading the wrong direction. So they've turned this around. But what's interesting is some of the trends that we're seeing. So, we can kind of break apart the trends into two parts. Again, back to the K-shape, sort of the higher income versus the lower income. On the lower income, we've already talked about affordability and things like that, value. Convenience, that's very important, and those are the trends that we're seeing associated with Pepsi products. On the higher end, when people are talking about Pepsi products, they're talking about natural colors, and they're not talking about GLP-1. So we've actually, this is one thing that we've been watching, and it hasn't really played out. We expected the Ozempic craze, the GLP-1s, to really eat into Pepsi's profits, especially on the snack side, but we just haven't seen it significantly, especially not on social media. People aren't talking about that as we thought they would, and so for the higher income people that are more likely to be doing those kind of drugs, the GLP-1s, it's more about the natural colors, the natural ingredients, and Pepsi's taking moves to address that issue. So overall, we're seeing that Pepsi is not doing great on the drink side, hanging in there on the snack side and making some moves to turn around. But I think the big story for us is that they were in a sharp decline for quite a while, and they've started to turn it around. So this could be a bit of a sigh of relief for investors as they have dealt with a fairly sideways stock. And you can kind of see here the data. The blue line is our data. That big spike in the middle was more a marketing effort, the Pepsi Challenge. We saw a big increase in website visits with regard to that. And that may have been the thing, the catalyst that stopped that downward trend. You can kind of see after that point, I mean, if you can, imagine a line that takes that out, it was in a downward trend, and that sort of snapped it, and we're moving back to the upside. So this sideways move in the stock may be over. We're not extremely bullish on Pepsi. But we do like the fact that the downtrend has been snapped, and they've got some things working in the right direction right now.
Last earnings, Landon, the stock popped pretty significantly because they beat on comparable sales, and they raised some guidance on this. They're expecting 5.8% growth this quarter alone, so they're starting to grow again. Caveat, though, I was in the store the other day. I saw Doritos protein. What the heck is that? I get it. They're trying to pivot away probably into the GLP-1 where everybody's eating more protein and all that other stuff. But Landon, the question that I have, and you mentioned this, the fact that they're starting to lower prices. Worst time in history to lower prices because the cost of moving everything, currency costs, are headwinds right now. Is that going to be a concern for this company this quarter, just due to the fact that, hey, they lowered prices anywhere from 5 to 15%, I believe, on a lot of their chips products, but those are all the costs that are going higher now. Is that going to be a concern for you guys going into this report?
Well, I think they're kind of stuck, between two bad decisions. One is, the worst times to lower prices like you're talking about. And then the other one is people not buying as much because it's not affordable. And that's the problem that we always talk about. I mean, if you're selling to consumers where price is a major factor, you're going to have hard times right now because all the costs are going up. And it's not just your cost, it's the consumer's cost. And so they, when they're going to the store, they're thinking less about, do we want to get all these chips, or maybe we can just get one bag, or let's get the value pack, or whatever. Let's spend less effectively. And so I think that is one of their problems. And one of the ways that they're combating that is by going for the more affluent customers by doing things like, having protein chips, having natural colors, trying to make their ingredients more healthy to appeal to the people that maybe care a little bit more about that. So I think that's the tough decision that they've sort of found themselves facing. And, I guess if your choice is lower prices and sell, or keep the prices the same and don't sell, I guess you have to lower prices, but it's, they're stuck between a rock and a hard place, and they have to do one or the other. Again, they're selling to the wrong side of that K-shape right now.
Landon, let me ask you this. The stock has had some momentum. Tom mentioned how it performed off the back of the last quarter. How are you feeling in terms of an earnings score for this one?
Yeah, so this is basically a stop the bleeding on the data side of things. I mean, I know the stock has kind of been sideways. It's not down terribly. I wish it were a little bit further down. But we've got a Main Street score of 49, a Wall Street score of 20, which tells us that the consumers are kind of so-so on it. But Wall Street is a little bit more negative on it, just based on some of the trading that we've seen especially relative to the market, although caveat, this is obviously a defensive stock. Anyway, long story short, we've got a plus 23 on them for this earnings score, which is, if you guys know our scoring, that is barely bullish, just on the side of bullish where we're confident enough to place a small trade. Not going in heavy on this one, but we do see that the downturn, especially in drinks, is starting to curve up to the upside, so the bleeding is stopped. We are a little bit concerned with the snack side of things, just for all the reasons that we mentioned. But we also see that the strategic initiatives that they're taking are moving in the right direction, maybe trying to not just sell to people that are price conscious, but people that are more quality conscious. And so they're going to be able to get more money out of customers from that. So plus 23, slightly bullish on this trade.
All right, thank you, Landon. That is Landon Swan, co-founder of Likefolio, with the latest look at PepsiCo ahead of its earnings. Now, for the trading perspective on all things Pepsi, let's bring Kevin back into the fold. Tom, we got a lot of insights. Your thoughts before you guys get into the example trade?
Yeah, I think you take a look at the pullback that we've seen. Now, last earnings were great, right? That's why the stock popped. It was above $170 a share at the start of the year. Then the macro events started taking place that hit the stock. So we're basically back to about 154 in the stock. So it's kind of given up a lot of those gains, over $15 from the highs from last earnings. So seeing a little bit of weakness there. I think you're going to have to take a look at the beverage side of their business, their margins, currency headwinds potentially. And those are the things that you're going to have to focus on, because they might start talking about the amount of money that they're spending additionally. When you see crude oil, they've got to get their stuff to market, right? So crude oil going up is going to cost them a lot of money. So we'll have to focus on those moving forward. But Kevin, the option market's only pricing in about a 4.2% move either way, in the stock of just over $6.50 in either direction. How do you want to look at this one from an example trade?
Tom, I'm going to take advantage of the 72.5 implied volatility in the April 17th expiration, and only a 39.4 implied volatility in the April 24th expiration. So taking advantage of that, doing the 1 week 160 call calendar. It's only trading $0.25, Tom. So you can really put this on for an inexpensive price. Now the stock has rallied a little bit, so it might be trading a little higher, but it was trading at 25 cents a short time ago. So make sure it's not all over the board, but certainly this is a name, Tom. You're taking advantage of the big difference between implied volatilities here to make this calendar spread more affordable, Tom.
You make a good point there on the vol dispersion. What you're buying on that 160 call on the April 24th is a lot lower, below 40% implied volatility on aggregate, and selling a higher implied volatility in the near term. April 17th, 160 calls. That's about 72% on aggregate implied volatility levels there. So that lowers the entry point price. buying the 1 week wide call calendar on the 160 strike, you're paying, we got a 25-cent debit on there. It's probably trading closer to 35, 40 cents at this point, but that's going to be your risk with the debit you pay on it. So if you pay 25 cents, $25 per spread on this trade. Now, you look at this risk profile and you're like, okay, I need to be at or near the 160 strike to be profitable, but you've probably got a range between maybe 152 on the downside, 167, 168 on the upside to be potentially profitable on this trade. So while you're aiming for that 1 standard deviation move to the upside here at or near 160, you still got a decent range. It kind of sets up with Landon's Likefolio data where anything above the 20 level, they're a little bit more bullish on it. But inexpensive way, Diane, for you to get upside exposure on this, that 1 standard deviation aligning with what Likefolio's data is stating at this point, and the fact that this stock has pulled back pretty significantly from those post-earning highs that we saw just 3 months ago.
I like the inexpensive component of that one there. Thanks, guys. We've got the breakdown coming up. We're taking a look at Salesforce as it catches a bid today. Kevin mentioned earlier the gains we're seeing in software. We're certainly seeing those in Salesforce. We'll have more Fast Market after this break.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall, live on the floor of the big board. Before we get to the breakdown, I want to give you a check of where markets stand as we get closer to the bottom of this hour. So we still got mixed market action right now. Now, the S&P 500 is better by a little bit more than 0.25%, but I want to give you more perspective. Earlier in this hour, we were pushing toward those intraday records. We had hit 7,001 on the S&P 500. A touch above 7,002 would be a new record high. So we'll be on records watch throughout today's session, whether it's intraday or a closing high. The Dow still lower. It is off by just shy of 0.5%. NASDAQ 100 has a gain of 0.5%. Russell 2000 lower by about 0.25%. Salesforce is catching a bid today as some analysts, though, caution still around the software trade. It comes as the broader software sector gains ground, with the IGV also up, that up about 3% right now today. Software stocks have been left for dead, but today there is certainly green on the heat map. This week, Piper Sandler lowered its price target on Salesforce, but maintained an overweight rating on the beaten down stock. Shares of Salesforce are down more than 30% this year. Time now for the breakdown. For that, we want to welcome in Kevin Green, Senior Markets Correspondent. KG, before we do a deep dive into Salesforce, I want to get a quick thought from you on the markets as we sit It feels like there's a tug of war happening between the bulls and bears. The bulls certainly had the floor so far. You said we'd be on 7,000 watch today. Your quick thought?
Yeah, I mean, that's going to be a key psychological level that we have seen as an area of resistance in November, December, and even January of this year before we started seeing a pullback to the downside. So anytime that we have a major area of resistance, obviously we're going to probably see some selling pressure going into that. And then you are seeing maybe a little bit of a rotation trade, as you kind of talked about. It's really concentrated in technology, communication services, and software is kind of leading the way. And if you're even looking at the semiconductors, they're actually a little bit weak today. Micron, SanDisk selling off, but you are seeing a bid in software names, and that actually has been the inverse over the last month and a half, 2 months, where you saw semis gaining a lot of strength, software weakening, at least for now here. But there's a lot is still going on when it comes to the headlines. Not surprising that we're seeing a little bit of pressure to the downside now, selling off as we get these news headlines around Iran. Also, some headlines from Scott Bessent, as well as Kevin Hassett, and maybe some things happening in the White House here. So a lot going on. Not making too much into this, but it's been a heck of a run too. So a retracement back down, testing some key areas of support like the 20 or the 50-day moving average wouldn't be outside of the realm of possibility here as well, Diane.
All right, let's talk Salesforce. So it is catching a bid today. This one's certainly been beaten up. What are the technical levels you're watching here?
Yeah, from a technical standpoint, you actually have to pull the chart back here a little bit in order to get a little bit more of a perspective. The stock has been obviously hit very aggressively here, but if you look at a 5-year chart, you can see that we're pretty much trading around, getting close to around the 2023 lows, if you will. We're still about maybe another $40 or so from those lows. But you are seeing a little bit more of a consolidation on the weekly chart where the RSI itself is starting to consolidate, try to make try to break out here. And if this price action continues, we will see price momentum kind of shifting, and that could be a positive sign. But the thing that gets a little bit concerning, not only outside of the technicals, is the fundamentals, Diane. This stock is trading at the lowest multiple that we've seen in a very long time. In fact, even if you look at the COVID lows, right now it's trading at around a 12.5 forward multiple. We haven't seen the stock trade at that low of a multiple in a very long time. So the market's not only hitting it from a technical standpoint, but also from a fundamental standpoint. And a lot of that's really on the back of the fact that there's a lot of competition within the space. Agentforce is going to be kind of their flagship product, but there's a lot of competition that might be eating into their market share. And from a fundamental standpoint, the company has not been able to accelerate revenue in the fashion that investors would like to see. We continue to see a lot of quarters that are seeing a revenue advances of around 10 to 12%. The market really wants to see around 16 to even 18% revenue growth on a year-over-year basis, because if you're looking at this stock compared to others, it's not really growing on the top line where others are, and that's probably why you are seeing institutional traders and investors really kind of ignoring this name and focusing on maybe some of the higher quality technology companies that are out there that have exposure to artificial intelligence and customer resource management.
So does this one feel just like a sympathy move with the broader gains that we're seeing in software, KG?
It does. I mean, even if every type of stock that has this type of drawdown like we've seen right now, there's always going to be a turnaround, or there could be a potential turnaround story, and no one really can pick the bottom. I told you before, I mean, the multiple is actually relatively cheap, but if you're not getting the top line growth like you would have expected or you would like to see compared to their peers, then why would you pay up for the name? I think this is a sympathy play. You are seeing a lot of short sellers actually buying back a lot of stock over the last couple of trading sessions because of this rip rally in the broader S&P 500. And maybe they do have a product offering that they'll announce here that's going to complement or maybe accelerate top line growth. But this is a stock. Salesforce is really known for inorganic growth, or purchasing and buying companies rather than building things in-house. And so that's also been hitting the stock as of late as well.
All right, thank you, KG. That is Kevin Green, our senior markets correspondent, with the breakdown on Salesforce. Let's get Tom and Kevin back in here for example trade purposes. Tom, you've got the example trade in Salesforce. Any thoughts before you jump into it?
Yeah, the SaaSpocalypse, taking hold in CRM. You have to start thinking about this. Ever since Anthropic and their Claude model came out, are these companies that are subscription-based, right? They've got big clients all over the globe, right, that rely on their HR software and other things. Can they build their own with these AI agents? Well, maybe. That's why the stock has sold off. We just bounced off the 3-year lows earlier this week. So that's a concern for these companies. as far as growth numbers goes. Now, they've got their own AI agent, right, within Salesforce. But will they be able to parlay that into keeping all these subscribers in all these Fortune 500 companies? That's going to be the concern moving forward is, why subscribe to a service like Salesforce if you can build it yourself in less time, probably with less people too. So that's going to be a concern. And then they've got employee compensation concerns also, the amount of stock that they've given employees. So there's a lot of concerns on a lot of fronts, but like I said, that's why you're seeing the stock at 3-year lows here. But I looked at a strategy. If you think maybe this is overblown, we've seen a little bit of a resurgence in software maybe over the last couple of weeks, not so much in CRM, but if you think it's going to move a little bit higher, this strategy takes advantage of it. They report earnings on the 27th of May, so I want to avoid that earnings event while still giving myself upside exposure with this example trade. I went out to the May 15th monthly options here, Kev. Bought the 175 call one time here. That's basically $2.50 in the money. Sold 2 of the 195 strike calls, and then bought 1 of the 200 strike calls. So an unbalanced call butterfly, paying roughly about a 630 debit on this. It might be trading a little bit higher because the stock has moved higher. But the debit you pay is going to be your risk. If you pay $630 per spread, it takes your break even up to 181.30 to the upside. On a percentage basis, not a big move needed here. But Kevin, that in that May 15th monthly option series that expires in 30 days where this trade sits, about $18.50 move expected, kind of aligns with where you want this stock to go to the upside.
Yeah, you've given yourself 30 days in duration, a $20 wide call vertical, financed or reduced in price by a short $5 call vertical. Trading 630, it's, you have a chance for it to go to $20, so that's more than a triple on this trade if you get it right. Obviously, if it goes through there, your profitability is diminished, but it still stays profitable on the upside, Tom.
Yeah, more than a double in a profitability, even if the stock does spike over the 200 level. But using what the option market pricing in for that May 15th monthly option series can help set up directionally. Maybe you have to have your own assumption, but it can set up maybe where you put that short strike, because you're short 2 options on the 195 strike. That's where you want the stock to go. That's about that 1 standard deviation move over the next 30 days that the option market's pricing in. But keep in mind, that's a dynamic number. It changes with implied volatility levels in the stock also, so keep that in mind. But an unbalanced call butterfly, take advantage of some upside exposure on here. You lessen the price by doing the butterfly as opposed to maybe just buying the 175, 195 call vertical also on this one. So Diane, looking for some upside, but avoiding that earnings event in this example trade.
All right, that's an example trade there for Salesforce. It is catching a bid today, along with the gains that we're seeing in the software space. You got tech at the top of the leaderboard, consumer discretionary and tech for the S&P 500. That's going to do it for us today on Fast Market. I'm Diane King Hall alongside Tom White and Kevin Hinks. Download the Schwab Network app. It is available in the App Store, and tune in 24/7 on schwabnetwork.com. Stay with us. You've got Next Gen Investing coming up.
So what is unique about Schwab Coaching is the community.
There's a lot of energy. Like-minded people are learning with you.
You can just see and feel all the excitement around getting to learn a new topic.
Some of you want to get everything face-to-face with you and 400 or 500 of your closest friends.
Some clients like to be in the privacy of their own home on an online workshop, but still having that live interaction with the coach.
As I'm talking, questions are coming in from that live audience, and they help me fill in those gaps as an educator.
People learn differently, but all those ways we actually teach it all come back to the point of making a difference and helping you make progress.
And so that means not just giving you theory, it means giving you the practical implementation using our platforms.
So we want it to be fun, we want it to be informative, and most of all, we want you to walk away with a skill set and independently be successful in achieving your goals.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Good afternoon, happy Wednesday, and welcome to Next Gen Investing. I'm Alex Coffey. Let's take a quick look at where the market sits, as we were for a little bit there at least, and maybe still on all-time high watch for the S&P 500 on an intraday basis, which is just over 7,000. I think it's 7,002, maybe some change. Got really, really close. Did not quite eclipse it, but right now sitting up 21 points, which is about 30 basis points for the S&P 500. That is 69.89 and some change. Now, I should preface, if we were to close here, this would be a new all-time closing high. So that day that we did peak above 7,000, we were unable to hold on to that. But watching that intraday, you can see the Dow and the Russell stumbling here a bit, down 30 and 40 basis points there. The NASDAQ 100 continues to lead, up about 0.5%. Intraday, though, it's kind of mixed. You see a breakdown of the up and down stocks. It's only 45.55 up in the S&P 500. Flip that around for the NASDAQ 100. It's about 55.45 for the NDX. So something to watch there. As we take a look at the heat map, software stocks making a nice comeback today. You can see that bright green area down in the bottom left of our screen. But as we move on into what we're going to cover for the show, we'll go through some of our movers just in a brief moment here. We'll be joined by Sam to go through that. But Chart and Trade, Rick Ducat will stop by. We're looking at Broadcom and Meta on the heels of that expanded partnership that was announced. Bank of America will be the subject of FOMO post earnings. And then under 30, what a story. Allbirds completely flipping things over after offloading the footwear business. Looking forward to that discussion later on with Jeff Pierce, as they're now potentially an AI neo cloud player. So something to look forward to later on. With that, though, we'll welcome in Sam Vardis, the first guest of our program here, who's joining me live from the New York Stock Exchange. Sam, of course, is a host across our programming. Sam, good afternoon to you. Happy Wednesday yourself.
Let's talk some Uber. Uber is on the move higher here, 5.6% in real time.
Yep. Yeah, that's right. So one of the catalysts today seems to be this report out from the Financial Times. Alex, good afternoon to you, suggesting that it's going to spend $10 billion now on thousands of autonomous vehicles and also some equity stakes here in their developers. So really shifting, this is what the report is highlighting in the story here from the asset-light model that we're used to and the gig economy, which obviously we know Uber as. So a nice 5.5% pop here. The aim is to avoid disruption, they say, from robo-taxis. In fact, we know that the company itself doesn't see robo-taxis as a threat, but more of an opportunity here. And this is where some of the analysts that even I've spoken to have said they're expecting the next leg of opportunity here for Uber to take it another leg higher here if they're able to execute and pull it off. So Uber has really been positioning itself in this race. You could say the robo-taxis investing heavily. It plans to launch services in 28 cities by 28. That is globally. That's 2028, including Australia, Europe and Asia. And so it has been partnering with a number of companies as well. We know that, the Baidus of the world, the Chinese company, of course, Rivian, Lucid as well. A few weeks ago, remembering we learned about the partnership with NVIDIA as it's trying to get into the robo-taxi business, and it's doing that by the way of Uber as well. There has been a view that this could potentially be a challenge for the way of Waymo and Tesla as well, who are already trying to do this at scale. But I like the way that Axios has framed this today. As we see this race towards autonomy, a new big three in mobility is emerging. Instead of GM, Ford and Chrysler, it's Waymo, Tesla and Uber. And as far as where Uber sits here, I mean, there certainly seems to be a view out there that its superpower right now is that it's got this tech platform that exists already, that everybody is familiar with, that has been matching people with vehicles for years. So obviously this is something to watch if, of course, these reports do come to fruition. But speaking of investments, there's another story out from the information today, Alex, pointing to the fact that the CTO, so the executive behind the technology here, has basically been saying that the AI spending at this company is like blowing out the budget, basically suggesting that the company's surging use of AI and how much it's spending here, actually they've spent all their 2026 budget. We're in April already. So it seems like the software development is becoming a very costly reality for tech companies right now. And I feel like, Alex, that's going to be a really interesting debate as we move into this earnings season in earnest with particularly the tech companies, when we already know that they're CapExed up to the eyeballs.
Before we move on here, I think it's quite interesting, Uber's approach, because in many ways, and it's being rewarded differently maybe, but I almost see this as an Apple-like approach, where Apple knows the power it has within AI, given that it has such a device network, particularly in North America. It kind of scrapped its in-house plans and is elected to partner up and invest and be a little bit more of a kingmaker. I took it this way, it looks like Uber's sort of done the same, because they've recently scrapped in the last couple of years some of their own in-house plans, and they're almost becoming a kingmaker within this space, looking to find that winning horse.
Yeah, it certainly doesn't see it as a threat, as I mentioned. It very much sees this as an opportunity, and that really has been the view out there, that maybe Uber, similar to your example with Apple there, kind of has something that these other companies don't have. And that is, of course, years of customer loyalty and, a platform that people are very familiar with, that is already matching people up with, obviously, the ride-hailing business within the gig economy. But it's going to be an interesting transition, I think, from what has been an asset-light model. So I think, that's what everybody is watching right now.
All righty, and we're talking Marvell. This has been a stock that has been fascinating to follow. Under a little bit of pressure today, despite what's really been just an extraordinary run, Sam, and it actually got some pretty good news. What was it? Oppenheimer raising the price target pretty substantially, but not enough to keep what's been, a 5-day stretch and streak going?
Yeah, it's been up 5 days in a row, actually, as I've been reading. It's the longest winning streak in more than a year. So perhaps some coming off the table today, but this is obviously on a day where we are seeing chips broadly down across the board here. So I would say that maybe some of that is attributed to the performance we're seeing here, even as you say, Oppenheimer has come out and raised the firm's price target now to 170 from 150. They've kept an outperform rating here on the shares. This came off the back of hosting investor meetings with the company's management, I believe, over in Europe, and they've said that basically the tone that they've walked away with was unequivocally bullish, as the company highlighted accelerating growth outlooks led by networking and ASIC, which is obviously the customized chips as well. So the company is obviously doing this for Amazon. There's an expectation that it's going to start doing this for Microsoft as well in the second half of the year. But basically, this analyst is saying that it's well positioned, Marvell, because of its full suite of copper and optical products as well. Obviously, we've been talking a lot about that in recent weeks too. So you get a sense from these notes today, Alex, that the price action and this run up isn't really letting up anytime soon, even though we're just seeing a pullback today. But all in all, I mean, over the course of things, it continues to benefit, no doubt, from obviously the booming AI data center demand and the partnerships also that it's got from the big tech companies. And something that really stood out to me last earnings, Alex, was visibility. I think that really gave some of these companies a leg up if they were able to offer that and reassure investors about how much runway and visibility they had with respect to obviously projecting revenue in Marvell's case with nearly 30% for fiscal 2027. And so subsequently, we did actually see a rally off the back of earnings, which wasn't the story for every tech company last earnings. So let's wait and see. But I mean, that had been celebrated by the street at the time. I mean, as far as the sell side notes were concerned, I mean, the point that many were making was that the company was able to give visibility. And so I think that's really been a key story here. As far as what other analysts have been saying, I mean, if you look across some of the sell side notes just in recent days and weeks, I mean, you had Barclays upgrading Marvell to overweight as well, from equal weight, a price target of 150. Not as high as what we're seeing from the folks over at Oppenheimer, but I mean, they do believe that this is going to be an optical company with parts that are growing rapidly. The growth carries the name alone, they say, within that. Cantor Fitzgerald also saying the price target has been bumped up now to 120, so not as high as Oppenheimer again, but keeping a neutral rating. So they're, sort of sitting on the sidelines a bit, but they do say that it remains hot, AI, and everything else is not. So obviously, they do see this as a big beneficiary of what we're seeing here, particularly as we do see the demand backdrop as robust as ever, and valuations today are frankly disconnected versus the reality. That was the view from Cantor Fitzgerald. So, I mean, you do mostly have a bullish view on this one, but I think it's going to be really interesting to get more of an update this time around if they continue to sort of give that visibility in the guidance, which very much seemed to give this one a leg up.
Speaking of legs up, Cloudflare, NET's the stock ticker, making a nice move today. This after Mr. Fish, James Fish at Piper Sandler weighed in. A nice upgrade and some pretty nice commentary to go along it.
Yeah, that's right. So upgraded over at Piper Sandler to overweight from neutral, $222 price target here. Turning more bullish based on a few things here, Alex. Look, Cloudflare's infrastructure positioning across multiple growth opportunities. They see the first quarter 2026 inputs are solid, although they do expect the guide to be reiterated as normal. They do think that the pullback has helped the stock, so this is a good entry point perhaps. The firm has long viewed Cloudflare as one of their favorite sort of longer term stories, given where infrastructure is at. I mean, I know that obviously we've been talking about that a lot lately with some other names, but they're also pretty encouraged by Cloudflare's execution here. So they do see growth opportunities across a number of aspects. It feels like alphabet soup here, Alex, so bear with me. I mean, you've got AppSec, you've got NAS, which is the network as a service, you've got SACE, which is the secure access service edge, you've got IaaS, which is the infrastructure as a service, and also AI as a service as well. So they're pretty bullish, I suppose, across the landscape here. And the third point that they're making is also that what we're seeing is shifting towards more edge distribution platforms. It's called EDP. And that's where Cloudflare is seen as dominant here with their strong LLM relationship. So they're expected to continue to benefit from that. And I was reading exactly why that is. And basically what it's getting at here is that you've got modern apps like streaming, gaming, AI, Internet of Things, that really need real-time responses here. And these platforms process data closer to the user, so cutting round-trip time dramatically. So that's where it's benefiting. And this does have high expectations that likely need to see growth compound in the next few years. But the confidence is being driven by the RPO growth and coverage ratios, according to the folks over at Piper Sandler. So, yeah, a nice reaction off the back of that. No doubt it is helping give it a leg up today.
And finally, we talk Snap, as this unfortunately is becoming more common news with some of these bigger tech firms looking to cut or planning to cut approximately 1,000 jobs. I think I saw, representing about a sixth of the workforce globally. And then we got some guidance updates alongside that as well, Sam.
That's right. So this is the latest tech company basically to go leaner, Alex. And yes, you're right with those numbers, about 1,000 people. It represents about 16% of full-time staff. North America employees were apparently asked to work from home today. Obviously not a great thing when you hear about headlines like this. So we're seeing a subsequent reaction pop to the upside because obviously they're going to be able to free up some cash here to do what they need to do. In December, it had about 5,200 full-timers. Over the years, full-time employees have been shrinking. I was actually looking at a chart. There was about a 20% reduction in 2022, roughly 10% of cuts in 2024. Then we actually saw a bit of a ramp up, but this will also include the closure of more than 300 open roles as well. It does talk about advances in artificial intelligence, which is helping it become more efficient and basically need less manpower. I mean, that's the story. That we've heard that from a number of companies. This is not a Snap story, but AI is generating more than 65% of new code, they say. So it's a phenomenon we're seeing across tech at the moment. It does expect to cut more than $500 million in annualized expenses in the second half. It does come off the back of activist investor pressure, it seems, to improve things at this company. So Irenic Capital Management calling for broad cuts here. Part of this has also been directed towards its augmented reality glasses. So it's been urged to spin off or shut the business down as it's burning cash. But, you know, I was looking at some of the sort of analyst commentary. I mean, Reuters, for instance, with a quote saying this from an investment director: cutting costs may appease an activist in the near term and give a long-suffering shareholder some relief. But whether it really leaves the company with a defensible business model and competitive position it can defend, develop, and turn into profits and cash flow is unclear. So I think that's just where things are at right now. But yes, revenue growth. Things have slowed down over the last year or so, even though it does still expect Q1 revenue growth to rise about 12%. But that doesn't stop the rising competition that it continues to face. I mean, you know, from Meta's, Instagram, Facebook, for instance. I was looking across shares of Snap versus some of the other social media companies. It is the laggard. When you look at Pinterest, Meta, Reddit comes out on top. So I think that just goes to show where it sort of stands in the market right now.
Yeah, and I always have thought the comparison to Pinterest is so interesting. It's like they both have their own struggles, but they're the opposite struggles. Snap has never had issue with users. It's had issues with the ads didn't make sense with the experience. If you and your friends are exchanging communication, an advertisement in the middle of it doesn't make a ton of sense. Where on Pinterest, they had trouble getting different demographics and expanding users. But once you're on there, the ads are the whole point. You're trying to find ideas. So super interesting space. Meta, of course, the holy grail that sort of figured it all out. Sam, any final thoughts before we say goodbye, as we're kind of on the precipice potentially here of a new all-time high?
Yeah, I'm just looking at that big board, Alex. I mean, 7,002.28 is the number we are watching. I mean, you know, you just look at the headlines today, and a lot of them have been, what war?
I mean, Ed Yardeni out with a note today saying that as far as the stock market is concerned, the war is over until further notice. Look, I know that's not true, but that's just kind of how it feels right now. I mean, look at the NASDAQ, the longest winning streak since 2021. The IGV has been pretty remarkable this week, up 10% as well. I would focus on the dollar as well. Not many people are speaking about that, but nearly all the gains wiped out since the war. I mean, this is a 6-week low today. I was looking, it's down for an 8th straight session, on track for its longest losing streak since April 2011. So obviously the Dixie is back to where it was before the war, rising 3% as that relative safe haven trade and bid had been baked in here. But yeah, look, I mean, people that I've been speaking to today, a lot of my guests have this sort of cautious optimism right now. I had a note out from a trading desk last night that was saying they wouldn't be surprised if we do see a bit of a pause and a drift short term, and that is largely because I should say parts of these markets, I was talking to Nate Peterson about this earlier today, about some of the bear traps. They do look a little bit stretched. I mean, particularly if you do look at the SOX index, up 30% from March, from the low there, 10 trading days, taking a look at some of the 7-day, 14-day RSIs here. So things are looking a little bit overbought, but something to watch, and no doubt we have that eye on that 7K mark right now, Alex.
Yeah, no doubt. We're really close, 5 points or so from the all-time high. But Sam, should we be surprised that the market bounced back? Like, why are we always surprised when it happens like this every time around these geopolitics and wars and military actions?
Yeah, good question. I think from what I'm getting from the conversations, it's the pace of how quickly we got here and in what fashion. Because obviously you had this feeling that, you know, everything was being thrown at this market at the same time, and you had the private credit concerns, you had the AI disruption fears, etc., and nothing really, this is the conversations that I'm having with the traders and some of my guests, has fundamentally changed about this war since perhaps last week. I know, of course, we've got the US blockade, but we're going into a potential another round of talks. We know what came out of the talks last time. I mean, they were failed discussions, but there seems to be a lot of optimism that maybe, Ed Yardeni was actually pointing this out earlier this week, we're just getting used to obviously this kind of being in the background, so to speak. I mean, particularly if oil prices continue to stay off those triple-digit highs. I mean, 91 on WTI right now. I mean, he was making the point that we kind of learned to live with Ukraine and Russia. Now, I'm not saying that's the case with this one, because people are saying that this is the biggest energy shock we've seen. But for now, the data also seems to be holding up, Alex, and the fundamentals as well. I mean, the data doesn't look too bad. The input prices didn't come in as high as expected today. The PPI didn't come in as high yesterday. I mean, that's giving the market some comfort. And the fundamentals, as I mentioned, now we've got some meat on the bone to chew on, are showing that the banks are saying that, okay, the economy looks resilient for now. I think that's a bit of a tone setter for the rest of the earnings season. That's sort of my takeaway.
Yeah, no, I mean, and Sam, when we were doing market on close, I've been saying, and I feel vindicated now, the market's been looking past this for a couple weeks now, and now we just have other stuff to talk about with earnings and things kicking off. But looking forward to another edition of Market on Close later with you and Marley, so make sure to stay tuned for that in a couple hours. Sam, thanks as always. But that's going to do it for the top of our show here. We're going to take a short break. We get back. Rick Ducat's going to join us. He's lead market technician for the Schwab Network. We're going to chart and trade two stocks on the move today that are tied together, Broadcom and Meta Platforms, right after this.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Intern, this place is incredible.
It's where I get all your office supplies.
Your golf balls,
Your fancy coffee, your giant TV.
it's everything in one place. It's like
Schwab. Everything investors need, all in one place.
Come again?
Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between.
Think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. I'm Alex Coffey, now joined by Rick Ducat here alongside me in our Chicago studios for our Chart Master segment. And Rick, it's been a few months, depending on the index, before we've hit all-time highs. And granted, we have not done that just yet, but we are awfully close. If this number over my shoulder here reads 7,002 and 29/100ths, we're at a new all-time high.
Yeah, I mean, exciting time. It's interesting, too, when you do start to get these breakouts above a old high water mark. It can be an energetic reaction as the traders are overwhelmed, the cascade of orders triggers, and you get a runaway price activity here. Certainly not saying that's going to happen. Just that's a common trading situation that many folks look out for.
Also, not a complete surprise, maybe, and look, this is a one-day, one-minute chart. These can be very dramatic, but this point was essentially 7,002. It was just below that. Is it also not uncommon to kind of see a reaction when you approach those all-time highs as well?
You can see it. It can take a few tries to actually fully punch through that resistance level. Oftentimes, that's why technicians will advise to wait for the close before you start making any hasty trading decisions, especially if you're trading based on indicators. There can often be fake outs based on intraday swings. So, it's okay to be optimistic, but just don't be uncautious, I guess is what I would say.
Yeah, and this would be a new all-time closing high, so it's important that we're talking intraday kind of spike highs here. 7,228 is the former high. We'll see if, or current high, we'll see if we can eclipse that intraday or not within about 7 points or so. Let's get to our regularly scheduled programming here, though, with our chart and trade segment, as we're discussing two names, Rick, that are tied together today upon an expansion of partnership, starting with Broadcom, big time, custom chip maker and more within this AI infrastructure build out.
Yes, to be sure, and an interesting situation we find ourselves in from a chart perspective here. The reason I say that is because we have now filled this gap that developed here shortly after earnings that we saw all the way back in February. So after that decline we had our downward sloping trend line here in blue that has since been broken here. We've seen a pretty steep rally to the upside, but now a bit of a question mark here. So we've hit this gap level. Now will we follow potentially the broader market as we were saying, if it does lift into new highs? It seems like just a general resurgence of strength for many of these semiconductor related stocks here. And if we were to keep traveling upward here, our old highs come in 414.61 here in this area. One level to look out for potential support if the move does falter, 382. Why? Because that was an old high that we saw after the gap down we were discussing earlier, and that's about where we formed another gap just during our last session here. Beyond that, 361, old highs, and then a breakout point as well. So when we look at our moving averages that we follow in this case, our 5-day EMA in dark blue is the one that's the closest to our current price activity, a bit shy of 375 or so. The other moving averages are quite far below our current price activity here, but you can see they're starting to tilt upward. The faster ones are starting to cross above the slower ones. They're continuing to diverge apart from each other. So that is all things that you would want to see if you were bullish in this name here. Look for the reverse to happen for signs of potential trend change, for the moving averages to start shifting to a downward slope, for price to start closing below them. RSI overbought, 75.9 at this point here, upward trend line still in play. A long downward trend line you could have drawn in red has pretty compellingly been broken at this point here. So an interesting setup to be sure as we approach the latter half of this trading week. So now we can also see a smaller volume node here near about the 375, 380 level or so. A little bit of activity up here near 400. But really most of the trading activity by far is contained here between about 320 to 360 roughly. Our point of control coming in near 336. So that's really the standout level. It's a notable crossover that we've managed to stay above that point.
Yeah, good stuff, Rick. Hang tight. We're going to get to Meta in just a moment, but a quick example trade for Broadcom, looking for a continued move. Now, this is a later in the earnings season reporting stock, so staying ahead of the next quarterly update. But say you think there's just going to be a continued run back towards those highs, and what I looked at here was a 4:15 call calendar. It is selling next Friday's April 24th expiration and then buying the following Friday's May 1st expiration, both 4:15 calls. Looking to spend around a $3 debit, maybe more than that, maybe less, depending on market fluctuations over the last couple hours. That said, if you were to, whatever debit you get for an example like this, that is your risk on this trade. You see that on the upper right-hand corner of that risk profile, $300, which coincides with that $3 debit. We talk about this risk profile all the time. These shaped risk profiles, kind of like a mountaintop, and they peak out at that strike. So they're customizable. They can be moved around depending on your degree of bullishness or bearishness or neutrality around a particular name, but they are risk defined, and in this case, looking for a move back towards 4:15s. We bring back in Rick and discuss Meta. So the other part of this deal, Rick, the excitement for Broadcom, was, well, they got a big spender that continues to spend big, and that's Meta, as they're locking down some of these different chip sources as they're trying to, I guess, kind of wean themselves off NVIDIA and AMD. But Technicals cuts through all that noise and just tries to focus on price. So it looks like we're approaching some sort of resistance level.
Yes, and a chart that doesn't look quite as strong as our last one, but is enjoying a similar, very steep rally to the upside here. The level of resistance in question here comes in around 680. So if we were to backtrack, we can see that was a point of lows, a notable high point after an earnings gap down in late October here of last year. And then we had some trouble making it above that area here after the last earnings event that catapulted us upward. It quickly died down and once again became a resistance point. Now we find ourselves at the same area once again here. So one area to watch to the upside may be this intraday spike that took us above 710, or perhaps for the gap to be filled here near about 741. Meanwhile, to the downside, our green lines here, 620, another gap level, another moment of support before a breakdown here, and around where we solidified after a push to the upside once more. White upward sloping trend line is still in play as well. Again, a rather steep, sharp trend line here. The sharper a trend line, the less sustainable it typically is here, but that doesn't mean there's a time limit on it, just a general point of consideration to make. So now we can see a different picture for our moving averages here. In this case, now we're seeing price crossing above all of our 4 moving averages in pretty quick succession here during the past couple trading weeks. Most notably yesterday, a strong close above the 250 one-day EMA in orange. That one presently comes in right around 646 right now, so that's a notable downside level to watch for potential support. It also coincides with our 5-day short-term EMA, also roughly with that trend line too, so a bit of a confluence there to watch out for. RSI on the move to the upside here, but a little bit shy still of that 70 threshold that would represent the overbought area. But again, like our last chart, downward sloping trend line on the RSI has been broken. We also managed to make our way out of that oversold area here. So across into the overbought area, along with price making new relative highs in tandem, would be what the bulls would want to see in general. So now finally, our volume profile study shows that we have our point of control here near about 657 or so. We are managing to stay above that level. A bit of a gulf in this area here, and then things start to pick up again from 700 to about 720.
Good stuff. Rick Ducat, lead market technician for the Schwab Network, breaking down to the big movers over the last few years, but tied together today. As we look at an example quickly here in Meta Platforms, looking for a test of 700. So many things converging at that point: volume nodes, trend lines, etc. Even if this is just a counter trend rally, 700 could be a target. And so, looking at a call butterfly spread, looking for that to happen, perhaps by next Friday. It's the 700 call butterfly with $10 wings. So 690, 700, 710. Looking to spend $1. You risk $100. Chance to make 900. Break evens at 691 and 709. So need a move up to that point. And it's another one. The closer you are to that short strike, the better. Thanks again to Rick. We're going to take a short break. When we get back, time for FOMO. And today, Bank of America is the topic of discussion. Marley Caden will join us, and we'll discuss BAC right after this.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Pop. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to Next Gen Investing. I'm Alex Coffey, now joined by host for the Schwab Network, Marley Caden, for our FOMO segment. And today we're discussing Bank of America, BAC, the ticker. Now, financials, they don't elicit oftentimes this FOMO feeling, but the moves that they've, some of them have had maybe do. Nice little rally here for Bank of America, up about 2%.
Yeah, they've almost completely erased their losses year to date with this move to the upside on some good numbers. I mean, comparable numbers to some of the others we've seen from the big banks reporting. But let's walk through these numbers and we'll draw some correlations here from the other banks that we've seen already. Their first quarter profit and revenue rose more than expected. They had strength in similar areas we've already seen from the other banks, particularly in their trading businesses. Earnings were up about 17% to $1.11 per share. That was about a dime better than the estimate. Also its highest EPS in almost 2 decades. Revenue was up more than 7% to $30.43 billion. That was also better than expected, of course, boosted by that higher trading revenue, fees from investment banking, and also asset management and rising net interest income numbers. Now, their equities business saw their revenue soar 30%. That went up to about $2.83 billion, Alex. That topped estimates, helped drive their trading operations to its best quarter in about 15 years for the bank. Of course, a lot of that tied to the recent volatility with the Iran conflict, which is not something that we haven't seen from the other banks that have reported as well. In terms of global markets, revenue up 8%. Sales and trading revenue surged 13%. That was to a record $6.4 billion. Revenue for fixed income, though, was up 2% to $3.5 billion. But like rival Goldman Sachs, they also had a slight miss. That did come in below expectations by about $330 million there for fixed income, which is a different picture than what we got from Citigroup. So some differences.
And Morgan Stanley.
And from Morgan Stanley as well. Also, they cited an easier regulatory environment helped boost their merger and acquisition activity, a 21% increase in investment banking fees as well. An important metric for them, but B of A is the second largest lender in our country. They saw their net interest income increase about 9% to $15.9 billion. That beat expectations. They say that was due to higher loan and deposit balances, fixed rate asset repricing, and markets activity. Also important, they projected that their net interest income growth would be between 5% and 7% this year. They upped that today, now saying it'll be between 6% and 8% due to that outperformance that they saw in the first quarter. Also important, their borrowers don't seem to be struggling. They posted a $1.3 billion provision for credit losses in the quarter. That was lower than the $1.5 billion provision in the year earlier period, and also about $190 million below estimates. Brian Moynihan went on to say that, of course, they are watching risks, but they, quote, saw healthy client activity, including solid consumer spending and stable asset quality, indicating a resilient American economy. So a bit of a tone change from some of the other reports that we've gotten. You know, we had, of course, Jamie Dimon's famous cockroaches comment that sort of led itself to all of us talking about that. But even their net charge-off ratio, that's a proportion of loans that were deemed unable to be collected, that also improved about 6 basis points during the quarter. And their consumer banking and global wealth divisions each gained more than 20% in net income overall.
Yeah, really, really incredible. As we talk about this stock erasing its losses, we are within a quarter point of a new all-time high. We're about to potentially make that in real time, and Bank of America is playing its role. It's the 13th biggest contributor to today's rally. Now, granted, Microsoft, Apple, Tesla, they're certainly punching above their own weights here today, but Bank of America, a part of that story if we do see that, Marley. But all in all that's going on, we're potentially going to be talking all-time highs. We got earnings coming through, and it just tells a different story than the headlines.
It does, and I've been having this conversation with our guests all day long. Is that, you know, we're a breath away or a stone's throw.
We
or
just
within,
got it.
Oh, we hit it.
7,200.
We're over it.
7,002.8.
So we're over it.
We got a new all-time high officially in real time, and you know, I was talking about this with Sam on your program actually when I was filling in. I was saying, hey, the market is showing signs that it's looking beyond this. Whether or not that's right, whether or not it should, it doesn't really matter. It made us a pivot 2.5 weeks ago, and it hasn't looked back. And the market started to, you know, carry on after. Crude oil took a second, but it's starting to join. But we're at a new intraday high for the S&P 500. This is the benchmark for risk assets worldwide, particularly in the U.S. But you think about just primary investment vehicles, how many things are built around this? The best that's ever been in terms of price.
And Jim Urio I was talking to earlier on Trading 360, and he made some similar commentary. It's not necessarily supported in logic what we're seeing, but the markets have decided that they want to rally, that the situation in Iran is essentially over, and they want to move higher. He also cited some data points that he says he thinks the labor market has a leg to stand on, so some less concerns about stagflation here. And he said, you know, the markets have made their decision. Whether or not it's rooted in logic or there's a crystal ball we don't know about isn't for him to decide, because the markets have decided, and that's what's happening.
Well, and it's not uncommon. I was talking about this with Sam just a moment ago, you know, when she was on at the top of the show. Like, seemingly every geopolitical conflict we do this, we sell off dramatically. When we think about 2022 and Russia and Ukraine, and granted, I know the U.S. wasn't a direct participant in that, but it was then still not solved. It's still ongoing. I don't know how many years later, 4 years later, and the market just recovered and moved on. And it's not to say that these aren't impactful. They absolutely are. You know, you don't want this to happen, but financial markets are resilient and they tend to adapt. And I think we're seeing that in real time, combined with the fact we're about to embark upon a tech earnings cycle with tech valuations. In some cases, some of these mega caps like at Broadcom, 25% forward earnings haircuts. So I think it's a really unique time to assess some of these fundamentals as we get any final thoughts.
It's a unique setup, and I think the timing is an important thing that you mentioned, too, because if we had tech earnings a couple weeks ago, I think we'd be in a very different scenario than where we are right now. It's almost like taking a look at B of A today and Goldman at the beginning of the week. We had a different setup to start the week. We saw Goldman move lower on arguably equally impressive numbers, but we see Bank of America moving higher today alongside the rest of the market moving higher and hitting an all-time high.
You know what, one thing that seems to connect everything right now? It's AI. And AI is playing a bigger and bigger role. So with that, we'll leave it. As our next conversation, we'll expand more upon that. We'll be talking about AI adoption trends in businesses worldwide with our next guest right after this.
Aw, she's got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing on this new all-time high, intraday high for the S&P 500 day. We welcome in our next guest. That's Ara Karazian, an economist at Ramp, to discuss what's been a big part of the market story for the better part of the last 3 or 4 years, which has been AI and its adoption. Ara, first off, happy Wednesday. Thanks for joining me. And you know, your data shows that U.S. business adoption of AI just crossed 50%. Seems like a meaningful number. How do we get to this tipping point?
Alex, thank you for having me. You're right. So this data comes from Ramp. It's a business spend platform. So it's actual money movements by businesses. This is actually a new way of measuring AI adoption in the United States. It's, typically, this kind of measurement is done using surveys. What we found time and time again is that businesses tend to either underreport their actual AI adoption, or that those surveys just tend to be unreliable based on who the survey provider is actually calling. So when we actually looked at the contracts that businesses were signing with companies like OpenAI or Anthropic, or the more verticalized software solutions, we found that there was a significant run-up in AI adoption in 2025. Now into 2026, we've crossed into 50% of businesses have adopted some sort of AI solutions. But even within that, much of that spend is still experimental. It's still small scale. It might just be some kind of enterprise chat subscription for employees. There's a relatively small share of businesses that are using it already for some kind of high intensity purpose that's actually going to drive productivity gains.
You mentioned OpenAI. ChatGPT kind of had that first to market moment, or at least the first really mass adoption type model. I don't know how many years ago now, let's call it 3. But you mentioned Anthropic as well. And now it seems like it's all about Claude. Is that gap still meaningful between those two, or is Anthropic closing down any lead that OpenAI may have had?
You're exactly right. You've identified the main competitive feature of this market right now. So there are 2 major players, OpenAI and Anthropic. OpenAI is still the most popular model at businesses. It's used by the most businesses. In large part, that's because it was this early mover that started with a lot of great consumer success with the launch of ChatGPT at the end of 2022. But the big change over the last year, particularly actually over the last 3 or 4 months, has been Anthropic, which has now seen not only rising adoption, but accelerating adoption, to the point that our latest prediction is that we believe Anthropic's models will now surpass OpenAI in business adoption within about a month or so.
And is that because the early adopters and VC-backed firms that are kind of in this world, everybody kind of follows their lead, or is it a superior product, or what makes you think that Claude is starting to not only catch up, but potentially, pass and, supersede what OpenAI has been able to do so far?
Well, when we think about what drives AI adoption, I would point to a few things. One is going to be the sector. So there are a couple sectors that were always early adopters to AI. In many ways, AI was developed by and for these sectors to begin with. So the software sector is one, practically ubiquitous adoption of AI in the software sector. Finance, professional services, these are the sort of knowledge work tasks that were early beneficiaries of AI. So these were the types of sectors that were first on this kind of technology. So they're already going to be the early adopters. These are also the sectors that are now increasingly likely to choose Anthropic first. In fact, Anthropic's models are more popular already in the software sector than they're likely to use ChatGPT. And that is reflecting Anthropic's distinct strategy here. Anthropic did explicitly target these early adopters and these evangelists and target a more enterprise strategy rather than OpenAI, which for a long time was greatly consumer focused. Interestingly, now we're starting to see these reverse. So Anthropic is becoming a little bit more consumer focused, launching tools like Cowork. This is a version of Claude that is geared toward less technical users, so you don't have to use it in the terminal. You can use it as you would, any typical software directly on the web. And then OpenAI is investing a lot of money into its enterprise features. So its competitor to Claude Code, that's the engineering product, seeing a lot of investment from OpenAI today. So you're seeing both of them kind of try to adopt each other's strategy. But right now, it's been a great year for Anthropic. The idea that this company, which is still significantly smaller than OpenAI, has a lot less funding than OpenAI, is now likely to become the most popular dominant model in business adoption is not something anyone would have predicted even 6, 7, 8 months ago.
Now, and correct me if I'm wrong, my understanding, and I imagine in many large enterprises, kind of integration through Copilot systems is probably a primary way that some of the official use of some of this is, and where a lot of that spending is. That's still OpenAI, at least adjacent, right? A lot of the GPT platforms, the ones powering things like Copilot.
Exactly. Copilot, Microsoft's offering, often powered in large part by OpenAI's offerings. And also Google's Gemini. So Google's Gemini probably has a significant amount of adoption that most people don't even realize. It's just directly integrated into tools like Gmail and the Google Workspace. Most businesses don't even have to pay for it. It's integrated directly for free into the product suite. That said, these are the kinds of AI investments that are very unlikely to drive actual productivity gains. When we talk to businesses, these are the kinds of integrations that aren't typically connected to a lot of the tools that workers have access to. They don't connect to a lot of the company's data sets. They don't connect to a lot of the financial systems. So if you go to a firm that's just using out-of-the-box Gemini or Copilot, it's really just a chatbot that's available to some people. Something that, it's maybe going to be helpful for me on some admin tasks, but isn't really the kind of investment that's going to drive productivity gains for a broad set of workers. So we like to focus on the paid adoption, often that going through APIs or agents, something that can directly integrate into a worker's daily workflow. That's largely coming from investments in Anthropic's tools.
All right, let's take one step back, kind of a final wrap-up point here. I talked about maybe 3 years ago is that kind of ChatGPT moment to where we are now. You've been monitoring data throughout. We hit this tipping point. We're watching this gap between that first player really just being narrowed quickly in real time. What is all of this that we've discussed and all the data that you're, assessing and analyzing really tell us about where the moats in this space really are? Because a couple of years ago, it would have seemed like OpenAI was untouchable, and I'm hearing a very different discussion point from you here in real time.
I mean, this is an extremely competitive market, and one that I don't think most analysts are used to. The idea of an upstart challenging a large incumbent is not new, but the idea of that happening and taking so much market share within 6 months is extremely new, and that is a unique feature of the AI landscape that we're in. And we're not just seeing it in the foundational model companies. There's a lot of software companies that are now AI native, that are built on top of these models and directly integrate these AI models, that are challenging legacy providers in software. So look at CRM software. So a player like Salesforce still controls about 80, 90% of the market for CRM software. But you're increasingly seeing AI native software rising every month, maybe 1 to 2 percentage points in business adoption, which is massive. You can think maybe in a year, we'll see one of the biggest players won't be Salesforce anymore. It'll be one of the sort of AI native players. So you're seeing the same thing play out outside of the main model companies into other parts of the software stack.
I love that you point this out the way you did, Ars. We gotta run, but I've been saying that is it really from an investment standpoint. It changed the thesis for a portfolio manager looking at something like a Salesforce that was so consistent and had such a strong moat. You just can't say that with the same level of confidence. Now, it doesn't mean that they won't reestablish it. you just can't say it now, and it's reflected in the volatility of some of these software names. But fascinating conversation. Would love to chat again soon. Ara Karazi, an economist at Ramp, with some really interesting AI adoption data trends. And with that, we're going to pivot to something that is beyond interesting and extraordinarily unique as it's time for Under 30. We're discussing, I guess, what was formerly known as Allbirds with our next guest. That's Jeff Pierce, Senior Manager of Derivatives Trading at Charles Schwab & Co. And I can't think of a better guy to discuss this. I had to refresh the news feed a couple times, Jeff, to make sure that what I was reading wasn't some type of gag, but all the power to him. I guess we're selling footwear and we're pivoting to GPU as a service. I mean, Neo Cloud is the name of the game for Allbirds.
That's right. Yeah, one of the more bizarre stories I've seen in some time, and the stock is reacting to it. I mean, it's up, around $16 now. Was up above 24 intraday. Those are levels we haven't seen since early 2024. But you're right. They've announced that they're exiting the footwear business and pivoting into the AI compute infrastructure business. They plan to rebrand as New Bird AI, and management says it signed a $50 million funding agreement with an institutional investor. Proceeds are expected to fund that move into AI infrastructure. To your point, their goal is to become GPU as a service provider, also offer AI native cloud solutions. A couple things need to happen first. The financing and transformation will require that shareholder approval to vote, or at least a meeting is scheduled on May 18th. And there's not yet a detailed operating plan showing exactly how they're going to execute that business. And at the same time, they are selling that shoe business to American Exchange Group for about $39 billion. If completed, the footwear business will, of course, go to the buyer. But the public company shell remains and becomes that new AI business. So management says shareholders should expect, if that goes through, to receive a special dividend as well.
All right, Jeff, let's take a step back. I mean, I think you beautifully laid out what was potentially going on here. Really almost a micro cap stock now in terms of where it once was. I think it had like a $4 billion valuation at one point. It was $50 million or something is what they're selling the shoe business for if everything goes through as suggested. But what does this tell us about where we are? Because I just spent the last 50 minutes talking about how valuations have started to come down. Things look healthy. Is this blockchain ICE-T 2.0 kind of situation? Is this the AI data center jump the shark moment? Or is this just where the opportunity is and this management team thinks they're going to capitalize?
Well, I certainly hope the management team thinks they're going to capitalize on it, but I do think we've seen this before, right? And you mentioned crypto blockchain. I mean, we've seen several struggling companies attempt to go after those kind of popular themes. And initially they do get a pop from it, but can they sustain it is the big question. I mean, if we look at this company, it's not just the pivot to AI, right? That is certainly a big question mark. How are they going to be able to do it? But another big question mark is this $50 million in funding seems large relative to Allbirds. But when we think about these other companies that are in the AI infrastructure industry, 50 billion is a very small amount of capital. Major AI players are spending hundreds of millions to billions of dollars. So it really raises the question of whether or not they could be competitive, even if this transition is executed, extremely well.
Good stuff. Hey, Jeff, I have to ask you as well. All-time highs, S&P 500, really exciting. But you read the headlines, you read about the fear and the uncertainty. Two things don't jive. I guess, do we just defer to price?
Yeah, I think that's, as we look at, obviously the market is, not the economy, right? That's something to keep in mind as we talk through this. But as we look at that macro picture, those fears, as you were talking about before, a lot of, traders and investors have been able to push through these concerns, especially when we see this volatility built in where every day could make a change into the market. So we're continuing to see investors hedge and protect themselves, but also want to take advantage of that volatility. And I think that that's what we're seeing here in a lot of this price action.
Really, really great discussion, a unique day and a unique story, to put it lightly. Jeff Pierce, I always appreciate it, Senior Manager for Charles Schwab's derivatives trading team. It's going to do it for us here on Next Gen Investing on a new all-time high day. Make sure you stay tuned for additional programming throughout the day. We got the watch list coming up next. We got Market on Close later on as well. We'll see you tomorrow.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time, and we have hit a record here on Wall Street for the S&P 500. We have a lot to go over, and we are live on the floor of the New York Stock Exchange. A big show for you today. We're looking at tech and the recent rebound that we've been seeing. The NASDAQ 100 is on an 11-session winning streak, and the index is now up 3% for the year. Our panel will take a close look at what's next for some of the defense stocks, looking at the U.S.-Iran conflict as folks continue to weigh on the market. And in our big move segment, Tom White is standing by, and he'll look at real options trades for Nike, ServiceNow, Lam Research. So we have a lot to watch. As I mentioned, the Nasdaq up 11 days in a row. It's up about 14% in that time. The S&P crossed 7,002 and hit 7,003 to make a new all-time intraday high here. Right now we're at 6,996, up 28 points. The Nasdaq 100 up almost 0.75% at 26,012. The Dow Jones Industrial Average down 160 points, and the small caps, the Russell lower, just fractionally. Oil and gold are mixed. Gold's down $36 and oil's at 92 bucks. Here is the heat map here as I take a look. You can see most of the Mag 7 names have been in the green today. Really exciting as we take a look at some of these Mag 7 names, right? NVIDIA is up 11 days in a row. We have the Icing launch, which is a huge move there, and quantum stocks are moving higher. We've had news on Microsoft with its best day of the year. Amazon on the heels of the deal that it had yesterday to acquire Globalstar. That's also been a winner. So there you go. And Meta and Broadcom have a deal today. So much underway. A lot of red there. Other names, I see Caterpillar, GE, Johnson & Johnson, which came out with some numbers. Some of the consumer staples names, Western Dig. We're going to be talking about some of the memory names later. I see Seagate also lower. Micron, another name in the red. 2 hours until the closing bell rings, and we have a lot to take a look at. So let's go through some of the market moves here on Wall Street. Joining me right now, Diane King Hall, taking a look at some names that you should be watching, including Uber, which is now really betting big on autonomous.
It
right?
is, and you kind of have to now lean into that because that seems where the future is when it comes to transportation. So shares of Uber rallying big on this news. That stock right now up about a little bit more than 6% right now. So huge move there in Uber. Those shares sitting above $77 now as it shifts away from an asset-light model. This is based on some reporting from the Financial Times that the ride-sharing giant will commit more than $10 billion towards autonomous vehicles. And the way this is being broken up is they would be earmarking about $2.5 billion for equity stakes in autonomous vehicle companies. So in other words, they wouldn't be the front runner in those. They would be, supporting the push of development in autonomous vehicle companies. Another $7.5 billion, though, is earmarked towards scaling their own fleet. So what that means is it's a shift away from how Uber has traditionally operated. They're asset light, meaning you're the driver, you bring your vehicle onto its platform, and so it doesn't have to deal with all the costs of upkeep and whatnot. So this is a cost factor that would come into play for Uber, but Wall Street still seems to like this idea. The fact that they are leaning into autonomous vehicles is all about the robo-taxis. It's become a significant idea within mobility right now. And so when you think about Uber's biggest cost that they do deal with is the payout to drivers. So this would pull the driver out of the equation and leans into autonomous vehicles becoming commercially viable and Uber figuring out its positioning there, Nicole.
Yeah, and they're going to use some of that money. They're going to be partnering with Lucid, purchasing 35,000 vehicles, also working in Europe with some other names, WeRide and
That's right.
Baidu and Pony, and then expanding into the UAE and Europe and London. And so, hey, you're rolling on something big here at Diane King Hall. Okay, next up, let's take a look here at the expanded partnership with Broadcom and Meta.
Yeah, listen, and this is giving a tailwind for both stocks here. This is a deepening of their relationship. It's a multi-year, multi-generation strategic partnership between the two parties. These are heavy hitters in the AI arms race. So we're looking at shares of Broadcom. Those are higher right now by almost 3% at the moment. Meta also gaining some ground today. That's stock up almost 1.5% right now. It's not a one-off supply deal. Basically, it signals a long-term roadmap for this partnership through 2029. So we know Broadcom often trades on AI networking and custom silicon momentum. So investors are focusing on the duration and scale. So they like the duration of this. This is longer term than just a year. This is longer term than just 2 years. We're going out towards the end of the decade here. Meta, we know, is one of the biggest AI spenders in the world. It had been penalized at times times for its spending, but Meta is committing billions to, or it usually means that Meta's committing billions to future CapEx, but this is about infrastructure here. So this is leaning in on the next level of the AI arms race. We often talk about NVIDIA, but Broadcom has obviously been a significant competitor in this space, Nicole. So networking we know is important.
All right, and on an upswing here is Snap, parent of Snapchat. There's so much going on here, and I did see BMO with an outperform rating now and a $15 target. It's at $6 right now for Snap because there's also some news on layoffs.
There is, yeah. Listen, and this is about cost efficiencies. Obviously, you know, you can't ignore that the challenges this brings to those who would be affected by it, but they're taking the hatchet to the workforce here with plans to cut about 1,000 jobs here, what translates to roughly 16% of their workforce. They're also eliminating some open roles they plan to hire for. Management said this is part of a broader restructuring to become more lean, to become more profitable. This is all about cost cutting, becoming more efficient, and leaning into AI. Snap believes AI can reduce repetitive work, speed up product development, and improve efficiency here. So the company is targeting more than $500 million in cost savings by the second half of this year. So the cost savings will come later this year. AI is already being used internally, Snap has said, generating, they said, more than 65% of new code. Their AI tools handling over 1 million queries per month, Snap says. And management says they've been using smaller teams rather, have been utilizing AI for both its subscription product, Snapchat Plus, its advertising platform there, and then overall efficiencies, Nicole.
Incredible 1 month. I mean, just April alone, up 30% for Snap. I mean, I didn't realize or put it together, but on the 31st of March, we did see that activist investor Irenic Capital did build a stake in Snap. And actually, at that time, in the article, it said they may have to do some more streamlining. They may have to do some layoffs. And here we are talking about 16% of the global workforce that will be laid off. So, you know, hindsight's 2020, but a 30% move since that note came out. Diane King Hall, great to see you.
Great to be with you.
Thank you so much. Good luck there. Coming up, we're going to spotlight tech, hardware, software, the debate within the tech sector that you need to focus on. The NASDAQ 100 is on an 11-day winning streak. Did you expect that? And still to come, big moves. Tom White is standing by with real options trades for Nike, ServiceNow, and Lam Research. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our Investing Webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at schwabnetwork.com.
Intern, this place is incredible.
It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV.
It's everything in one place. It's like
Schwab. Everything investors need, all in one place.
Come again?
Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between.
I think I'm gonna be sick.
We have to buy that now.
Schwab.
Invest your way with Schwab.
Welcome back. We are here on the watch list. We're taking a look at Allbirds, which is pivoting from footwear to the AI space. The company said on Tuesday it will sell its footwear business assets and has struck an agreement for $50 million in convertible financing to acquire GPUs, with the goal eventually providing AI infrastructure services. It had struck an agreement for $50 million convertible financing facility that would allow it to achieve this long-term vision of becoming an AI infrastructure provider. Did you see the shares? They're up 700% right now as we speak. Do you own that stock? BIRD up 708% right now. You know, call it an AI company, and there it is. We continue to go deeper on our tech spotlight. Lisa Schreiber, Associate Portfolio Manager, Gradient Investments, is joining me right now. Good afternoon to you. We think about the NASDAQ 100 up 11 days in a row. We're seeing a lot of the Mag 7 have some up arrows here and there now, right? After a lot of selling in tech. What are you thinking is happening here?
Yeah, Nicole, like you said, we're living the good life at the moment, right? I mean, S&P is at an all-time high, NASDAQ best 10-day, 11-day winning streak since 2021. So investors are certainly a little bit more comfortable being in a risk-on mode again. And I think overall, good enough news for the markets is what the market is happy about at the moment, and is able to look a little bit through all the concerns that we have, especially in the Middle East, right? And that also checks with history. When we look at historical price movements around the breakout of conflicts, then we see, hey, and that seems a little bit counterintuitive at times, that before the conflict is actually over, that markets tend to rebound, and that's what we are seeing at the moment here. And also, especially when it comes to tech, tech was overall a little bit more the loser coming into this year of 2026, as other asset classes and companies were participating in a more market broadening out. But I think again, with the risk-on mode, we are seeing some winners here again. Certainly good signs here.
Yeah, understood. We think about something, as the S&P, by the way, folks, has now hit a high of 7,008. We think about software versus hardware, and we know the software stocks, the IGV, for example, was hit so hard. Is the bottom in, and what's the difference, software, hardware? What are you looking at, pros and cons there?
Well, Nicole, unfortunately, I cannot tell you if the bottom is in or if there will be more upheaval going forward, right? And when we see as soon as Anthropic and OpenAI release more AI models, then we see some more upheaval in software, especially with the term that was dubbed the sescopolypse. I don't know if I pronounced this right, but everyone knows what I mean, right? So I don't know if there will be more ahead. What I know, though, is that there will be winners and losers at the end. So there's no doubt about that. But investors were treating the whole sector basically in uniformity, and some companies are just were caught in the sell-off, not really justified, which opens up great opportunities, especially in the cybersecurity space, for example, which got hit hard again the last couple of days. And when you ask me about software versus hardware and hyperscalers, again, great opportunities in the software space.